So guys, our next standard will be Ind As 23, borrowing cost. This is pretty much similar to our accounting standard 16 in C-Enter. Only difference is the way in which you compute borrowing cost will change because of financial instrument standard. Now, after you have covered financial instrument standard, we learned a method called as amortized cost method. Under amortized cost method, the contractual coupon rate what you pay is not interest, but the interest expense computed using EIR is your interest expense. So that computation alone is different. Rest of the standard is pretty much similar to accounting standard 16. Anyway, let's start from the scratch. Tell me this, sir. For example, this fellow is a customer. He wants to buy a residential villa he wants to buy from a builder X Limited. Now, this X Limited builder, in construction of this house, he would have incurred so many expenditures. All that expenditure he has to recover from this customer only, along with his profit. If you see what all expenses he is incurring, he would have incurred something towards materials cost, labor cost, some overheads cost, designing fees, interior designing cost, so many costs. Then for spending all this cost, this fellow has to invest money. X Limited has to invest money initially. Imagine he did not invest his own money. He borrowed money from a bank and he purchased all this. But on that borrowing, he has to pay interest. That interest on borrowings. So all this will be the cost of the builder. To this cost, he will add certain profit margin and he will determine the sale price. Let's say this sale price came to 200 lakhs and the interest on borrowing is 50 lakhs. Now, a customer who pays 200 lakhs and buys the house, what entry will the customer write in his books? He will write building account debit to bank with an amount of 200. Do you agree that in the 200 lakhs, whatever is capitalized towards building, is there interest on borrowing during construction period? At 200 lakhs, interest on borrowings during construction period, is it included or not included? Definitely included. Who made borrowing? Builder. Who paid interest originally? Builder. But ultimately, asset is capitalized in the books of customer, and that cost definitely includes the cost, that means the interest on the borrowing during the construction period. This is an example. Another example you see. Sir, I took a 10% loan, 100 lakhs, for construction of building. In the first year, I started the work, but it's still in progress. So I already spent, let's say, 50 lakh rupees. The remaining amount is there in bank account, or I would have parked it temporarily under some investments, another 50 lakhs. Now, year ending, sir, on that loan, I have to pay interest. When I pay interest, I rate entry like this. Interest expense account debit to loan, 10 lakhs, 10 lakhs. Because ACM knows, sir, interest you have to credit to financial liability, and then loan account debit to bank. And normally, sir, what will happen to every nominal account? It will go to P&L account. Interest also is a nominal account that should go to P&L account. But if it goes to P&L account, I'll ask you, you are booking the cost in P&L. What is the benefit you received in the current year? Interest is incurred in relation to a borrowing, and a borrowed funds are used for developing a building, and the building is incomplete. That means it is not capable of generating any future economic benefits in the current year. When you spent money, but the asset is not yet ready for usage, then whatever money you spent takes the nature of cost of construction. It is not an expense in P&L account. So since the building is not capable of giving you any benefit as on today, so interest expense should not be thrown off to P&L account. Rather, this also will be capitalized. So the entry what I will be writing is building WAPE account debit to interest. The moment I write like that, it will become 60 lakhs in my balance sheet. So guys, this is my balance sheet at the end of year 1. Next, let us say another 1 year is over. So let's say building is ready for usage only at the end of year 2. So year 2 building is ready for usage, sir, but year 2 end. So I will not describe it as building WAP anymore. I'll call it as a proper building. Already 60 I capitalized last year only. Current year 50 lakhs also is spent. So total amount capitalized till now is 110 lakhs. Now I have a 10% loan, 100. On this loan, again I have to record interest expense account debit to loan with an amount of 10. Now what will happen to this interest? Building got ready for usage only at the last day of year 2. So throughout the year 2, building was still under construction. So interest expense cannot be charged off to P&L account. Interest expense also will be capitalized. So this time entry will be building account debit to interest expense 10. And as a result, the building is now ultimately capitalized at 120. From this, what I'm trying to establish is what is getting capitalized to the building is not only the cost of construction, the indirect cost of construction, which is the cost of borrowing also during the period of construction. Even if you buy a ready-made house also, the builder will definitely charge his borrowing cost to you, which is part of your 200 lakhs. When you sit and construct your own building also using borrowed funds, borrowing with whatever interest you are paying, that interest is also indirectly a cost of borrowing only. Now your asset got ready for usage at the end of year 2. Now, from year 3 onwards, whether you actually put the building to use or not, that is irrelevant. Building is capable of giving you benefits. Interest will go to P&L account. It can't be capitalized. Arey sir, once something is ready, once construction is over, how can I call it as cost of construction and capitalize it any further? Just because you did not use the building, it is capable of giving you benefits. No, if you don't use, that's a loss for you. If you use, there is some benefit coming, there is an expense coming in P&L account, matching will happen, some profit or loss or something will happen. Are you getting it, sir? From year 3 and onwards, interest cost should be transferred to P&L account. It cannot be capitalized. So this is all based on what? A simple principle of matching. Expenses should be matched with benefits. In the period of construction, the asset is not capable of giving benefits. It is in the process of becoming an asset. So whatever borrowing cost you're incurring, that partake the nature of construction cost and not as an expense in your P&L account. Therefore, don't release it to P&L account, but you capitalize it. Right? Now, standard ultimate essence is borrowing costs that directly are attributable to borrowing costs that are directly attributable to acquisition, construction, or production of a qualifying asset shall be capitalized. Capitalized meaning is take the interest cost directly into balance sheet, don't bring it to P&L account. Asset can go and add it, provided it should be directly attributable to acquisition, construction, or production of a qualifying asset. Now that brings us to the definition of qualifying asset. Now what is the meaning of qualifying asset? Official definition is qualifying asset is an asset that necessarily takes substantial period of time to get ready. So qualifying asset is an asset which necessarily take substantial period of time to get ready for its intended usage or sale. For example, every asset that takes substantial period of time need not be used. It can be sold also. For example, I'm constructing a factory building. After 4 years of construction of factory building, ultimately what will I do with the factory building? I will use it. So that's definitely a qualifying asset. I am constructing a 40-floor apartment. So total 500 flats will be there. It will take 6 years time. After 6 years, what will I do? I will sell. So every asset that necessarily takes a substantial period of time need not be used. It may be used. It can be sold also. So that indirectly now covers by this language. You must understand that even inventories can also be qualifying assets. Not every inventory automatically will not become qualifying asset. If an inventory has to become a qualifying asset, then that inventory also must take substantial period of time to get ready for its intended usage. For example, I'm a builder, I'm selling apartments. Apartment is a capital expenditure for the buyer, but for the seller, it is just like any other sale of goods. Correct? So for him, that apartment is an inventory. Now, again, coming back to the above definition, if you see, there are three wordings used now. One is acquisition, construction, and production. Acquisition means outright purchase. Construction means you understand. Production and a word is used only for inventories. Just now we have seen that in the definition of qualifying asset, inventory also can be included, provided inventory is taking a substantial period of time. Construction, anyway, you understand buildings, factories, plant and machineries, power plants, roads, bridges, tunnels, all this will take substantial period of time. Construction easily understandable. Why acquisition wording is there? What is the meaning of the word acquisition? Acquisition means outright purchase. If you are using the word outright purchase, that means asset is ready for usage. No? When asset is already ready for usage, then how can it be qualifying asset? Then a wording, why is it there? Read this, sir. Borrowing cost directly attributable to construction of qualifying asset can be capitalized. Sounds good. Qualifying asset anyway takes substantial period of time, so construction will suit there. Next, borrowing cost directly attributable to production of qualifying asset can be capitalized. Sir, what are you producing? I am producing 20-year-old scotch. 20-year-old scotch obviously take how many years? Minimum 20 years, no? So that's definitely a substantial period of time. That's inventory only, but still it is qualifying asset. Now, borrowing cost directly attributable to acquisition of qualifying asset shall be capitalized. Tell me, acquisition means what? Purchase. Purchase means what? Something which is already ready for usage, that only you are buying. When already something is ready for usage, how can it be a qualifying asset? For that, the answer is asset is ready-made asset, but it is not ready for my intended usage. Qualifying asset definition is what, sir? It should take substantial period of time to get ready for its intended usage. Example, you borrow money. With that borrowed money, you walked into Volkswagen showroom, you purchased a car, which is ready-made car. And that car is ready for your intended usage immediately. That is definitely not a qualifying asset. On the other hand, you borrowed money. You borrowed money you paid as advance to a machinery supplier who is located in some other country. Is the machine ready? Yes, machine is ready. That's the reason I paid full amount. That fellow shipped the machinery today. It took 4 months time to come to India. After that, 1 month time to get installed. I paid money at 0 time. Asset is getting ready for my intended usage at 5 months time. That's a substantial period of time. And the ready-made asset, but is it ready for my intended usage? No. Therefore, it becomes a qualifying asset like that. Next. Sir, what is the meaning of substantial period of time? This is not defined in the standard. Not defined in the standard. So, it's a judgment call, sir, and depends on facts and circumstances of each case. Sir, my brain is fogged, I can't make a judgment. Then take 12 months as substantial period of time. This is practical purpose, not in exams. Exam question lo, sir, what will happen is this fellow will make a borrowing on 1st April, start construction on 1st May, construction will complete on 1st of January. If you count, that's exactly 8 months. You should not say 8 months is less than 12 months, therefore it is not a qualifying asset, nothing needs to be capitalized. These kind of assumptions and all you are not supposed to make in the exam. That's why at 12 months and a word also I'm not writing. Because if I write, you will try to apply it somewhere. Standardly it is there, sir. If you can't make a judgment, consider 12 months period as substantial period. But do not apply that while doing questions. Questions, sir, even if construction period is 4 months, also if they are asking borrowing cost capitalization, shut up and capitalize it. Don't defeat the purpose of the question by saying that asset is not qualifying asset. Who are you thinking? What are you thinking about me? No, sir, don't do that. Don't make any assumptions which will defeat the purpose of the question. Nobody likes smart ass. So, this is what we covered, sir. Point number 1 covered, point number 2 covered. Now coming to point number 3. Borrowing cost definition. Now you see, sir, now that our instruments chapter is already over for us, you all know what is ACA method and all. Tell me, borrowing cost of what all is interest cost? The plain interest, whatever you are paying, legal contract interest, has anyway interest. Apart from that, transaction costs are also indirectly part of that interest. Any discount on issue, premium or redemption, they all are captured into what? Your EIR, they are all captured, isn't it, sir? Similarly, when you take an asset on lease, what is the first entry you rate as a lessee? ROU asset account debit to lease liability. On that lease liability, again you will book interest expenditure. What is the entry for that? Interest expense account debit to lease liability. Correct? Interest expense again is a borrowing cost only. She is explaining all that. Borrowing cost means interest and other cost incurred in relation to borrowing of funds. It includes interest expense calculated using effective interest rate method. What is EIR method, ACM and all, I need not tell you, sir. That is within your knowledge. As such, if somebody has forgotten, I give an example here. You can go through it. Next, finance charges in case of lease liability. That is also borrowing cost only. Next, the third one, important one. Exchange differences on foreign currency borrowings to the extent they are regarded as adjustment to interest cost. That means, when our entity is having foreign currency borrowings, you all understand foreign currency borrowing is a monetary item. Since it's a monetary item, on every balance sheet date, I have to remeasure it using closing exchange rate. When you remeasure it using closing exchange rate, there will be either an exchange gain or an exchange loss. What he says is some portion of that exchange gain or loss will be identified as the deemed borrowing cost. Sir, why and how much? That is very important. A question also is extremely important from an examination angle. So let's do one small example. So this is a concept in itself. It is CA interlow important, CA final law even more important. It's a mixture of your Ind AS 21 and Ind AS 23. Forex standard plus borrowing cost standard ka mixed effect. Let's see one small example. Sir, this fellow wants to construct a qualifying asset. He wants money. He don't know how to get the money. Then he went to SBI India. He told SBI, I want 40 lakh rupees. What is the interest rate? SBI says 40 lakh rupees. Interest rate. They told 10%. This fellow says 10% is too high. Let me borrow abroad. So he went to USA Bank. From USA Bank, he borrowed an amount of $1 lakh, let's say. Or else $50,000 $50,000. Imagine spot rate $1 is equal to rupees 80. So on conversion, $50,000 into 80 rupees per dollar, that became 40 lakh rupees. He happily invested off. Now, a $50,000 loan, he took it at the rate of 4%. Indian interest rate is how much? 10%, but abroad he borrowed at 4% only, very cheap. Now, year ending, what happens? This fellow has to pay interest. So, interest paid on foreign currency loan, $50,000 into 4%. How much is that? $2,000. Leave it. $2,000. But you are an Indian company, sir. If you have to pay $2,000, you have to spend rupees and buy dollars. Into, let us say case 1, my exchange rate is 85. Case 2, my exchange rate is rupees 81. So how much is my interest cost? One case you process, pink color, later on we can process. Okay. One case, first case alone I'm processing. How much for 1 lakh? 70,000. Now, what is the treatment of 1,70,000? This is definitely capitalized. Sir, why are you capitalizing, sir? Why did he borrow? For construction of a qualifying asset. Definitely 1,70,000 interest has to be capitalized. And moreover, our fellow is very happy also. Why is he happy? By making a smart decision. What is that smart decision? Had he borrowed in India, 40 lakh rupees, on 40 lakh rupees he has to pay how much interest? 4 lakhs. Interest cost in India is rupees 4 lakhs. But smartly, what did he do? He borrowed in USA and interest came to only 1,70,000. He's happy or not? He's paying lesser interest by 2,30,000. Now, this is one thing. Second thing, on this foreign currency loan, you have to do a remeasurement at the balance sheet date in accordance with Ind As 21. So when you borrowed the money, exchange rate was 80. Today, after 1 year, exchange rate is 85. So loan has to be increased. Definitely you will suffer a exchange loss. Exchange loss on remeasurement. Remeasurement of foreign currency borrowing. How much is that? $50,000 into originally recorded at 80. Now you have to remeasure at 85. So 5 rupees per dollar loss. So total loss is how much? 2,50,000 rupees loss. You tell me, sir, on monetary items, exchange gain or loss will go where? PRL. Outrightly monetary items exchange gain or loss will go to PRL. On non-monetary items, it depends. Wherever fair value gain goes, exchange gain or loss also will go to the same place. But monetary item, exchange gain or loss, definitely will go to PRL only. So ideally, this 2,50,000 goes to PRL, no? But what our standard says is, wait. Out of this 2,50,000, some amount we will treat it as deemed borrowing cost. And the remainder amount is an exchange gain or loss which is transferred to PRL. And whatever amount is treated as deemed borrowing cost, that amount will be capitalized. Now, what is this concept of deemed borrowing cost? Understand this. Had you borrowed in India, forget about foreign borrowing, had you borrowed in India, how much interest you would have paid? 4 lakhs. I would have allowed you to capitalize entire 4 lakhs. But no, because of your foreign currency borrowing, you are anyway capitalizing how much? 1,70,000. So had you borrowed in India, you would have capitalized extra how much? 2,30,000 extra you would have capitalized, correct? Now, out of this 2,50,000, what our India says is, to the extent of savings in interest. What is your saving in interest? Instead of paying 4 lakhs, you paid only 1,70,000. So to the extent of savings in interest, I will treat it as a deemed borrowing cost, and out of your exchange loss of 250, which otherwise should go to PRL, I am transferring 2,30,000 as a deemed borrowing cost, and I will allow you to capitalize it. Oh, which means what goes to PRL is the remaining 20,000. That nobody can help. Now you tell me, sir, why this provision is there? Why this provision is there? Somebody borrowed in India, he paid more, he capitalized more. This fellow, he did not borrow in India, he borrowed outside to reduce borrowing cost, and he actually reduced 1,70,000. So he'll capitalize only less. What is the need for you to go and do this? What's the need? That's not allowed for tax purposes and all, no. Exchange losses are allowed only when you actually pay, not on restatement. Accounting point of view, why is it? Why are you calling it deemed borrowing cost? If I ignore this point, this entire thing would have gone to PRL. Why is the standard doing it? The reason for that is, books lo rayar sir, but you should know. Interest rate parity theory. IRPTN, one small concept is there in your Forex chapter when you do AFM. What that fellow tells you is, if any currency has got lower interest rate, that currency is going to appreciate in future, and vice versa. Now, between these two countries, which one is having lower interest rate? USA. So, when you are making a borrowing in US for lower interest rate of 4%, you are happy because of lower borrowing, but you are also prepared for an exchange loss also. Pakka dollar price will rise. 100% will rise. So you will take the advantage of lower borrowing cost, but you will suffer the risk of exchange loss. If interest rate parity theory was perfectly holding good, 100% perfectly if it is holding good, you know what would have happened? Both ka total put together exactly will be equal to 4 lakhs. And 20,000 also will not come free. So what IRPT says is, whether you borrow here or you borrow here, overall cost on your pocket will be same. Okay, you did not borrow in India, you borrowed outside. Cash point of view, immediately you will see a saving. But whatever you saved in the form of interest, that much only you will lose in the form of exchange loss. So the namesake exchange loss, this is actually borrowing cost only, is what the standard applies. Sir, but my exchange loss is more than that. No, that's pure bad luck. For this, what can you do, sir? That will go to PRL only. But to this extent, I will capitalize it, calling it as a deemed borrowing cost, a pure classic application of interest rate parity theory. For that reason. Sir, any doubt in this? No. Continue further. Now, what I will do is assume that your exchange rate by the end of the year is not 85, but it's 81. If it's 81, then your interest will be how much, sir? Second case law? 1,62,000. I'm sorry, 1,62,000. What will happen to 1,62,000? I will definitely capitalize it. What is your exchange loss now? $50,000 into 81 minus 80, which is equal to 50,000 only. You tell me, sir, how much will it treat it as deemed borrowing cost? 50,000. You should not do, means how you should not think is, had I borrowed in India, I would have capitalized 4 lakhs. Now anyway, I'm capitalizing 1,62,000. Still gap is there to the extent of 2,38,000. I will capitalize 2,38,000. How can you capitalize? It's only cost of 50,000 now. You definitely have exchange loss, but how much exchange loss you have? 50,000. If what you have a 50,000, deemed borrowing cost also should be only 50,000. It can't exceed what is your exchange loss. Beyond that, you cannot exceed. So entire 50,000 is treated as deemed borrowing cost and it is capitalized. Why I gave you two cases is, the amount capitalized is not same. Observe closely. In the first scenario, you are having an exchange loss of 2,50,000, but I capitalized it only to the extent of savings in interest. But in second case, savings in interest is 2,38,000, but I capitalized it only to the extent of exchange loss 50,000. That means there is a cutoff point. Moral of the story, exchange loss is a maximum amount. At the same time, savings in interest is the maximum amount. Whichever, both you have to satisfy. So whichever is lower. So all this, if I arrange this in a form of steps, it look like step number 1, identify in India what is your notional borrowing cost had you borrowed in India. Step 1. Step 2, actual borrowing cost in foreign currency. Step 3, your savings in interest cost. Step number 4, your exchange loss. Step number 5, exchange loss or savings in interest, whichever is lower. That is your deemed borrowing cost. That's all. Properly, if you execute, you'll understand. Now my goal is to explain that here interest rate parity theory works, and based on that only certain exchange loss is treated as deemed borrowing cost. Chalo sir, on this one question is there, quickly you have to pick up that question, please. Take to question number 1, sir. First question itself. Read carefully. A Limited has a borrowing of $1 lakh at the rate of 4% from a US bank on 1/4/2016. The spot rate on that date is $1 is equal to 50. Okay, when you borrowed, exchange rate is given. The above loan is used for construction of a plant and machinery. By telling you this line, indirectly is telling you that there is a qualifying asset in place. Sir, imagine if qualifying asset is not there, there is no purpose of learning all this. Why? Sir, if qualifying asset is not there, I cannot capitalize anything, no. With the name of interest also it will go to P&L. With the name of exchange loss also it will go to PRL. What is the point of splitting like this? There is no point. Both will go to PRL only. So qualifying asset ka story is must. A similar loan could be obtained in India at 10%. At the end of first year, the exchange rate is 54 case 1, 51 case 2. Calculate the total borrowing cost that can be capitalized. So make two amount columns, sir. Case 1, case 2. Interest cost if borrowing was made in India. This is obviously notional calculation. How much is this? You would have borrowed $50,000. So how many dollars? $1 lakh, 50 rupees. Okay. $1 lakh you borrowed. And when you borrowed, exchange rate was 50. So 50 lakh rupees notional amount into 10%, 5 lakhs. Second point. Actual interest cost in foreign currency borrowing, $1 lakh. What is the interest rate at which you borrowed money? 4%. Into case 1, exchange rate is 54. Tell me this number, sir. 216, 204. Have no doubts, this definitely will be capitalized as interest cost. Definitely you have to capitalize it. Move on. Exchange loss in foreign currency borrowing. $54 it became. When I took it was 50. So 4 rupees is the loss on $1 lakh. So that is 4 lakh rupees. In second scenario, it became only 51. So that would be $1 lakh into 1 rupee. So that will be 1 lakh. Now, normally, sir, if no story is told to you, exchange gain or loss will go to PRL basically. But because this is a qualifying asset, some amount is treated as deemed borrowing cost. Sir, how much? Fourth one. Out of exchange loss in 3 above, lower of following is deemed borrowing cost. Number 1, savings in interest, 1 minus 2, or the entire exchange loss itself, that is 3. 1 minus 2, 5 lakhs minus 2 lakh 16,000, that's 2 lakh 84,000 or 4 lakhs, whichever is lower. This fellow gets selected. Second scenario, 5 lakhs minus 204, 2 lakh 96,000. This much savings you made. Luckily, exchange loss also is only 1 lakh, whichever is lower. 1 lakh gets selected. That's all. It's a deemed borrowing cost. Sir, you have to remember this. Steps and all are for neat rating, but ultimately, it is new point for you. Step number 4 is the hero, sir. Remaining all are just for computation purposes. How much amount can you treat it as redeemed borrowing cost? Chalo sir, next fifth one. Last point. Total borrowing cost capitalized. 2 plus 4. Kadanta 216, the 284. Total 5 lakhs. Oh? Correct. 216 plus 284. 5 lakhs. Here 204 plus 1 lakh. 3 lakh 4,000. Though they did not ask if you want to write exchange loss transferred to PRL. That is 3 minus 4. 4 lakhs losses, sir. 284 you treat as deemed borrowing cost. 1,16,000 rupees will go to PRL. Here nothing will go to PRL. Entire thing is capitalized. That's it. Fourth point, sir. Remaining all are working notes for that. Fourth point is a main crucial point. And remember, all this drama will start only when there is a loss. Because to avoid interest cost, you went for a foreign borrowing at a lower interest rate. So you borrowed at lower interest rate, paid less interest, but you suffered a loss. Out of that loss, some portion is deemed borrowing cost. Asal, if you never suffered a loss and you got directly a gain, then a gain will directly go to P&L account. There is nothing to discuss also there. Right. Now, sir, in these steps, any doubt is there? If you don't have a doubt, I have a doubt. Nikhil Babu, answer. What is the mistake in this? Let's see whether you ate the same breakfast like previous class or not. There is a mistake in this. You all are supposed to identify it by now. My hands were paining when I was writing that mistake. Nothing is given, that rate only is ACM rate, that rate only AR rate. You should not have a problem with that. I had to do that mistake because ICA does it. Okay. Interest cost, when will you incur? When will you pay? Year end. When will you incur? Throughout the year. Which rate you have to use? Average rate. Which rate did I use? Closing rate. That's wrong. Wrong, sir. You have to take average exchange rate. But all study mat questions, all exam questions, nobody is giving you average rate. They are doing the sum with closing exchange rate only. So, but it's 100% wrong. There's no doubt in that. The question won't give you average rate only. What will you do? E sums they are not giving. Sir, why are they not giving? Because stupids are copying from CA Inter books. AS16 question, March in AS16 place, India is 23 they are putting. Wrong. For that matter, IA16 answer question also is wrong. There also interest expense anywhere in the world is recognized only on average rate only. No, sir. How can you do it? India's 21 chapter we did ACM, no average exchange rate ki. How can each chapter ka rule will change? Bakka wrong question. I can't help there. Leave it. Now, I will take to a case, visualize an answer. Sir, this is first year ka story. It is second year ka story. And 2 subsequent years, asset is still under construction, QA, qualifying asset. Situation 1, first year I got exchange loss. Second year also I got exchange loss. You tell me, sir, when you get exchange loss on your foreign currency borrowings, what will you do? What will you do if you get exchange loss? Again, whatever we did till now, same thing you have to do. That means out of this exchange loss, some portion you have to identify it as a deemed borrowing cost and you have to capitalize it. So whatever we have done here, same thing you will do in year 1 also, year 2 also. It's the easy case. Means you already know. It's exchange gain first year. Second year also exchange gain. So if first year gain comes, second year also gain comes, then what will you do? If both the year gain comes, there is nothing to do. This will go to PRL. This will also go to PRL. Whereas first year loss, second year loss, here do all the 5 steps, as discussed above. Both your gains, both will go to PRL. You're pure lucky. You not only borrowed at lower interest rate, you are also enjoying an exchange gain. They really gain a happily enjoy. Nobody will stop you. Third case, also easy case. First year exchange gain. What you would have done? You would have transferred to PRL. Happy. Second year you got a exchange loss. So go and do your 5-step model. Whatever we discussed about. These 3 cases are easy cases, sir. This fellow, danger fellow. Initially loss, subsequently gain. Sir, what danger is there? You only tell me. Sir, when you apply your 5 steps, what you did, out of the exchange loss, what you suffered in the first year, some exchange loss, instead of transferring it to P&L account, you capitalized it to the asset cost, treating it as a deemed borrowing cost. Subsequent year, gain came. You know what it means? A loss what you suffered in the last year on remeasurement, that is not a genuine real loss. Out of that loss, some loss is now recovered in the form of a gain. But a loss, did you take it to P&L account? No. What did you do? You capitalize that loss. The gain also should go and nullify that loss. Where is that loss now? Already in the asset. The gain also has to be transferred to the asset. So to what extent? To whatever extent we have capitalized originally to that. Are you getting it, sir? So the last 4th case is important again. How to handle this 4th case? A16 was not answering this. Ind As 23 look, questions are there. E point specifically addressed. So that's why, sir, this is easy case, sir. In this there is nothing to do only. This is cheap case. This again normal easy case. This is something where you should be careful. First loss, subsequent gain. If first loss already some portion you would have capitalized to the asset cost. Subsequently gain came, it indicates that unnecessarily you have capitalized. You have to reverse it. Sir, to what extent? To the extent of loss capitalized earlier or present exchange gain, whichever is lower. Obviously, for example, here deemed borrowing cost came to 1 lakh. It actually exchange loss, but deemed borrowing cost name, so you would have capitalized this. In second year, sir, you got exchange gain of 1,40,000. Tell me what is the treatment of this? Tell. First year 1 lakh exchange loss, you capitalized it with some name called as deemed borrowing cost. Subsequent year, gain came 1,40,000. What is the treatment? Entire 1,40,000 will go to asset. No. Asset law, how much exchange loss is there? 1 lakh. So what you should do out of this 1,40,000, 1 lakh rupees gain is now capitalized. Capitalized means not adding. Capitalized means taking to balance sheet. A debit balance it will add, credit balance it will go and deduct. Gain is a credit balance, no? It will go and remove it from cost of the asset. What happens to remaining? The royal gain, happily enter into PR. What if your exchange gain itself is 70,000? Then how much can you credit to cost of the asset? 70,000 only. Even though capitalized amount is 1 lakh, you can credit to to the qualifying asset only an amount of 70,000. Whatever is there, that only you can credit. Now, how can you credit more than that? So exchange gain, instead of crediting your P&L account, go and credit it to qualifying asset. What goes to PRL is nil. That's it. So this is what extra that is there in Ind As 23 compared to A16. On this also one small question. Turn back, next question. On 1/4/16, R Limited made a borrowing of $40,000 from at the rate of 2% from a US bank. Sir, all of you keep your calci, you have to do it parallelly with me. 2% from a US bank. The exchange rate on that date is 59 rupees, spot rate on the date of borrowing. India ka borrowing interest rate. Who is starting calculations already? Read first. The borrowing rate in India is 8%. Closing exchange rate at the end of first year is 63 and at the end of second year is 61. Wait there. How you should read the question also you should know. Look at this. When you borrowed money, exchange rate was how much? 59. By the end of first year, exchange rate improved. You have FC payable, FC is increasing. Exchange gain or loss? Loss. First year loss. A 5-step model you have to do. Some portion of exchange loss definitely you would have capitalized with the name of deemed borrowing cost. Look at next year now. 61. From 63 of first year ending, second year ending, dollar rate is coming to 61. What does it mean? Second year you will have a gain. That means first year loss, second year gain. E case you have to be careful. Remaining cases like casually, if you do also correct answers only will come. Are you understand? So when you read the question, you first spot other exchange loss on the gain, the 2 consecutive years. It is which model? 4 situations are possible. No, it is which situation? 4th situation directly for us. Calculate the borrowing cost in both the years 16-17 and 17-18. Now, sir, first year law, since it is loss, all 5-step model you have to apply. Second year ki 5-step model and all not required. Normally you can finish it off. Let's do, sir. Start. Step number 1 is what? If you borrow in India, how much amount of interest you would have capitalized? $40,000 into 59 rupees into 8%. 1,88,800. But because you borrowed in USA, $40,000 into 2% into 63 rupees you will pay. 50,400. Sir, because our CA exam questions were like that, study mat questions are like that, I'm multiplying with closing exchange rate. But if the question gives you average exchange rate, definitely you have to consider that only. Be open for that thought. Okay, 59 rupees became 63 rupees. How much dollar increased to 4 rupees per dollar into $40,000? 1,60,000 exchange loss. Savings in interest into 1 minus 2 or entire exchange loss, whichever is lower. So 1,38,400 is lower. So that is your deemed borrowing cost and that is capitalized. So total borrowing cost capitalized is second step 2 and step 4 ka amount, which is 1,88,800. This is 16-17 ka story, just like our previous sum. Coming to 17-18, you got an exchange gain of 2 rupees. Of course, again borrowing cost is there. No, work out borrowing cost first. $40,000 into 2%, $800 into 61. 48,800. This definitely is capitalized. There is no doubt on that. What about exchange gain? 63 rupee per dollar became 61 rupee per dollar. That means there is a 2 rupees gain on 40,000, which means there is an exchange gain of 80,000 rupees. What is the treatment of this 80,000? Don't see the answer. Visualize all of you. How much exchange loss did we capitalize with the name of deemed borrowing cost? 1,38,400. That's only still sitting in the asset side only. Now we got a gain of how much? 80,000. 80,000 should go and remove that whatever is already capitalized. So entire 80,000 rupees is treated as deemed borrowing cost and you will capitalize it. Capitalize means not adding, adjusting to asset cost. So by doing this, what is happening? Your net borrowing cost capitalized is 48,800 you are adding to qualifying asset. 80,000 you are deducting from the qualifying asset. On a net basis, you are deducting minus 31,200 from the asset cost in year 2. You understand, sir? Total 80,000 got capitalized. Sir, imagine this is not 80,000, but this is 1,80,000. Then what you would have done? Or out of your 1,80,000 exchange gain, 138,400 will be treated as adjustment to the asset. Remainder will be treated as gain in your PRL. This sum we have to restrict only ourselves only up to 80,000. Suppose imagine the question did not give you. I am telling you. 18-19 third year colors. Again exchange gain came. Again 80,000 came. What will you do? Now out of 138,400 capitalized in first year, how much did you remove it in second year? 80. Still 58,400 is there. In the third year again, if you get a similar 80,000, 58,400 rupees you have to adjust it to qualifying asset cost minus it. Remainder will go to pure. Or you understand that there is nothing to buy hearts or whichever is lower and all. Just to first initial understanding. Once you understand the logic, you not buy heart all that. So very simple stuff. So all this I have summarized it here, in this table. Exchange difference for the first time, exchange difference arising subsequently. First time gain will go to PRL. First time loss low, the lower of these two will be treated as deemed borrowing cost. Subsequently also loss comes, same treatment. Subsequently gain comes after an exchange loss, then the lower of the following will be deducted from the borrowing cost. Either the exchange gain completely or the exchange loss treated as borrowing cost in the earlier years. This is specifically covered under Ind As 23, sir. This is not there in A16, E part. This is there anyway, A16 also it is. So fine, sir. Next, move on to capitalization ka story. See, what we have established is the interest cost, whatever you are incurring, will be added to the cost of the qualifying asset. This only we are calling it as capitalization of borrowing cost. Now, watch a small example so that you'll remember what we are going to study now. 1st April 2025, first this fellow borrowed money. Even though money is borrowed on 1st of April, some fellow told that auspicious day is not there, you should not start construction work right now. You waited. Stars, moon, sun aligned in the same line. That one fine day, you started 1/7/2025. On this date, coconut you broke. Work commenced. Even though work is commenced on that day, 1 rupee also you did not spend. Sir, how is possible? Simple designing work and all happening, sir. Actually, work started on 1/8/2025. Here, expenditure is incurred on qualifying asset. Now, from which date onwards can I start capitalizing? I am incurring interest cost from this date, by the way. From this date onwards, I'm definitely incurring interest cost because I borrowed. But I started the work here. First rupee spent on qualifying asset is here. From which date I should start capitalizing? Interest cost I'm incurring from here. 3 dates I'm giving you. Which date? What the standard says is, if you have to start capitalization of borrowing costs, you have to start from a date called as commencement date. E wording is also new in this standard. Commencement date means it is a date on which 3 conditions should be satisfied for the first time. What are the 3 conditions? Number 1, expenditure must be incurred on qualifying asset. Borrowing cost must be incurred. Activities necessary for getting the asset ready for its intended usage or sale must be in progress. And all the 3 conditions should be met for the first time on a date. That day is called as commencement date. From that day only you can start adding the borrowing cost to the qualifying asset. That day is which day here? 1st of August. This will become your commencement date. So all 3 points, all 3 events ka dates you identify, whichever is later you pick up. When all the 3 are met for the first time. So if you ask me, sir, on 1/9/2025 also all 3 are happening, no sir, that is also commencement date, no sir. First time when all the 3 coincide, that is called as commencement date. So first time is this. From here onwards, interest cost can be capitalized. Sir, but the banker fellow is asking me to pay interest here also, no. He will ask, why did you take loan early, stupid fellow? You should have met astrologer first. Correct, no sir. You took loan in advance, as a loss. This will go to PRL, not allowed to be capitalized. Next, when I say work commenced, it need not be bricks, cement, sand, labor, crane, all that not required. Even administration work, technical work, planning work, that is also okay. For example, if I have to construct a building, I have to apply for the government authority that please give me clearance, I'm going to start a construction work here. That admin work also counts. That is also counting. So, any important points, sir? Read. An entity is required to begin the capitalization of borrowing cost from the commencement date. It is a date when entity has first met all the 3 conditions cumulatively. Number 1, qualifying asset expenditure should be incurred. Borrowing cost should be incurred. It undertakes activities necessary to prepare the asset for its intended usage or sale. When I say activities, they include technical or admin work prior to commencement of physical construction. So that is also okay for us. It is extremely important, sir. E standard lo directly it is not tested. but in PPE standard, one question is there on this. We did that question also. What it says is, it does not include the holding of an asset when no production or development that changes the asset's condition is taking place. I know that's difficult to understand, so I put an example. Please go through it. Borrowing cost incurred while the land is under development are capitalized during the period in which activities related to development are being undertaken. Sir, imagine, sir, you have to construct a factory. Where will you construct a factory? Area, land. So first you have to buy land. Just to be, so, but land is not a qualifying asset. Why? Land is ready for its intended usage on the date of purchase itself. No. So land should not be treated as qualifying asset. But land borrowing, sir, land purchase, if you made any borrowing, which is going to be used for construction of the factory, once factory construction starts, then you are changing the nature of land to a factory. So from the date of construction only, borrowing cost can be capitalized, not for the purchase of the land. For example, 1st April you purchased the asset, but factory construction started on 1st May. 1st May onwards only you should capitalize. Even though you incurred borrowing cost even in the April month, you cannot capitalize it. The question already was solved in PPE standard. There was one big question where this fellow initially purchased the land, incurred so much of expenditure, and ultimately constructed a factory. Construction cost should be capitalized from the date of construction, not from the date of purchase of land. Of course, land is a precondition for construction of factory, but land by itself is not a qualifying asset. So that's what he's saying. Borrowing cost incurred while land acquired for building purposes held without any associated development activity do not qualify for capitalization. Next, suspension of capitalization. Suspension, meaning is what? Temporary stoppage. Please, there only write. Temporary stoppage of capitalization. Follow this example, sir. 1/4/2025, let's say, is my commencement date. When I borrowed and all is irrelevant for you. Once I tell you this is commencement date, this is the date from which borrowing cost capitalization is started. From here it will start. It went on, work is going on nicely, sir. Then 31st March 2026, we received a stay order from government. Somebody filed a case on us saying that the land on which you are constructing this commercial complex belongs to some poor people which you have encroached them, we have threatened them, and we are constructing a building. Court says halt. Till the matter is pending in the court, no further work should be carried on. So fine. I also incurred legal expenses, I also fought, and overall by the time I win, it took another 1 year. And then 1/4/27, again work resumed, and ultimately work finished off here, 31st of December 27. Now, how many months ka borrowing cost I can capitalize? If you count from the commencement date till completion, this is the ultimate completion. From here to here, if you count, here 12 months, here 12 months, 24 months, here another 9 months, 33 months total. But in this 33 months, tell me, sir, entire 33 months of work happened? No. There was a period of 1 year where active development of qualifying asset got interrupted for extended period of time. So during this period, even though work is not happening, still to your bank you paid interest. Interest is actually not necessary, but still you had to pay because banker you have to pay because you made the borrowing, but there is no development happening here. So it's a pure in the nature of loss. So the entire period interest cost, borrowing cost incurred during interruption period, interruption of qualifying asset for extended period, shall not be capitalist. Why enter in loss, sir? Losses, how can he calculate as a loss? No fool will allow you to capitalize loss. Sir, just now only, no, sir, exchange loss we capitalized. Are sir, adi namesake exchange loss. Conceptually, that is borrowing cost as per interest rate parity theory. That's the reason we capitalized. Losses capitalization is a joke. Nobody, loss means what, sir? Money loss, the benefit will not come. Sir, just because your project got halted for a period of extra 1 year, you paid more borrowing cost. If you charge a higher price to customer, he will buy. He will not buy. Your competitor did not suffer that loss. No, that fellow will sell at normal price only. If you jack up the price, why will the customer come to you? He will not come. So, this pakka loss. Losses cannot be capitalized. This event is called as suspension of capitalization. So, moral of the story, when will you suspend capitalization of borrowing costs? When active development is interrupted for extended period of time. E words as it is, you have to understand. Active development should be interrupted for extended period of time. Sir, extended period of time means what, sir? Array, sir, our standard does not define what is substantial period of time, which is qualifying as a base. That only they did not define. Do you think they will explain you what is extended period of time? Definitely they will not explain. Again, it depends on what? Facts and circumstances of each case. Now, one general thought I am telling you. Suppose, sir, for construction of this complex, we will have a deadline in our mind. If because of delays, interruptions, our overall deadline is going to be crossed, then that is treated as extended period of time. If the deadline, original deadline is not breached, you can ignore it. I'll tell you another example. Sir, 1st January, a customer asked me to construct a house for him, which I told will take exactly 1 year time. If 1st January gave the order, next January house warming certainly, plan accordingly, sir. 31st December ki new house lo you are shifting. I told him that. So, in next 1 year, whatever borrowing cost capitalization is there, that I can do when, if there is no interruption at all. But imagine, sir, in the month of July and August, rains came. Work stopped for a period of 15 days. For 1 month, work stopped. But my deadline will not be extended. Why? When I committed the deadline on 1st of January, don't I know that rainy season rain will come? I don't know. I know that. Knowing that only I planned. And moreover, can you stop rain? As a natural, no, sir. That is a natural, normal, unavoidable. Moreover, it is not for extended period of time. And therefore, small hearts, suppose you should not literally take it very serious. You should not say, Sunday workers did not come. Project went on for a period of 1 year. So total 50 Sundays are there. 50 Sundays work did not happen. 50 Sundays ka borrowing cost, I will transfer it to P&L account. Wrong answer. Normal, unavoidable, you can ignore it. If it is not extended period, you can ignore it. Why I ask you to remember that wordings exactly is, sometimes delay will be there, sir. If rainy season, how will you work? You will not work. So holiday for a period of 15 days, 20 days. For 15 days, 20 days, even though work is not happening, ICICI Bank, you still have to pay interest, no? Interest in a way, honestly speaking, is a loss. But that is unavoidable, normal, not for extended period. Happily capitalized. There is no need for you to suspend capitalization. Questions are there on this? Entity is required to suspend capitalization of borrowing costs during extended period in which active development is interrupted. However, if there is any temporary delay, which is normal and acceptable, borrowing cost capitalization need not be suspended. And finally, coming to the next level called as cessation of capitalization. This is forever stoppage. Forever stoppage of capitalization. You need not even read that. Tell me, when will you stop forever? When the asset is ready for its intended usage. Then obviously asset is complete. No, once asset is complete, with what phase will you call this is indirect cost of construction? Asset is completed already. You cannot capitalize. It is general thought. But when you read, specific points will come. What that fellow says is, capitalization of borrowing costs should cease when substantially asset is ready for use. Indirectly, activities necessary for completing the asset are substantially completed. You need not 100% complete it. Substantially, if it is over, that's enough. Why, sir? Otherwise, what will happen? Imagine, I'm constructing an apartment building. Apartment, let's say it will take 3 years to construct. Big apartment. I constructed. 3 years construction period, qualifying asset, happily capitalized. What happened? Third year, I realized that sales are not happening. When sales are not happening, if I declare that this project is complete for accounting purposes, what I have to do? Fourth year onwards, the entire interest cost will come to P&L account. Sale is not there. What will happen? A company will suffer a loss. What this fellow will do? Sir, every flat flow, sir, little keep pending. Sir, painting is not done. Bathroom fittings are not happening. Door is not there here. He'll temporarily, wantedly keep it incomplete to get it. So to convince the auditor that project is incomplete, no. So still I will capitalize. Sir, in every, sir, you buy any property, sir, nothing will be fully complete. They'll promise you 100 things. At the best, they'll finish off only 99. One promise will never be fulfilled. Something or the other thing a builder will miss. He will escape with the name of, it is not 100% complete, I will capitalize. Standard says, don't play games with me. Substantially, all the activities, if they are completed enough, stop capitalization. This is one reason where people can manipulate. Another reason is, you imagine, sir, many times buildings you see, for example, in this lane only, on the main road, I've seen a building. Every time I pass through the road, a blue color cover is there like that only. 1.5 years. It's not a very tall building also, only 2 floors. Why that blue cover is there? Why construction is still happening? When I see inside, ground floor is completed, top floor is also completed, the middle floor, half work done. When I inquired, that fellow says, sir, building is ready for sale or giving it on rent. Why is it looking like this? What is cement? What is all this here? Why did you not finish it properly? He says, depending on the tenant who comes here, I will do the rest of the work. Suppose a restaurant comes, that fellow wants a particular kind of finishing. A gaming zone comes, that fellow wants a particular kind of finishing. A hospital comes, a different kind of finishing. Depending on the bank comes, different kind of requirement they will have. So depending on the tenant, they will do the last job. So for that, they'll keep little open work. They'll not finish it completely. Little open just less. These days, you see, when you buy any apartment, sir, nobody is doing interiors. Earlier, shelves and all at least they used to give. Today, they are not giving. What are they doing? Do as per your requirement. Your interior fellow will do it. We are not doing. They'll just give the space. You yourself have to do the rest of the job. That is also treated as substantially complete. Next. When asset is getting completed in phases, cessation of borrowing cost also will happen phase wise, provided a completed part should be capable of using it. Example. Small points, sir, but all are very obvious points, but questions are there, unfortunately. So you got to cover everything, though they are very simple for you. Imagine, sir, first floor, second floor, third floor. In year 1, floor 1 is complete. At end of year 1, you tell me, sir, I have to do capitalization for which floors now? Year 1 lo tell me. Borrowing cost capitalization for all 3 floors. Floor 1, floor 2, floor 3. Sir, floor 1 is over, no sir. Floor 1 is over when? First day, last day? Last day. Throughout the year, whatever borrowing cost I incurred on floor 1 definitely will be capitalized. Similarly to floor 2, similarly to floor 3. However, now that floor 1 is ready, hereafter you should never capitalize any borrowing cost to floor 1. Right? Next, when you come to year 2, year 2 end, floor 2 got completed. So in year 2, what you will do, whatever borrowing cost you are incurring to floor 1, floor 2, floor 3, this will go to PRL. These two will be capitalized. First year, what happened? All 3 are capitalized. Second year, floor 1 we transferred it to PRL. Floor 2, floor 3 were still capitalized. Third year, if floor 3 is also completed, then third year, no, floor 3 alone, I'll capitalize. Floor 1, floor 2 will go to PRL. It's like that, phase wise. But look at this example. I'm constructing something like a oil refinery where there are 3 chambers required, A, B, and C. So it is like this. Three chambers have to construct and have to integrate them. By the end of first year, this is completed. Now that this is completed, whatever borrowing cost is relating to this, can I stop capitalization? Yes, sir. These two are pending. Can I use only A? Yeah? If I put oil here, it will fall down here, no. B and C are not there, no. So even though A is completed, A is not ready for my intended usage. Whereas is to put floor 2, floor 3, even if it is not completed also, floor 1 I can still use it and give it on rent to somebody else also. So phase wise cessation is allowed only when the completed phase is capable of being used or sold. Here it is possible, here not possible. So until the entire project is over, you have to continue capitalization of borrowing costs. Easy concepts, sir, but careful. When an entity completes construction of qualifying asset in parts and each part is capable of being used while the construction continues on other parts, the entity can cease capitalization of borrowing cost relating to that part which is completed, provided what? Each part is capable of being used while construction continues on other parts. Up to here, we have covered 50% of the standard. Half was over. You know what? One question also we did not cover except for plain foreign cost exchange cost, foreign currency exchange also how much is deemed borrowing cost alone we covered. Why we did not touch any questions is all the questions will start from now. This fellow is a villain of entire standard, specific and general borrowings. Till now standard level is here. Now it will go 2 notches up. Our general borrowings is the main hero of the standard set. Specific borrowing, nothing is there. Once you pass this, almost all questions will be over at once. And there are no further concepts you have to learn here. Anyway, let's come here. You tell me, sir, don't read, just casually guess. Now that you all understand what is the flavor of Ind As, what kind of criminal Ind As is, tell me. Specific borrowing, general meaning is what? What comes into your mind when you say specific borrowing? A borrowing that is made specifically for the purpose of qualifying asset. Okay. Hey, sir, you are 100% right. Borrowings made exclusively for the purpose of fantastic, mind-blowing, beautiful, correct answer. That relation should be so direct that if expenditure on qualifying asset is 0, borrowing cost also would be 0. So borrowing A would not have been there if there was no qualifying asset. That kind of direct relationship should be there. That's all fantastic. Now, what this fellow says, borrowing cost to be capitalized is equal to borrowing cost incurred on specific borrowings minus any income from investments, income from temporary investment of borrowed funds. Okay. Let's say 10 lakh rupees loan, sir. Interest rate is 10%. Pakka specific borrowing. I'm telling you 2 numbers. Correctly answer. A loan obtained on 1/4/2025. Today, on 1/4/2025, same day only, let's say work commenced. Expenditure on qualifying asset is also incurred, but only to the extent of 6 lakhs. You borrowed 10, but you spent on qualifying asset only 6. The another 4 lakhs you spent here. After 3 months, further expenditure on qualifying asset is spent. Your asset is still incomplete only, sir, by the end of the year. Forget about that investment income for a moment. Tell me, how much borrowing cost today capitalize? Sir, whenever we are capitalizing borrowing cost, whether it is specific or general, what is important is you identifying commencement date. Before that, you cannot capitalize. What is commencement date? 3 points cumulatively have to be met for the first time. Who are they? Borrowing cost should be incurred. On which date did you incur? 1/4/2025. Work should started on 1/4/2025. Expenditure on qualifying asset also should be incurred. That is also satisfied, which means this fellow becomes your commencement date. So fantastic. 1/4/2025 inch you can play. Tell me amount. Amounts are amount. Work out. 10% I wantedly gave so that easily you'll work out. Still you want calculator, huh? Okay, fine. Work out. 6 lakhs into 10% into how many months? Total 12 months. Okay. What about 4 lakhs? 12 months. 12 months or 9 months? E 4 lakh rupees money is used in the project only for a period of 9 months, whereas this money is used in the project for a period of 12 months. So, E 4 lakh into 10% into 9/12 is wrong answer. No, sir. Specific borrowing, no. Your talent you should show in general borrowing. E type of questions, I know what you did in your past, but that is for general borrowing. Specific borrowing, at round, sir. How much you spent on the qualifying asset is irrelevant. If it is specific borrowing, what the standard says is, Are sir, a qualifying asset ki borrowing direct relation. How much you spent is irrelevant. Did you spend or not? Yes, sir, 10 rupees spent. Enough. Commencement date condition satisfied. What I will do? Entire 10 lakh rupees into 10%. Total you have to capitalize. Sir, but if 4 lakh rupees is not used in the project for the first 3 months, still you capitalized 4 lakhs ka 10% also for the first 3 months. But it is a specific borrowing, sir. Meaning, if that expenditure is not, if that qualifying asset is not there, the borrowing also would not have been there. So when I need how much money, that in the process of construction only I will know. So I borrowed 10 lakhs. So entire interest can be capitalized. Sir, my first 3 months, what did you do with your extra 4 lakhs not spent? I invested somewhere, I got some interest income. So the standard says minus any investment income. That also you minus. On temporary investment. If that is not there, ignore. If it is there, in net borrowing cost alone should be capitalized. So what is the moral of this example? If it is a specific borrowing, how much money you spent on what date for how much period is irrelevant for you. Once you identify the commencement date, entire borrowing cost must be capitalized, net of any income from investment. That's all. Borrowing cost incurred on specific. Whatever is your actual borrowing cost. Of course, can't break this rule, huh? From the compromise. That is fixed. Identify the commencement date. Before that, 1 rupee also cannot capitalize. From the commencement date, entire borrowing cost you can capitalize on specific borrowings, even though you did not spend it. Please read ma. Borrowing cost made exclusively for the purpose of acquisition or production or construction of qualifying asset. Borrowing cost capitalized is equal to actual borrowing cost incurred minus income on temporary investment of borrowed funds. All borrowing costs have to be capitalized from commencement date, even if only a part of borrowing funds are utilized in the qualifying asset. Exclusively on these questions are there. First, we'll pick up 1 or 2 questions, sir, so that some questions at least we can finish off some tally. Exchange rate sums I already finished off. Come to question number 5, please. Alpha Limited on 1st April 20X1 borrowed 9% rupees 30 lakhs to finance the construction of two qualifying assets. Please stop there and also underline there. Borrowed 9% to finance construction of two qualifying assets. How clearly he is telling that's not general information. That means it is a specific borrowing. When did you borrow? Date important. 1st April 20X1. Construction also started on 1st April 20X1. The loan facility was availed on 1st April, was utilized as follows, with remaining funds invested temporarily at 7%. On 1st April 20X1 only, you spent off 5 lakh rupees. For factory building, office building, you spent off 10 lakh rupees. You observe, sir, these 3 dates ki, three conditions are satisfied for me. Borrowing is made, expenditure on qualifying asset is incurred, construction work also started. So who is my commencement date? 1st April 20X1. From there I can start capitalizing. Start capitalizing how much? You tell me, what is the factory building ka total cost? 5 plus 5, 10 lakhs. Office building ka total cost? 20 lakhs. 10 plus 20, total how much borrowing? 30 lakhs. Perfectly matching. On 10 lakhs, entire year ki fully capitalize at the rate of, what is the interest rate ma? 9%. Please do, sir. 10 lakhs into 9% is how much? 90,000 here. Minus some income is there that I'll adjust. Come here. 20 lakhs into 9%. 1,80,000. Here also some minus I have to do. Now what minus I have to do? Observe, sir. Factory building total cost 10 lakhs. First day I spent of 5 lakhs. Another 5 lakhs I spent on 1st of October. In the first 6 months ki, another 5 lakhs is invested elsewhere at the rate of 7%. Take your calculation, work out the investment income, please. 5 lakhs into 7% into 6 by 12. 17,500. Similarly here, you invested 10 lakhs. Double amount kada, double jese, 35,000. 10 lakhs into 7% into 6 by 12, 35,000. So net you can capitalize here 72,500. Here you can capitalize 1,45,000. That's all over. Easy only. Anything is confusing here? Specific borrowing law, do not count dates. Date is relevant only for identifying the commencement date. Once you catch the commencement date, entire specific borrowing though you have to multiply and capitalize it. How much you spent on which date is irrelevant. Okay guys, this is done. Now coming on to the general borrowings. So this is one story in itself. This beyond a point will become slightly confusing also. So I'll explain it through examples. You go on catching the entire summary points of all the examples. We'll summarize it. And then we'll see questions. You'll get more better idea of this. But as such, this is not difficult, but not too easy also, unfortunately. So anyway, let's see what is the meaning of general borrowings. So general borrowings means these are borrowings in balance sheet or existing borrowings in balance sheet which are not specific borrowing. Don't understand it as a silly definition, sir. Other than specific, you are calling everything as general borrowings. True, but the meaning is specific borrowing means, sir, exclusively for the purpose of qualifying asset, you are going to the bank and you are borrowing money. General borrowing is not like that. You need not borrow now. Already existing borrowings are there, no? Our borrowings, I will call it as general borrowings, and the standard prima facie believes that our borrowing money, you already used it in construction of this qualifying asset. Okay, sir. So the by default assumption of the standard. So anything that is not specific borrowing automatically will become a general borrowing. Now in my balance sheet, sir, there is a 10% SBI ka loan, not specific. There is a 12% debentures, not specific. there is a 8% working capital loan. Not specific. Working capital loan is general expenses loan. And now what am I doing? I am incurring some expenditure on qualifying asset. What the standard says is, since these are not specific borrowings, some money out of this borrowing is used in this qualifying asset. I cannot prove 1-to-1 rupee relationship because the borrowing is not taken exclusively for the purpose of that qualifying asset. 1-to-1 relationship cannot be proved. So by default assumption is borrowing is definitely used in this qualifying asset. So you have to capitalize interest. Okay, how much will I capitalize? Now my borrowings are having different rates, no? So you cannot capitalize with different rates. You have to convert all of them into one single average rate. Now that's why our step number 1 will be determine weighted average capitalization rate on general borrowings. Now, how will I get this? So, weighted average capitalization rate is like this, sir. Take the interest cost on general borrowings divided by, it is very important, not divided by borrowing, divided by weighted borrowings outstanding during the year. Sir, the standard is very simple and extremely confusing, especially is on low people falter and make mistakes. Step 1 low, one weighted average will be there. Step 2 low also weighted average will be there. This is for borrowing ka weighted average. Step 2 is expenditure ka weighted average on the qualifying asset. People get confused and make a mess of the whole thing. Be careful. Now, just example to explain you the story of this rate. Imagine there is a 10% loan. 100 lakhs. There is a 12% debenture. Let us say 150 lakhs. This is amount of borrowing. I want weighted average borrowing rate. How will I identify? Let's first work out the interest cost. 10% into 100. How much is that? 10 lakhs. So the 100 into 10%. Next, it is 150 lakhs into 12%. 18 lakhs. So total it is 28 lakhs. What's the total borrowing? 250 lakhs. So what is your capitalization rate now? Average rate 28 divided by 250 into 100. How much is that? 11 point. Listen, I did not apply any formula and all. Total interest divided by total borrowings I have done. Your answer is not wrong in this example, but in some other example you will get a wrong answer. Why the answer is not wrong is, it's purely coincidence that your answer is right. What did you do? Total interest divided by total borrowing. If you apply my formula, you won't get any different answer, but you will get a more 100% accurate answer, which will come same in every case. For example, you see 10 plus 18 is a total interest cost divided by, what did I ask you to do denominator low? Take weighted average borrowings, which is 100 into 12 by 12 and 150 into 12 by 12. Now also you'll get the same answer, 11.2%. But where the importance of this formula comes is, when borrowing is raised during the year or repaid during the year, then if you follow total interest cost by total borrowings, then you will get wrong answer. So let's see one small case for that also. If we unknowingly, casually mistakes will happen. Look at this. Sir, I made 1 lakh borrowing here at the rate of 12%. At 6 months time, I made another 1 lakh borrowing at the rate of 12%. At 12 months time, I am paying interest cost. On this, my interest cost for 12 months is how much? 12,000. My interest cost on the second borrowing for 6 months is 1 lakh into 12% into 6 by 12, that is 6,000. So if you check my total interest cost, it is 18,000. If for a moment I hide these numbers from you and ask you, this is my total interest cost, that's my total borrowing, what is the interest rate? You all know the interest rate already. Interest rate is how much? 12%. But if you work out like this, 18,000 total divided by 2 lakhs into 100, you will get an answer of 9%. This is definitely wrong answer. Answer is what's at 12%. 12%, how will you get? 18,000 divided by first 1 lakh borrowing was there for entire 12 months. Second 1 lakh borrowing was there for 6 months into 100. So 18,000 divided by 1,50,000 into 100. That way you will get your perfect answer. So like numerator, like denominator. Sir, what is like numerator? You tell me, how did you get 18,000? How did we get 18,000, sir? 18,000 how we got is first 1 lakh into 12%, 12% into 12 by 12 plus 1 lakh into 12% into 6 by 12. Numerator lo whatever weights you used for interest computation, denominator also same weight must be used, otherwise a number will be a wrong number. These kind of traps will be there in the question. This is step number 1A. Still you are still determining a rate for capitalization. Each stage also mistakes ki chance is there. Be watchful. This is step number 1. Once you cross step number 1, step number 2 onwards, it's not difficult, sir. Just you should know different versions of it. That's all. Step number 2 is identifying the expenditure on qualifying asset. Financed through general borrowings. What is the meaning of this? Let's see. 1/4/2026. Expenditure incurred 6 lakhs. 1/10/2026. Expenditure incurred 4 lakhs. 1/1/2027. Again expenditure incurred is 3 lakhs. And you are closing your books of accounts on 31st March. Imagine your capitalization rate is 12%. Then how much interest can you capitalize? What is there? It means 6 lakh rupees borrowed, general borrowing is used in this project for a period of 12 months. 4 lakh rupees general borrowing is used for a period of 6 months. 3 lakhs general borrowing is used for a period of 3 months. Since it is not specific borrowing, you should not say, sir, if 4 lakh rupees borrowing, what happened to it in the first 6 months? That is general borrowing, sir. That's not related to this asset unless you actually spend it. So, whenever your spent happens, from that date only I will count. So, what I will do now, on this 6 lakhs, on this 4 lakhs, and similarly on this 3 lakhs, I will capitalize proportionately, which will work out to 6 lakhs into 12% into 12 by 12. How much is that? 72,000. Similarly, 4 lakhs into 12% into 6 by 12, 24,000. 3 lakhs into 12% into 3 by 12, 9,000. Total it up, ma? 20. Entama? 10. This is borrowing cost capitalized to qualifying asset. Directly you can get the answer like this. Or alternatively, smart work is also there. What is that? Is instead of making all these diagrams and all, you can directly work out weighted average expenditure on qualifying asset. How to work out is directly take weights. 6 means in the above calculations, ignore the percentage. 12% remove yes. So it will be into 12 by 12. 4 lakhs into 6 by 12 plus 3 lakhs into 3 by 12. You are indirectly saying that 6 lakh borrowed fund is used for 12 months, 4 lakhs general borrowing is used for 6 months, 3 lakhs general borrowing is used for 3 months. What's the final answer, ma? 9 వచ్చిందా? No, sir, you won't get 9. What is the meaning of this is, it is as good as you using 8,75,000 rupees of general borrowings on the qualifying asset throughout the year. If you identify this as step number 2, then in step number 3, what I will do is borrowing cost capitalized is equal to step 2 into step 1. Step 2 into step 1. This capitalization rate 8,75,000 into 12%, let's say. So it will come to 1 lakh. Any which way, whatever is comfortable, you can do that. But what we identified in step 1, 2, 3 is only general borrowings. If this project is also funded by specific borrowings, a specific borrowing cost also you have to capitalize. The general borrowing work is step 1, 2, 3. Am I clear till here? Now listen to this. Up to here, CA internal also it is there. The CA final one extra point you have to learn. What is it extra point is? Till now, you incurred expenditure up to which date, sir? 31st March 27. Tell me, by 31st March 2027, qualifying asset balance is equal to how much? Count 6 plus 4, 10 plus 3, 13 lakhs you directly incurred. Not only that, you capitalized an amount of 1,05,000. So total it is 14 lakh 5,000. Till here clarity is there? No, one more here. So final ka story starts here. Up to there see enter. Come here. 1/4/2027. This year 2 lo you are there now. Already your opening balance of qualifying asset, including borrowing cost, is how much? 14 lakh 05,000. Next. Or else let me put this here so it will be confusing otherwise. Okay, right here. On this date, expenditure incurred. Another 5 lakhs incurred. 1/4/2027. Now, on 30th June 2027, you received a government grant of 3 lakhs. If government grant comes, you know what's the meaning of it? To that extent, money is already recovered. So your borrowing cost or your expenditure incurred on qualifying asset is now reducing. Next. It is positive for you. One more event happened. On 1/10/27, again you incurred expenditure. Let's say this time 10 lakhs you incurred. Finally, on 31st March 28, qualifying asset is complete. Now, sir, step 1 answer is fixed at 12%. Tell me, step 2 ka amount. The amount on which I have to apply 12%, that we have to work out. Tell. It is easy, sir. Here nicely you did. That is first year. Second year, how to do this is, step 1, capitalization rate. Let's say that is easy, only 12%. Step 2, expenditure on qualifying asset. This is the amount on which you have to apply the 12% rate. Tell me, sir, how much did you incur in the current year? 5 lakhs you incurred. For how many months? 12 by 12. So 5 lakhs definitely have to take. But luckily, 3 lakh rupees is recovered for you. Correct? So minus government grant receipt. Government grant you received means for 9 months you did not use a general borrowing to that extent. So what is 3 lakhs into 9 by 12? 2 lakh. To that extent you did not use general borrowing. It's just like, in your EPS standard, Wayne's calculation of buyback type. Buyback comes, what will you do? You will remove buyback for the remaining period, no? Like that, a government grant to progress payments, remove it. Next, again I incurred, no? How much? 10 lakhs. When did I incur? Exactly in the middle of the year. 6 months by 12 months. So that will be equal to another 5 lakhs. So total how much? 5 lakhs plus 5 lakhs. 10 lakhs minus 225. How much is that? Not only that, opening balance also you have to consider, including borrowing cost capitalized, which is how much? 14 lakh. Sir, that amount also is borrowed money only. On that also interest you are paying. Our borrowing cost, our qualifying asset, whatever borrowing cost you capitalize, interest paid, from where did you pay that interest? Is the qualifying asset already earning money for you? If it is already earning money, that is not qualifying asset. No. That means what? On that qualifying asset, whatever borrowing cost you capitalized, our interest also is funded out of general borrowings only. That is treated as cost of construction, and therefore this is your starting point into 12 by 12. Put it up on total. 21 lakh 80. This is the expenditure on which you have to apply your borrowing cost capitalization rate, which means in your step number 3, borrowing cost to be capitalized is equal to 21 lakh 80,000 into whatever rate you get, 12 or 8 or 10 or whatever it is. Some number you tell me, ma? Are you understanding, sir? This is easy, sir. First year, very easy. When you come to second year, you have to remember opening balance also you have to consider. E-standard does not talk capitalization on specific expenditure incurred. It talks about entire average expenditure. In that, opening balance will be there, current year incurs will be there, grants received should be minus, progress payment received should be minus. Average amount ki you have to apply the rate. Very, very, very important. So that's what exactly we have written here. Please read these points once quickly. When the borrowings are made from various sources or for various purposes, including qualifying assets, the borrowings are referred as general borrowings. In case of general borrowings, identification of borrowing cost to qualifying asset is not direct. Once qualifying asset is complete, specific borrowing related to qualifying asset also now enters into the pool of general borrowings. Okay, point later on I will tell you. Come to steps now. Step number 1, calculate weighted average capitalization rate. Total interest cost on general borrowings divided by weighted average general borrowings. Imagine must, sir, understand correctly, step number 1 low weighted average is happening not for expenditure, borrowings code. Step number 2, calculate the expenditure incurred on qualifying asset financed from general borrowings. Refer note below. Go to that note. The amount of expenditure on qualifying asset include only those expenditures that have resulted in payment of cash, transfer of assets, or assumption of interest-bearing liability. That means, if you call something as expenditure on qualifying asset, that is not just incurred, it should be paid also indirectly, saying payment of cash. Expenditures are reduced by any progress payments and grants received in connection with the asset. The average carrying amount of the asset during the period, including borrowing costs previously capitalized, is a reasonable approximation of the expenditure to which capitalization rate is applied in that period. That means step number 3, capitalization rate, whatever you are seeing now, this you have to apply on average expenditure, which is financed from general borrowings. And that average expenditure should consider progress payments, should consider grants. It should consider expenditure incurred in the current year. It should consider opening balance. Very important. Opening balance and including previously capitalized borrowing cost. Very important. Now you see, sir, because you are doing on opening balance also, our opening balance rate interest also, it is quite possible that the number what you get may be more than your actual borrowing cost incurred. Asal bank ke you may pay only 2,50,000. But this came to 2,61,600. Why is it coming like that, sir? I paid only 250. No, that's because this is computed not based on what you are paying, but based on what you have incurred on the qualifying asset. So it is quite possible that this is more than the actual borrowing cost incurred. In that case, you have to adjust this only to the extent of actual borrowing cost incurred. So 261,600 correct. But you never incurred that. When you never incurred that, how can you capitalize? It is not cost, no. So you should adjust only up to 2,50,000. Ignore that remaining portion. That's the last point. The borrowing cost capitalized shall not exceed the actual amount of BC incurred during that period. You imagine, sir, I considered actual borrowings only in step number 1 for the purpose of what? Determining capitalization rate. After that, I never bothered about how much borrowing is there. I was only looking on qualifying asset expenditure and I went on capitalizing. It is quite possible that whatever you are capitalizing as interest cost may exceed the actual borrowing cost what you are paying to the bank. How can you capitalize that extra? You cannot capitalize, you have to limit them. So, adini limit point. On this, application questions are there. Once you do that question, standard is over, sir. This is max in the peak. First year, if you have to capitalize, it's very simple, sir. Subsequent year, when you go, then this standard original color you will see. Sure, sir, take up the questions on this. 5 we have done. Move on to 6th one, very easy one, cheap one. Beta Limited has the following loans in place at the end of 31st March 20x2. Amounts are in thousands given. 18% bank loan, year beginning also it was there, year ending also it is there. Term loan also 3,000 outstanding throughout the year. Debentures not there at the beginning of the year, it's issued during the year. 2,000 means 20 lakhs. Then 14% debenture was issued to fund the construction of office building on 1st July 20x1. Stop there. When the purpose is very clearly spelled out, it becomes a specific borrowing. But the development activities has yet to be started. That means no borrowing cost capitalization will be there. Reason, though it's a specific borrowing, unless the work starts, commencement date is not triggered, nothing can be capitalized. On 1st April 20x1 year beginning, Beta Limited began the construction of a plant. See, the office building, his story is different. Then he is telling some other story now. He is constructing construction of a plant, which is a qualifying asset using the existing borrowings. Expenditure drawn down for construction was 5 lakh rupees on 1st April 20x1 and 25 lakh rupees is spent on 1st January 20x2. That's also. Calculate the borrowing cost that can be capitalized for the plant. You visualize in terms of your steps only, irrespective of how it's presented there. That will frame your thoughts correctly. What is step number 1? You have to identify one weighted average capitalization rate. Weighted average capitalization rate is based on borrowings, not on the basis of expenditures. How many borrowings are you having? 3. Out of that 3, last one debentures is a specific borrowing. Ignore that. Remaining 2 borrowings. That too, happily they are outstanding for throughout the year. So capitalization rate formula is what? Total interest cost 18% into 1,000, 180 plus 3,000 into 16%, 480, 480 divided by 1,000 into 12 by 12 plus 3,000 into 12 by 12 into 100 outside. Tell me the number. Step number 1, weighted average capitalization rate is ready, ma. Step number 2 is what? You have to work out average, or rather weighted average expenditure on qualifying asset. Weighted average expenditure on qualifying asset, how to work out? See, you incurred expenditure 2 times. First stock of 5 lakh rupees you spent on 1st April. So 12 by 12, 8. 25 lakhs you spent on 1st January, which is 3 by 12, 8. Tell me average expenditure on this. 25 lakhs into 3 by 12, 1 by 4, 6, 25, 11, 25. Huh? 11 lakh 25,000. This is step number 2. And then comes your step number 3. Borrowing cost capitalization on general borrowings. 11,25,000 into 16.50%. How much is that? 185,620. He did not perform the steps as such. What they have done is expenditure into borrowing rate directly they applied. That also you can do, this also you can do. See, he gave so many dates. He's asking identify commencement date. Limited is commencing a new construction project which is to be financed by borrowing. The key dates are as follows. 15th May 20X1, loan interest relating to project starts to be incurred. The indirectly borrowing is made on that date. 2nd June, technical site planning commences. Work is started. 19th June, expenditure on project also is incurred. 18th July, construction work actually commences. So what is required for us? Borrowing cost should be incurred, work should be in progress, expenditure should be incurred on qualifying asset. When all these 3 events are cumulatively met on one date, the first time when they meet, that is called as commencement date. So that date is going to be 19th June. In between 2-3 questions are there, they are good ones, but we'll solve it after doing other ones. Sir. Mathematically, some questions are there, we'll get rid of them first. Come to 14th one. CA inter question only, sir, but CA final exam also came. Important. Moon Limited begins construction on a new building on 1st January 2018. So your work started on that date. In addition, Moon obtained 1 lakh rupees to finance the construction of the building on 1st January 2018 at an annual interest rate of 10%. Wait there. Loan to finance construction of a building. That's enough for me. This is a specific borrowing. The company's other outstanding debt during 2018 consists of 2 loans, 6 lakhs and 8 lakh rupees with interest rates of 11% and 13% respectively. So these are general borrowings. Other outstanding debt. Expenditure that is made on the building project is 2 lakhs in January, April 3 lakhs, July 4 lakhs, December 1,20,000. Compute the cost to be capitalized including borrowing cost. Now if you see, nowhere the questions clearly specified what is their accounting year, the Jan to December, April to March. But one hint they gave, look at this. The company's outstanding debt during 18. When only 1 year is given like that, you must understand that that fellow's accounting year is calendar year and not financial year. So therefore, Jan to December is your current year, sir. Moreover, next missing figure in the question is when in January. January beginning, January middle, January ending. Nothing is given, that is your assumption now. Generally, if it is given like that, based on ICA answers, we assume that the expenditure is incurred at the beginning of each month. You can assume otherwise also, no problem. He's asking compute the cost to be capitalized, including the borrowing cost. So, tell me, sir, specific borrowing amount is how much? Rupees 1 lakh loan at the rate of 10% per annum. Right? 1 lakh, 10%, correct. So borrowing cost to be capitalized. One lakh into 10% for the full year. So this is one part of the story. Second part. Borrowing cost relating to general borrowings. 3 steps now frame your thinking. Step number 1, weighted average capitalization rate. Check out here. You have 2 loans, one 6 lakhs and one 8 lakhs loan. So on 6 lakhs loan, interest rate is 11%. On 8 lakh loan, interest rate is 13%, it seems. Nothing is given, it's outstanding throughout the year. Now, during 2018 means assume that throughout the year only it's outstanding. So 6 lakhs into 12 by 12 plus 8 lakh into 12 by 12 into 100, please. Yes, sir. Fast. 12 point. Exactly, yeah. Chiller is there. 1429 now. Okay, fine. 14 is better. Step 2. First January 18. How much did you spend? We have to answer. Time waste for us to go do back and forth. Tell me first the next expenditure. 1st April 3 lakhs. Not so fast. July. 1st July how much? 4 lakhs. Okay, so 31st December is your date of closing balance sheet date. In this, important point is only one, sir. If first 2 lakhs is there, no? In this, 1 lakh rupees is met out of specific borrowing. Since specific borrowing capitalization we have already done separately, you will ignore that 1 lakh rupees today. A question will not come and tell you, sir. So you took borrowing on 1st April, 1 lakh. On the same day, you spent 2 lakh rupees, and that borrowing is exclusively taken for the purpose of construction of this project only. So your expenditure is definitely funded out of specific borrowing. Suppose the question says, specific borrowing is not 1 lakh but 3 lakhs. Then what I would have done is, the entire 2 lakhs is out of specific borrowing. Out of this also, 1 lakh rupees is still out of specific borrowing, and general borrowing calculation will start from here. Should be very careful how to allot. Unless specific borrowing is totally utilized, don't start using general borrowing. Okay, so the remaining 1 lakh is financed by general borrowing. This and all, there is no specific borrowing. So these are all financed only out of general borrowings. So weighted average expenditure on qualifying asset. Incurred or financed with general borrowings is equal to 1 lakh into 12 by 12, 3 lakhs into 9 by 12, 4 lakhs into 6 by 12, plus 1,20,000 into 1 by 12. Total it up. 5 lakh? 5,35,000. Step 2 is done for us now. Finally, step 3. Borrowing cost capitalization due to general borrowings. 5,35,000 into something you told me rate 12.14. Check out ma. 64,949. That's also therefore total capitalization is equal to 2 lakhs plus 3 lakhs plus 4 lakhs plus 1,20,000. This is all the cost incurred on the asset plus borrowing cost capitalizations 10,000 plus 64,949. Final answer. Seven and 10, 10, 20, 1090 for a that fellow is asking total how much are you capitalizing to the cost. Question number 15, almost similar one but not same, again important. In fact 15th is a better question than 14th. You read the question, tell me where the difference will come. K Limited began construction of a new building at an estimated cost of 7 lakhs on 1st of April. To finance the construction of the building, it obtained a specific loan of 2 lakh rupees from a financial institution at an interest rate of 9% per annum. So this very clearly specific borrowing. There are two other outstanding loans, 7 lakhs, 9 lakhs, interest rates are given. The expenditure incurred on the construction was again April, August, October, Jan. 4 installments amount is incurred, but dates are not given specifically. We assume it's happening at the beginning of each year. The construction of the building was completed by 31st January 20x2. So current year lone construction is also completed. Wait there. That means this is your cessation date. In the last 2-3 examples, you never saw cessation. You are always assuming that the asset is still under construction by your balance sheet date. So went up to balance sheet date. For example, watch here. With what confidence we wrote 12 by 12 here? From 1st January to 31st December, borrowed funds is used for the purpose of construction of qualifying asset. For 9 months we used, for 6 months we used, for 1 month we used. Like that we measured all this. But imagine I tell you, the project is finished on 1st of December only. Then you have to count from 1st January to 1st December only. Once project is completed, beyond period, how can you capitalize? You cannot capitalize. Be careful there. Is similar what is happening? The project actually got completed on 31st of January. Following the provision of Ind As 23 borrowing cost, calculate the amount of interest to be capitalized and pass journal entry for capitalizing the cost. That is okay. Journal entry part last we'll see, but accounting part. One more twist in this is, apart from the date, this time he incurred specific borrowing of how much? 2 lakhs. When did you, what did you spend on very first day? 150A you spent. This is totally funded out of specific borrowing. But specific borrowing actually is not 150, it is 2 lakhs. So another 50,000 in this also specific borrowing is there to the extent of 50,000. Rest all are financed by general borrowings. So compared to previous sum is better by 2 things. Date law also there is a cutoff point beyond 31st January you can capitalize, and borrowing amount also. First specific borrowing you have to exhaust. Then only you should assume general borrowings existence. So which would mean question number 15. Borrowing cost on specific borrowings capitalized. How much specific borrowing did you take? 2 lakhs. What is the interest rate? 9 or 9%, correct. So please do the math. Wait there, into 10 by 12. Why 10 by 12? Sir, if you simply multiply with 9%, you are indirectly capitalizing the interest cost for the entire year. That is wrong. No, sir. Project got completed on 31st January. February and March you can't capitalize. Up to 31st of January only. The important, sir. In terms of 15, huh? 15,000. This anyway you will capitalize. Now coming to borrowing cost on general borrowings. Weighted average capitalization rate. Oh, you got two borrowings, sir, 7 lakhs and 9 lakhs. So on 7 lakhs, what is the interest rate given? 12%. Sir, e questions lo your borrowing is basically outstanding for entire year. So weighted average impact you are not understanding yet. When they're outstanding in the middle of the year or something, there you should be careful. He sums directly. If you do also answer, a big change won't come. Luckily, they are outstanding for entire year. Percentage 11.43. Okay, it's okay. 11.4375 is okay. Step 2. You have to incur. Have to work out weighted average expenditure. Let's do a timeline now. First April, how much did you spend? 1,50,000. Then next again, 1st August, how much? 2 lakhs. Next, 3,50,000. Finally, 1st January, 1 lakh. That's it, sir. Beyond that, don't go. Your accounting year may end on 31st March. Don't count up to that date. This is your cessation date. Game is over here only. No prizes for running further. So up to there only. So here what you have to catch. This is financed by specific borrowing. In this also 50,000 rupees. A remainder 1,50,000. General borrowing. This is funded by general borrowing. This is also funded by general borrowing. So expenditure correctly you should calculate. Weighted average expenditure on qualifying asset out of general borrowings. Let's start with 1,50,000. 1,50,000 on which date did we incur? 1st August. August, September, October, November, December, and January. How many months? 6 months. Plus 3,50,000. October, November, December, January. 4 months into 4 by 12. 1 lakh. 1st January only, no. So 1 by 12. Do. Final answer 2 lakhs. Okay. You say so. Step 3. Borrowing cost to be capitalized is equal to 2 lakhs into 22,875 over, sir, total borrowing cost capitalized is equal to, already here we got 15,000 plus 22,875. 37,875. That boy is asking write a journal entry also for that, for capitalizing. What will you write? Interest to loan anyway you would have written. So all the interest expense is recorded in interest account. Instead of transferring it to P&L account, you have to capitalize it to the cost of the asset. What is this asset? Building a plant. Who is he? Building. So whatever interest you computed, whatever interest you have paid to the bank, all that you would have included in interest account. Out of what you are incurring, this much should not go to P&L account. So that you are capitalizing it. That's all. Here one more small point, ma. Here you doing this is important. Don't forget this. But don't do that here. Step 3 lo 10 by 12 you should not do. Why? Expenditure is already time measured. Are you understanding, sir? Rate calculation ki, see there it was a single number, so I applied. Here some borrowing is used for 6 months, some borrowing is used for 4 months, some borrowing is used only for 1 month, like that. So I already consider the timing effect into E calculation. Again, you should not do 10 by 12 and all. That will be very innocently making a mistake. Careful. Small mistakes, sir, we do not know, but we will make. 16th one, MTP May 25 came. So read once. Old question only, cheap one. Still go through it. On 1st April 20x1, entity A contracted for the construction of building for rupees 22 lakhs. The land under the building is regarded as a separate asset and is not part of qualifying assets. The building was completed at the end of March 20x2, and during the period the following payments were made to the contractor. Wait there. Started on 1st April 20x1. Building got properly completed also by the end of March 30x2 or 20x2. So fine. Throughout there it is under construction. 22 lakhs is contracted price at the waste. Consider what all payments did you make. Some 2 lakhs you made, then 6 lakhs, then 12 lakhs, then 2 lakhs. Total you paid 22 lakhs. Okay, that's the cost of the building apparently. Okay, entity A's borrowing at the end of the year were as follows. What do you have? A 10% 4-year note with simple interest payable annually, which relates specifically to the project. That's all. Specific borrowing. Debt outstanding on 31st March amounted to 7 lakh rupees. 7 lakh rupees, fine. Interest of 65,000 was incurred on these borrowings during the year. So your borrowing cost is given as 65,000. Now, don't go and do this. 10% into 7 lakhs is 70,000 on my calculator. Why is it telling you 65,000? Sir, maybe there are some initial transaction costs which are adjusted into it. Maybe he applied EIR instead of coupon rate. You never know. Moreover, there is no rule that a borrowing is outstanding throughout the year. So for some reasons, if the question is telling you interest cost is 65,000, it is 65,000. Don't go and question the question. Continue. And interest income of 20,000 was earned on these funds while they were held in anticipation of payments. So idle funds you invested somewhere and you earned 20,000. So tell me, sir, what is the effective cost after capitalize now? 45,000. In any way, we'll capitalize. So A is done. Move on to B. A 12.5% 10-year note with simple interest payable annually, debt outstanding at the beginning of the year amounted to 1 lakh and remained unchanged during the year. This is general borrowing loss. Again, a 10% 10-year note with a simple interest payable annually, debt outstanding at the beginning of the year amounting to 15 lakhs, remain unchanged during the year. What amount of borrowing cost can be capitalized at the year end as per the relevant Ind As? How cheap, sir, this is? Tell me capitalization rate quickly. 1 lakh into 12.5%, 12,500 plus 15 lakhs into 10%, 1,50,000 divided by 16 lakhs into 100. 10.16. So this is your capitalization rate on general borrowings. Go to the first payment, sir. First payment, how much did you make? 2 lakhs. 2 lakhs is totally funded out of specific borrowing. How do you know? Because specific borrowing amount is how much? 7 lakhs. I spent only 2 lakhs. Next, come to next installment, sir. 600. 600 lo, sir, another 500 is funded out of specific borrowing. Remainder 100 only is funded out of general borrowings. These two are clearly funded out of general borrowings. Rest of the sum is normal, just like any other sum what we have discussed. No twist, nothing, very simple sum. This is the old question only, but again 2025 Melo MT it came, I just included that. Cheap sum only, sir, you can handle it. You told me something, it came to 11%. Why? That's because I only made a mistake here. Come here. You're right only. Here add 1 0, sir. Here correction is there. I mean, I'll have to update. It is printed as 1 lakh. No, make it 10 lakhs. So that will make it one more 0, and that will become 11%. Well, please take 24th question now. This is easy only. It's a good one. Harish Construction Company is constructing a huge building project consisting of 4 phases. It is expected that full building will be constructed over several years, but phase 1 and phase 2 of the building will be operational as soon as they are completed. The question is based on what, sir? Cessation of capitalization phase wise. Following is a detail of the work done on different phases of the building during the year. Phase 1, 2, 3, 4, amount is in lakhs. Cash expenditure given, building expenditure in given, total expenditure given. So all phases ka total expenditure put together is 221. Loan taken at the rate of 15% at the beginning of the year is 200 lakhs. On this you have to pay interest. Then he says, after taking substantial period of loan, after taking a substantial period of construction, at the mid of the current year, exactly 6 months, phase 1 and 2 have become operational. Fantastic, beautiful. Find out the total amount to be capitalized and expensed during the year. How easy? Sir, a loan is taken exclusively for the purpose of this particular construction only. Already 200 lakhs is there. Okay, so how you will do it is, this question is not about general borrowing, specific borrowing. It's about cessation and how much you can capitalize. Borrowing cost incurred is equal to 200 lakh into 15%, which is equal to 30 lakh. Sir, a borrowing cost is incurred on all the 4 phases. No? So, how much is related to phase 1, phase 2? How much is related to phase 2, phase 3, phase 4? So, relating to phase 1 and phase 2. How much is relating to phase 3 and 4? Now, why am I splitting like this? Because 3 and 4 are incomplete, sir. I have to capitalize. 1 and 2 are complete in the middle of the year. So, first half I should capitalize, second half I should expense it off. So, first how to split? For that reason only, that fellow gave you expenditures. 34 plus 64. How much is this? 98. 55 plus 68 is that. So, 34 plus 64 is to 55 plus 68. First process this. This is how much? 98 is to, how much is this? 126. 126, no. 123, yeah? Split J. Fast, fast, fast. Two decimals. 30.13.13.30. This one, sir? Of course, remaining, no? 16 now. 16 point. Tell me correctly. 13.3033. Yeah. Then why are you getting 67 then? Okay, that's okay. This stands capitalized. Whereas here, again you have to do a split. First 6 months, last 6 months. Half J answer. 13.3 by 2. So this one also is capitalized. That is also capitalized. This is expensed to PR. Correct only, yeah? Your faces are giving me a lot of doubts. Okay, 13 point, okay, that's okay. 6,65,159 point here relating to phase 1 and phase 2. Okay, fine. It's all same, sir, same thing. Sir, that fellow question he gave amount in lakhs. I solved in lakhs. Answer he printed full zeros. I'm not responsible for that. But it's okay. Probably your answer is right. Exam happily you do this, no problem. Sir, there are no rules for this also. You know, no. If you take full decimal, your number will be different at a point. Everybody knows. Or do one thing. Write 4 decimals. That's the only hedging you can do. 25. Please mark important, sir. It is one of a kind. It's a good question. LT Limited is in the process of constructing a building. The construction process is expected to take about 18 months from 1st January 20x1 to 30th June 20x2. Carefully watch, sir. 1st Jan 20x1 to 30th June 20x2 means, if you carefully visualize, that is spanning across 3 financial years. X0, X1, X1, X2, X2, X3. Total 3 financial years, 18 months is spread. Continue. The building meets the definition of qualifying asset, of course. Otherwise, why will we study? LT Limited incurs the following expenditure for the construction. 1st January 20x1, 5 crores. 30th June, 20 crores. 31st March 20x2, 20 crores. 30th June, again 5 crores. Some dates and all are given. Expenditures is given. On 1st July 20x1, LT Limited issued 10% redeemable debentures of rupees 50 crores. The proceeds from the debentures form part of the company's general borrowings, which it uses to finance the construction of qualifying asset, that is a building. That means this is not a specific borrowing, this is a general borrowing, but there is only one borrowing. If there is only one borrowing, I need not do any weighted average capitalization, right? No. If multiple borrowings are there, then formula and all. If there is only one borrowing, a one borrowing rate only will become your capitalization rate. Continue. LT Limited had no borrowings, either general or specific, before 1st of July. So before this date, you never had any borrowings. First time in your life, you borrowed only on 1st of July. How much money did you borrow, by the way? 50 crores. Above table, please count once. Continue. LT Limited incurred 25 crores of construction cost before obtaining general borrowings on 1st of July 20x1, that is identified as pre-borrowing expenditure, and 25 crores after obtaining the general borrowings. See, that is visible, no? You can see the table also. 1st January you spent 5 crores, 30th June you spent 20 crores, total you spent 25 crores by 30th June 20x1, but borrowing itself is raised on which date? 1st of July 20x1. So before borrowing only you already spent some money. He's asking for each of the financial years ending on 31st March X1, X2, X3, calculate the borrowing cost that LT Limited is permitted to capitalize as a part of the building cost. Let's do. It's a good question, sir. Very good question, actually. 25. For financial year ending 31st March 20x1. Here, sir, expenditure on qualifying asset. 1st January 20x1, you spent 5 crores. Borrowing cost to be capitalized is equal to nil since there were no borrowings. Next. For a financial year ending 31st March 20x2, sir, in X2 obviously you incurred some expenditures and all. Capitalization rate is equal to 10%. So the question sounds like a specific borrowing. It is not. It is still a general borrowing only because the question said so. Simple. One second, sir. Let me check it. Okay. I'm just checking his presentation. If a better presentation is possible. Step number 1 is over. Step number 2 is what? We have to work out weighted average expenditure on qualifying asset. Just keep only one thing in your mind, sir. Borrowing date is 1st of July 20x1. Year starts from which date? 1st April 20x1 to 31st March. But April, May, June, asal borrowing a not there. When borrowing a not there, you cannot capitalize anything because commencement date ka definition will fail. Commencement date means what? Borrowing cost should be incurred. Borrowing cost is incurred only on 1st of July. So therefore, borrowing costs are incurred only from 1st of July 20x1. Therefore, 1st July 20x1 is our commencement date. The important point. Next. Opening balance of qualifying asset, how much is that? 5 crores. Here you write time weight and product. Next. Expenditure incurred on current yearly incurred 2 expenditures, sir. One is 20, another one is also 20. Expenditure incurred on 30th of June 20x1, and then expenditure incurred amounts are 20 crores, 20 crores. Now, if 5 crores have to give how much weight? It's outstanding throughout the year. Expenditures incurred on the project throughout the year, but borrowing itself came on 1st of July. So I have to consider a time weight of only 9/12. This also same 9/12. Whereas this one is incurred on the last day. So I have to consider 0/12. Multiply. I thought of writing like a formula, but this way we can explain more clearly. You will have your doubts. I'll explain that. First you write 3.75. This is in term 15 now. Is 0. So total is 18.75 crore. So this is your now come to the main point of discussion. You will have confusion, or ideally you should have confusion only on one point. What is that is? Sir, borrowing itself came on 1st of July. How can you capitalize interest for expenditures incurred before 1st of July? For that, the answer is general borrowings, sir. Asal general borrowings lo you can't prove which rupee is used where. And our standard assumes that whatever borrowing you are having, that is entirely invested on qualifying asset also. And the capitalization rate is something you have to apply on average expenditure throughout the year. Average expenditure cut definition is given in the standard. What is the definition given in the standard for average expenditure? Opening balance, including already capitalized borrowing cost, plus expenditure incurred during the year, minus any progress payment, minus any government grant, e weighted average number where you have to apply. It is not on expenditure incurred. Do you know, sir, earlier when we were solving questions also, even though when that fellow wrote answers directly on expenditures incurred, why I asked you to follow steps everywhere, and I was following step 1, step 2, step 3, even though the question directly did borrowing cost ka capitalization is, number will be same anyway, but I was trying to put a thought in your mind that step number 2 lo average expenditure is what I want, not what you actually incurred. On that average expenditure, borrowing rate will be applied. Whether a borrowed fund is used in that or not, really nobody can determine. Sir, forget about the current sum. But the sum is there, sir. Question number 6. Already borrowing is there. Year beginning lo is there, year ending lo is there. During the year, you started construction of a plant. What is the guarantee that a borrowed fund is used in this plant? What guarantee is there? Our money already raised for some other purpose. Our money might have been used in the plant, might not have been used in the plant. I do not know. If you can prove it, no, sir, it becomes a specific borrowing. You can't prove it. That's the whole point. So general borrowing, anyway, you can't prove it. So what the standard says is, throughout the year, what is the average expenditure that is incurred on, not spent, incurred? That means including opening balance also. That is the reason we are doing this. In this, opening balance also average it, current year expenditure also average it, here also average it. So there is no one-to-one relation between amount raised as borrowing and amount spent. But for your comfort purposes, a question how they framed your borrowing expenditure, your capital expenditure on the project is exactly 50 crores, which is matching with the amount what you have borrowed. 50 crore. This also is 50 crore. Indirectly, E particular borrowing is used for this project only. And he is not saying specific borrowing. Very clearly, he is telling that it is a general borrowing. You know why is he not telling specific borrowing? If he tells specific borrowing, life becomes very simple. Specific borrowing rule is what, sir? From the date when you are incurring borrowing, from there only. Average expenditure concept and all will not work there. That is a very straightforward answer. Just to complicate it, they just made one thing. Instead of specific, they made it as general borrowing. Some altogether went to a next level. Here you should understand that step number 2, I want average expenditure throughout the year, including opening balance. Our point you have to apply here. So now borrowing cost to be capitalized will be equal to $18.75 crores into, there is only one rate, no 10%, which is equal to 1.875 crores. Don't do any weighting here. 10 by 12, 9 by 12 and all, you should not do that. All that is already done while computing 18.75 only. Interest calculation, no, don't do. So tell me, sir, what is the carrying amount of the asset now? $5 plus 20 plus 20 plus 1.875. How much more? 45, 46 or 46.875 crores. Sir, why are you computing the carrying amount? Nobody asked you, but next year ka borrowing cost capitalization is done on opening balance. Again, you have to start with 46.875 as your starting point. So the financial year ending X2 is over. Next. For financial year ending 31st March X3. During the year, X2. Opening balance. The important 46.875. In this already capitalized borrowing cost is also included and it should be there. And then 30th June project got completed only. How do you know project got completed? Because he said the project construction will take about 18 months from 1st January to 30th June. So 30th June the project got completed. So on this date onwards, no further capitalization. But on this date you spent expenditure also. Expenditure incurred rupees 5 crores. So you can capitalize only for a period of 3 months. So weighted average expenditure on qualifying asset is 46.875 crore, or else we have to change the format. Same format I'll continue what I used. Opening balance 46.875 crores. Time weight 3/12 product. Please multiply and tell me. 11.72. Okay. Expenditure incurred 5 crores. For this weight is 0/12. So 0. $11.72 into 10%. How much is this? 1. So on this date, construction is complete. That is your answer, sir. It's a good question actually compared to other questions. This is one question which is unusual. For doing this question, you should know the concept of opening balance. You should know that general borrowings and the expenditure cannot be correlated. Number 2, you should also know that rate you have to apply on average expenditure, not on actually what you incurred only. Actually incurred anyway will consider. Opening also you have to consider. And general borrowings, you can't link the source and the application. If you can link, it becomes a specific borrowing. Some is actually, it sounds like a very clear specific borrowing, but just to complicate the story only, he made it general borrowings. You see, everything is matching, number matching, all that is there is only one borrowing. It's all perfectly sounds like a specific borrowing taken for a project which was started with own funds. If they ask like that, things will become easy. So they complicated it, put it in RTP. Till now never came. It's a good question. Also similar question, sir. Go through it. But much more easier one. X Limited commenced the construction of a plant from 1st of September 20X1, estimated to cost 10 crores. For this purpose, X Limited has not raised any specific borrowing. See, wantedly he is saying there is no specific borrowing just to complicate the stuff. Rather, it intends to use general borrowings which have a weighted average cost of 11%. So your step number 1 capitalization rate, they only have given as 11%. Total borrowing cost incurred during the period 1st September 20X1 to 31st March 20X2 is 0.5 crores, 0.5 crores. This is actual borrowing cost. You tell me, sir, actual borrowing cost on general borrowings is relevant or irrelevant? Relevant or no? Actual borrowing cost incurred on general borrowings. How? We will not capitalize this, no sir. What we will capitalize, rate you will take, which is 11%. That you apply on expenditure on the qualifying asset. Some number comes. Our number is going to be capitalized. How much you actually spent is irrelevant for me, to be honest. But why they are giving you is, imagine sir, you did weighted average expenditure. On that you applied that 11%. You got 0.55. According to our calculation, we say that you should capitalize an amount of 0.55. But actual cost incurred how much? 0.5. So you should limit to only 0.5. Your borrowing cost capital should not exceed the actual interest paid to the bank, no. So for that purpose only that is relevant. Otherwise that is useless for you. That is as a check. Okay, let's read. The question is not on all that. It's something else. Read now. September, October, November, December, January, February, March. So 7 months ka data he is giving. What data he gave? Cost of construction accrued given. Second table, second column, he is giving cash flow paid at the beginning of each month. What's the difference between accrued and paid? Accrued means how much work we have done. Based on that, how much we have to pay, whether or not you have paid. Second column obviously is cash outflow, irrespective of whether you obtained the work or not, how much you paid at the second column. Generally speaking, they both need not match. No, what you have spent versus how much work you have gotten done, they both need not match. But overall, they may match eventually, because whatever you have to pay, that only you will pay. But timing gap can come. That fellow's question is this. Based on above information, discuss the treatment of borrowing cost as per cash outflow basis and as per accrual basis. Now you observe carefully. What is step number 1 in general borrowings? Capitalization rate. That fellow already gave you. You need not work out. What is step 2? Weighted average expenditure on qualifying asset. Now a weighted average expenditure will you work out on the basis of accrual, that is incurred, paid. We say do both and tell me the impact of it. That means you will take weights based on this, one answer. You take weights based on this, another answer. Definitely answers will not match. Why? Time weights are different. No. Here more expenditure incurred here only. So more amount will be capitalized in this. Anyway. And then he says, between these two also, suggest the appropriate amount of interest that should be capitalized to the cost of the plant. Anyway, sir. 1st September into 31st March. Sir, all of you will do this calculation on your own calculator. Start now. Take only this. September, October, November, December, January, February, March. 7 months wait. Into 7 by 12. Start doing 1 by 1. 1.5 into 7 by 12. M plus. For this 6 by 12. This into 5 by 12. M plus. This into 4 by 12. M plus. This into 3 by 12. M plus. Also into 2 by 12 M plus, into 1 by 12 M plus. Once you do all M plus, do MRC and tell me the final number. Achieve some, sir. They are unnecessarily glorifying it. There nothing is there in that. మీరు step 2 చేస్తున్నారు సార్, అర్థం చేసుకోండి what you are doing. Step 2 ka number. Don't multiply with 11% yet. Just step 2 ka total tell me. MRC చేసండి. See, he did all that stupid calculation here. He got 2.74. You also got that only, roughly 73. That's okay. I accept now. 0.01 crore. Chiller amount for your range. Come here. This into 7 by 12. This into 6 by 12. This into 5 by 12. This into 3 by 12. Careful. This into 1 by 12. Don't do silly mistakes by doing 2 by 12 $1, 3 by 12. One month or nothing is incurred. Silly mistakes, so don't lose marks. Tell me here also amount, please. This one is correct. Sir, step 1, 11%. Step 2, in one alternative it is 2.74. In another alternative it is 4.02. Obviously, if I apply 11% on this, answers will not be same, no. So he says, first alternative you are getting 0.3, second alternative you are getting something around 0.44. He asked us to work out both, I worked out both. Now between these two, which one is right? Why? Incurred is first one, no? Then you should not say incurred, paid. Second one is more appropriate than first one. Although, sir, honestly speaking, first one ki second one ki big difference should not come in reality. But you might have incurred now, but you might have paid later. Or you might have paid a huge advance now, but expenditure you are incurring over a period, but already amount is paid. So because of that, differences can come like this. But either way, whether it is 0.3, the first method, or 0.44, the second alternative, in both the cases, the borrowing cost to be capitalized is not exceeding the actual borrowing cost of 0.5. So that problem I do not have. But between these two, which one is more correct? Conceptually. Come here, please read. The amount of expenditure on qualifying asset include only those expenditures that have resulted in payment of cash. Important. Standard ka verbatim as it is. If somebody reads that, can only identify that. Otherwise, how will you justify? Expenditure means ultimately you have to pay in cash. If you have not paid, on that payable, interest bearing should be there. That's a question clearly tells you. Why book everything is captured, sir? The original standard ka language. Payment of cash condition is there. And therefore, not only is also telling, as per Ind As 23, expenditure on qualifying asset include only those expenditures that have resulted in payment of cash. Accordingly, in the present case, interest should be computed on the basis of cash flows rather than on the basis of costs incurred. Therefore, the amount of interest eligible for capitalization would be 0.44. And then he tells you the amount of borrowing cost capitalized should not exceed the total borrowing cost incurred during the period. That anyway it's not incurring, no, so problem not there. Suppose instead of 0.44, had you gotten 0.54, then you will limit it only to the extent of 0.50. Because max actual cost incurred at 0.5 with how can you capitalize 0.5 for borrowing cost? No, you should incur, then only it becomes cost. See, good question. Simple calculations. See, all that is there is general borrowing cost up, sir. A step 1, 2, 3 correctly you should know how to execute. What is the intention of the standard behind that? When you say expenditure, it must be paid in cash. Just because you know that answer that this is correct, directly you should not write this. He asked both. Both you work out. Then suggest this, which one is better. This cheap question came in the exam. For 7. Read. Zira Limited obtained a term loan of 1080 lakhs for complete renovation and modernization of its factory on 1st April 2021. Plant and machinery was acquired under the modernization scheme and installation was completed on 30th April 2022. Stop there. Slowly stop there. When did you take loan, Babu? 1st April 2021. Normally, if you tell me this line, that plant and machinery is acquired, I will say it is not a qualifying asset. Why? And plant and machinery already acquired means it is ready for usage only. How is he covering up? Installation was completed on 30th April 2022, after 1 year, 1 month. Therefore, plant and machinery may become qualifying asset. An expenditure of 9-10 lakhs was incurred on installation of plant and machinery, and the balance loan was used for working capital purposes. Very nice. So 1080 lakhs low. 9-10 lakhs is used for plant and machinery, which is a qualifying asset. That is ready-made asset, but not ready for our intended usage. Therefore, it becomes a qualifying asset. A remaining amount, whatever is there, 9170, 170 is used for working capital purposes, it seems. Fine. Management of Zira Limited considers a 12 months period a substantial period of time to get ready the asset for its intended usage. Of course, our plant and machinery happily took more than 12 months. The company paid a total interest of 94.4 lakhs during the financial year on the above loan. Wait there, sir. This is 94.40 lakhs interest. Please tell me the rate, ma. 94.4 divided by 1080. Got it? 8 point. That into 9-10 lakhs. I mean 9-10 lakhs into that percentage, please. 94.4 divided by 1080 into 100. Percentage 8 point, how much do you tell me, sir? 8.7 exactly. 8.74% apply on 9-10 lakhs, please. 79 point. 5 3, this will be capitalized, sir. What about the second one? Working capital purposes, if you use borrowing, the qualifying asset, sir. PRL 170 lakhs into 8.74%. How much is this? Remainder 14.6. This will be transferred to PRL. How cheap? Next. Will your solution be different if the whole process of renovation and modernization gets completed by 31st December only? If everything completed by 31st December only, it is not exceeding 12 months. According to the question, 12 months is substantial period. If it is completed within 12 months, then it is not a qualifying asset in the first place. Entire 94.4 will go to PR. Tell me, sir. Is worth 7 marks, sir? People became CS because of this question. You need not even come to CA final to get this. Interfellow will do up happily. Come here. This actually is a good question, sir. I thought it would come last year only. It did not come. It's a nice question. Okay. The question is based on suspension and cessation ka concept. Conceptually, and it's a good one. Tell me, sir, when will you suspend capitalization? Active development is interrupted for extended period of time. Now, what is extended period of time? That do not know, we do not know. That depends on what? Facts and circumstances of each case. Imagine, sir, if I agree to construct a building for you, staying in Hyderabad, I say I'll finish off the building project within a period of, let's say, 12 months. Does it really mean that in the next 12 months, every day work will happen? Work likely to happen, but may not happen because of some rain, some strike, some band, Sunday holiday, Labor Day. Some days people do not work. You know, sir, in this place, people do not work on Amavasya Day. No labor person will come and work for you on Amavasya Day. If it is a no moon day, nobody will come. Normal employees will come. Outside labor, contract labor will not work on that day. It's a deemed holiday for them. They don't come. Now you see, in these 12 months, interruptions will be there, but those interruptions are small interruptions which are considered normal. Okay. Imagine, sir, rain happened. Because of that, 15 days work got halted. There is no surprise for us. That is normal. Same story, sir. I cut here. I put it in somewhere in a very rainy area. For example, where almost throughout the year it will be raining. There, work almost gets halted 15 days in every 2 months. Every 2 months, half month work stops. That kind of thing, if it happens in Hyderabad, is abnormal. But in that area, they are normal. I never commit 12 months there. I commit 2 years. Work same, but more interruptions will happen. And whenever interruptions happen, you should not say extended period of time and all. That is normal for them. E background, if you know, then only question you can handle. Go through it. PQR Limited is engaged in tourism business in India. The company has planned to construct a holiday resort at Shimla. Nice. The cost of the project has been met out of borrowed funds of 100 lakhs at a rate of 12% per annum. Fine. 40 lakh rupees were disbursed on 1st April 20x2 and the balance 60 lakhs was disbursed on 1st June 20x2. The site planning commenced on 1st June 20x2 since the chief engineer of the project was on medical leave. Anyway, the point what he's trying to say is loan amount you took 40 lakhs on 1st April only, 60 lakhs is delivered to on 1st June, but work actually commenced only on 1st June. And then the company commenced physical construction on 1st of July 20x2. Okay. Physical construction is not the criteria. What is the criteria? Borrowing cost should be incurred, work should be commenced, expenditure on qualifying asset should be incurred. Okay, move on. Physical construction 1st July and the work of construction continued till 30th September 20x2. So how many months? June, July, August, September. 4 months it went on. And thereafter, construction activities stopped due to landslide on the road, which leads to construction site. Sir, if I have to do construction, all employees, material, men, labor, everything has to be transported till the construction site. No, a road blockage came because of landslide. You know what is landslide? Recently, Kerala happened. No? Entire land on which houses are constructed, entire land moved off. That kind of thing. Shimlas are common. Why? That's all snow. Little temperature it increases, everything will start melting there. Continue. The road blockages have been cleared by the government machinery by 31st December 20x2. So interruption is for how many months? October, November, December. And construction activities have resumed on 1st of January and completed on 28th February. 2 months further work has happened. The date of opening has been scheduled for 1st of March 20x3, but unfortunately, the district administration gave permission for opening on 16th March 20x3 due to lack of safety measures like fire extinguishers which had not been installed by them. So, even though you thought that you will open the your holiday resort from 1st of March, but permission you obtained only from 16th of March. Okay, so which one is your cessation date now? Work is completed technically on 1st March. 16th March ki why that fellow did not give me permission is fire extinguishers I did not install. So legally I can use it only from 16th March. But rest all work is completed on 1st March only. So what is the cessation date? Substantially all the activities are complete or not, an assessment you have to do now. Let's see. Determine the amount of borrowing cost to be capitalized towards construction of the resort when. First case. Landslide is not common. Please underline that. Landslide is not common in Shimla. Meaning what, sir? That what it indicates is a 3 months interruption is abnormal for them. Since it is abnormal, the borrowing cost what you incurred during the 3 months interruption period is there, no? That should be suspended. Sir, are you understanding on what basis you are getting to a conclusion there? This is one part. Second part, delay in approval from district administration authority is a minor admin work left over. Since it is a minor admin work left over, it indicates that substantially all activities are completed on which date? 1st of March. So 1st March will become your cessation date. Now take your calculator out of it. Sir, from the bank, even though you obtained 40 lakh rupees on 1st of April, I can't consider interest capitalization for the months of April, May and April, May can't consider because work did not start. Work started on which date? Site planning work commenced on which date, sir? 1st June 20x2. Physical construction started on 1st of July. Now, what about expenditure spent? That the question did not specify. Borrowing cost is incurred, I know. Work is also in progress from 1st June, I know. Amount from which date did you spend? Data is not there. But physical construction started from 1st of July. Question is silent, sir. Let's see the answer, what assumption they have done. Exactly what I thought only. 1st June only. So when site planning is commenced, that fellow assumed that some amount is also spent on the same day. So take your 100 lakhs, sir. 100 lakhs into 12% interest into how many months? June, July, August, September. Only 4 months. 4 by 12. Some number will come. Then Work got halted, abnormal period, 3 months. Then again work got resumed. On which date? 1st of January. Again 1st January, 100 lakh into 12% into Jan and Feb. 2 by 2. How much is 6 lakhs? Sir? That's all you can calculate. 6 lakh rupees is your answer, sir. See, e point you read once means I told you this, but safe side. Commencement of capitalization came. Of course, expenditure should be incurred on the qualifying asset. Activity should be going on, and that activity need not be physical construction. The activities relating to qualifying assets include technical admin work prior to commencement of physical construction. And the physical construction part is a trap. 1st July, sir, don't take that as a trap. Site planning is part of activities necessary to prepare the asset for the intended use. I was only worried for one point that he did not tell when you spent money. Of course, site planning also money is required. No, sir, I have to pay money to somebody. No, so he implied that on the date only expenditure is also spent 1st June itself. But physical work started on 1st of July. Okay, the first case answer. Come to second scenario. He says landslide is common in Shimla. If landslide is common in Shimla, it is like a rain of a week or 2 weeks in Hyderabad. So do I need to suspend as normal? As normal. So I need not do any suspension. So I have to continue capitalization from 1st of June till the completion. No, a completion date key, he's changing the conditions. He says delay in approval from district admin office is a major work left over. Okay, fine. Then up to 16th of March. Earlier I stopped up to 1st March or 20th February. Now I'll go up to another 15 days also extra I have to take. How many months is that? June, July, August, September, October, November, December, Feb, March to half. So 8.5. 8.5 or 9? 9.5. 8. June, July, August, September, October, November, December, January, February, and half. 9.5 months. You're right, sir. So which means 100 lakh into 12%. Please check the answer, sir. 9.5 lakhs. What am I checking? At 12%, 12 months, what is visible there? No. Simple question, sir. But conceptually, you should be very, very strong. So easy. Or this question also makes your concept strong rather. Both ways. Okay. Answer the small question, sir. 1 or 2 questions are there. With that, we're done with this standard. Don't take light that it's the borrowing cost standard. You're seeing no, sir. 7 marks, 6 marks questions are coming. Answer this. Yeah. Sir, you made a 10% loan, 100 lakhs. What you did is, 100 lakhs you gave it as advance to P Limited or else let's say M Limited for construction of aircraft. Now this M Limited fellow says 4 years is required. To build a aircraft. Simple, sir. So you tell me, aircraft is a qualifying asset? Yes or no? Very clearly, yes. On this 100 lakhs, whatever 10% interest I am incurring, should I capitalize it or not? Sir. Can I capitalize it or not? But to capitalize it, commencement date should be there. Commencement date means first time when all the 3 conditions are satisfied. What are the three conditions? Expenditure on qualifying asset to be incurred. Okay, we incurred from our point of view incurred. Borrowing cost anyway we are incurred. What is the third one? Activities to prepare the asset for its intended usage or sale should be in progress. Our work who has to do? Me, I am limited. Mara manufacturer is doing or not, I have to go and check. No, go and check. If work is happening, then definitely you capitalize it. Work is not happening, don't capitalize it. Sir, but that fellow is supposed to do work. No, sir, that is his mistake. No, irrelevant, sir. It's not about whose mistake it is. It is about work is happening or not. If work is not happening, you went there. That fellow is building a beautiful yellow color aircraft. Sir, I ordered blue. No, he says, who said it is for you? Sir, but I paid 100 lakhs advance 1 year ago. What did I tell you? 4 years. Come after 4 years and ask. Your blue color aircraft is ready. Is it TDP? Your party aircraft will come after 4 years. Fine, you can't argue with him, no sir. You gave him a time of 4 years. When he will do, how much he will do, that is his wish. You don't have a right to question that now. Fine. But from an accounting angle, his standard is very clear. Work should be in progress. Is the work started? That fellow did not even buy paint up also to paint your blue color. So third point royally failed. Can't capitalize. His mistake or my mistake are irrelevant, sir. Irrelevant. Very clear. But if the work is in progress, definitely you will capitalize. Definitely you will capitalize. If work is in progress, otherwise you can't capitalize. Based on this, one question they created. Hey, where are you? You are only 10th one, sir. Please come here. Marine Transport, carefully read the dates. One short answer should be over. Read. Marine Transport Limited ordered 3 ships for its fleet on 1st April 2020. It pays a down payment of 25% of the contract value of each of the ship out of long-term borrowings from a scheduled bank. Okay. For 3 ships, you have given advance 25% each on 1/4/2020. The delivery has to commence from the financial year 20x7. How many years? 7 years. There is no argument now. It's a qualifying asset. On 1st March 20x2. Okay. The shipbuilder informs that it has commenced production of one ship. Okay. There is no progress on the other 2 ships. Marine Transport Limited prepares its financial statements on financial year basis. But the question is it permissible for Marine Transport Limited to capitalize any borrowing costs for the years X1 and X2? Okay, sir. When did you give advance? 1st April 2020. Our year will end on which date? 31st March X1. By 31st March X1, one ship ka work also did not start. So commencement date is not yet met for you. So first year you can't capitalize anything. Second year, sir, which is starting on 1st April 20X1, ending on 31st March X2. During this year also, first 11 months no work started. Nothing can be capitalized for the first 11 months. But in the last month, one ship ka work started. So the borrowing cost what you incurred for one ship for 1 month, that can be capitalized. Sir, how will I know whether he is working? Sir, after paying so many crores, don't you know what is the status of the worker? He will definitely inform. No, based on that, he will do. Ultimately, answer is this. During the financial year ended 31st March X2, borrowing cost relating to one ship whose construction has commenced on 1st March will be capitalized from 1st March to 31st March. Everything else should be expensed off to PRL. think all these are cheap questions, sir. One good consolidation question is there. That fellow won't leave you wherever you go. Come to 23. Last question, sir. Read carefully. Important question only. In a group with a parent company P, there are three subsidiaries with the following businesses. A. Real estate company. B. Construction company. C. Finance company. P is the parent, sir. A, B, C are subsidiaries. Parent company has no operating activity on its own. Okay. But performs management functions for its subsidiaries. Okay. Financing activities and cash management in the group are coordinated centrally. So who should do what, from where I should raise money, all that parent will plan. Financing company is a vehicle used by the group solely for raising finance. Okay. All entities in the group prepare Ind As financial statements. Of course, if one fellow gets touched with Ind As, everybody else. The following information is relevant for the current reporting period 20x1, x2. One second, sir. Also question number 23. Each company ki story he is telling, sir. You read the story and tell me how much borrowing cost can we capitalize for all the three subsidiaries and parent individually. Overall consolidated last. First one. Real estate company made a borrowing of rupees 10 lakhs with an interest rate of 7% per annum. So interest rate is 7%. 70,000 amount. Expenditure on qualifying asset during the period amounted to 15 lakh 40,000. Fine. All construction works are performed by the construction company. Amounts invoiced to a real estate company include 10% profit margin. Meaning, if 15 lakh 40,000 whatever a real estate company has incurred qualifying asset, no, our work is done by construction company, the next subsidiary. That fellow charged 10% profit margin. A 10% is a kind of unrealized profit which you have to eliminate. But unrealized profit elimination will happen in, tell me, sir, standalone financial, sir, consolidation. Consolidation. As far as a real estate company alone is concerned, what is their cost of building? 15 lakh 40,000. So, in real estate company, borrowing cost incurred is equal to 10 lakhs into 7%, which is equal to 70,000. This is totally capitalized to qualifying asset. Real estate company is over, sir. Next. Construction company. There is nothing to discuss also. Why? No borrowings during the period. Once you do not have any borrowing, why will I capitalize anything to you? Nothing will be capitalized. However, you finance 10 lakhs of the expenditure on qualifying assets, include using its own cash resources. Fine. So, summary point of view, sir, construction company. Borrowing cost incurred is nil. So, nothing to capitalize. Move on. Finance company. This fellow raised 20 lakh rupees at 7% per annum externally and issued a loan to parent company for general corporate purposes at the rate of 8%. You raised a loan, our money again you gave it as a loan. You did not spend money on any qualifying asset. So finance company borrowing cost incurred. How much borrowing cost incurred? 20 lakhs into, at what rate did they borrow? 7%. Not relating to a qualifying asset. Therefore, this is charged off to PRL. Next one. Parent company. used loan from the finance company to acquire a new subsidiary. So he also borrowed money, 20 lakh rupees at the rate of 7%, finance company raised, and they gave loan to parent company. So parent company also took a loan from finance company, 20 lakhs into 8%, but not for qualifying asset, to buy another subsidiary. No qualifying assets apart from those in real estate company and construction company. Where is real estate company? Okay, that one. Construction company, there is a qualifying asset, but it is financed out of their own resources. Fine. Parent company did not issue loans to any other entities during the period. Okay, wait, this. Based on this parent company accounting also we can do. Parent company in their SFS. Borrowing cost incurred 20 lakhs into 8%, 1,60,000. Again, answer is same, sir. This is not relating to qualifying asset. Therefore, charged off to PR. Only one thing is missing for you now. What is the amount of borrowing cost eligible for capitalization in the financial statements of each of the four entities for the current reporting period? Each of the four entities ke reporting ki answer is this, over. But a fourth entity parent is there, no? For that fellow you have to do SFS also, CFS also. SFS we have done, CFS you did not do. Now, last and final analysis. With this, sum is over. Parent company, consolidated financial statements. Sir, consolidated financial statements, so your thinking should be from group point of view. So, just for understanding, I am drafting this. Tell me, sir, all the loans, all the qualifying assets, everything you club, and then we'll decide how much can we capitalize. Go to each company ka data, read. Any outside borrowing is there? First company lo real estate company ka borrowing is there? 10 lakhs with a rate of 7%. 7% borrowing, 10 lakh rupees. Move on. Qualifying asset ka expenditure is also there. But don't take 15,40,000. Why should I not take 15,40,000? A 15,40,000 intercompany profit is there unrealized that you have to eliminate. How much profit did they charge? 10% is 110. So this is 100. How much is that? 14 lakhs. Huh? Move on. Sir, the first one, sir, real estate is a construction company. Borrowing is not there, but qualifying expenditure is there to the extent of 10 lakhs. Sir, this is of real estate company. This is of second company is of construction company. This is also of real estate. Group point of view, you should see group point of view, means entire entity, entire thing is treated as a single entity. Just for identification, I am writing. Construction company, finance company, borrowing is there, sir. 7% borrowing, 20 lakhs. Finance company. That fellow gave loan to parent company. Loan given is there. Parent books loan taken is there. Of intercompany owings cancelled. That's not a qualifying asset. There's no point of writing it. Parent company loan, neither there is a borrowing, but there's an intercompany borrowing. Outside borrowing is not there. Qualifying asset is also not there. Now, visualize from group point of view. From group point of view, cost of qualifying assets is equal to 14 lakhs plus 10 lakhs, which is equal to 24 lakhs. Again, from group point of view, capitalization rate is equal to 7%. How do you know it is 7%? All there are two borrowings, sir. Both the borrowings ka rate is same only. No, why should I do average and all? Anyway, it will be 7% only. And group borrowings are 30 lakhs. This is correct. External borrowings are 30 lakhs. Therefore, 30 lakhs, how did you get 10 lakhs plus 20 lakh? Okay. Borrowing cost to be capitalized. In consolidated financial statements is equal to 24 lakhs into 7%. Do it, sir. 1680, yeah? Sorry, 1,60,000. That's all. This is the final answer. Here, where people will get confused is, borrowing is made by real estate company, expenditure is spent by some other company. How can you do overall and capitalize? See, ma'am, consolidated balance sheet low, you have to feel as if this entire thing is a single entity. And general borrowings ki link will not be there with qualifying asset. Borrowing is there or not, you see. Qualifying asset is there or not, you see. Borrowing general borrowings ka rate to just capitalize it. Whether the money is really spent in this or not, you can't prove it. General borrowings. So it is just for identification I wrote from where I copied that. But overall group point of view, 30 lakhs general borrowings is there, 24 lakhs qualifying asset is there. Happily capitalize it off. That's all. Money, whether it is really used or not, you can't prove it. General borrowing does not work that way. Specific borrowing works that way, not general borrowing. So the answer is 1,68,000. That's what they should also do. Where is it? Here. So guys, that is the end of your Ind As 23. So we'll start with Ind As 34, interim financial reporting. Sir, very, very easy standard. Very few points are there to remember. So this is not at all a very difficult standard, very simple standard. It's little dry here and there, but as such, overall a very simple standard. Now, exam point of view, how important it is, it's difficult to say, sir. There have been some 5 or 6 attempts consecutively where question never came. Only for 2 exams, continuously the questions came. So it is unpredictable chapter. So it can't be identified as least important, mediocre. It's not top class, but you may say B category, that kind of item. Anyway, coming to the chapter interim financial report, as the name itself suggests, the term interim means something other than full year. And when you say interim financial statements, it means financial statements for a period less than 12 months. They are supposed to be understood as interim financial statements. Now, important point you have to catch here is Ind As 34 does not ask you to prepare interim financial statements. Understand this. That means, suppose, sir, there is an entity who follows April to March model, accounting year. A company voluntarily, what it feels is, in a span of 1 year, once only if I am reporting to my shareholders, within 1 year, so many things can change. Revenues can drastically fall down also, it can rise also. So many asset capitalizations might have happened. Some new acquisitions might have happened. I might have acquired some other company. Some other company might have acquired us. So the frequency of financial statement reporting, updation of information to the interested parties, shareholders and all, should be happening on a more frequent basis. So a company decided that we will do half-yearly financial statements. When you do half-yearly financial statements, what will happen is, a particular example, sir, from 1st April to 30th September, you will prepare financial statements. Usually second half nobody prepares. Why? By the second half ending, year also ends. No? So anyway, annual financial statements only people present. But for the first half, a company may voluntarily choose to prepare financial statements. So these are financial statements for 6 months period. A company can voluntarily choose to prepare. But if you want to describe this as interim financial reports, then Ind AS 34 becomes mandatory. So, if entity wants to present half-yearly financial statements for better reporting, quick updating their shareholders and investors, and then a financial statements, if you want to describe it as interim financial reports, then Ind AS 34 is mandatory. Now, this is one case. I'll tell you another case. On 1st of December, or let's say 1st of November, X Limited applied for a loan. When X Limited applied for a loan, banker says, bring your financial statements. What this fellow did, 31st March 2025, ending financial statements are there, no? That you submitted to the bank. That anyway you have to give. Banker asks, 6 months old financial statements you are giving, what happened till 30th September, bring that also. What is possible? Last balance sheet, whatever assets and liabilities are there, whatever reserves and all are there, all you might have vacated it and made it nil by declaration of dividend, selling the assets and all. Everything is possible. So banker won't give you loan looking at 6 months old financial statements. He says, bring financial statements till 30th September. Now, so financial statements ending, let's say 30th September 2025. If bankers, how clearly they will ask is, if I simply ask you to bring a financial statements, you will prepare financial statements with your own rules and all, because it's voluntary, no. So you will not call it as interim financial report. You will simply prepare some kind of financial statements which suits your purpose. So banker very clearly says, give me financial statements for the first 6 months in accordance with Ind AS 34. Your auditor should sign, and auditor fellow will not sign unless it is complying with your Ind AS. So if financial statements you are submitting exclusively for bank. Now, if you want to describe this as IFR, then you have to compulsorily follow Ind AS 34. Ind AS 34 does not ask you to prepare IFR, but if you are preparing IFR, then you have to comply with Ind AS 34. It's like this. Now, coming to listed company ka story. Sir, in India, all listed companies are supposed to give information about their quarterly results. Every 3 months, they have to furnish a limited reviewed financial statements ka extracts, not full financial statements. That is this listing clause requirement, SEBI requirement. That is not IFR. Interim financial results. What is standard is interim financial report. We are talking about entire financial statements. What they report quarterly is a limited extract of their P&L account is what they report in accordance with the presentation given by SEBI requirements. So the quarterly information what listed companies present in India, that is not IFR according to Ind AS 34, sir. Of course, if you want to prepare IFR Ind AS 34, you can prepare. But what SEBI asks is not entire Ind AS 34 ka IFR. So don't get confused between listed company ka quarterly reporting versus this one. They both are not same. Next. Now, look at this. General rule is, sir, when you say something as interim period, it means any period less than 12 months is called as interim period. However, the financial statements of the entity in the very first year of its incorporation usually will be less than 12 months. Correct, no, sir? Company can be incorporated on any day during the year. Let's say a company got incorporated on 1st December 2024. Just because the company is incorporated on 1st December 2024, their financial year will not start from 1st December. No, yearly it will start. Every year they want to follow April to March only. So they will definitely close their books on 31st March 2025. Now, if you check the length of the P&L account, it is only 4 months. You should not go and call that as interim financial report. At the very first year of incorporation, obviously, the period of financial statements will not represent 12 months. That's because it is shorter version. You should not go and call it as IFR. The wrong answer, sir. So, even though this is the general rule, financial statements of entity in the year of its incorporation may be less than 12 months, not to be identified as IFR. Just because it is shorter period, don't call it as IFR at the very first year of incorporation. So that is one point. Next point is, sir, A Limited is a parent company. This fellow has got subsidiary B Limited. Now, since A Limited is a parent company, A Limited prepares consolidated financial statements. A Limited also prepares their own financial statements, which we call it as separate financial statements. Now, if A Limited wants to prepare interim financial reports, then this standard says Ind As 34 is mandatory. A point you already know. But this standard exclusively tells you that Ind As 34 is mandatory on consolidated financial statements. That means if you want to do interim financial reporting, you have to follow Ind As 34 on consolidated financial statements. Sir, what about SFS? SFS, you may or may not prepare interim financial statements in accordance with Ind As 34. There is no rule. But if you are preparing consolidated level interim financial reports, compulsorily the mandatory. SFS ki not mandatory, sir. Small fine points MCQs may be important. This standard does not mandate which entity should be required to publish interim financial reports, how frequently they should do, and how soon after the end of an interim period. This standard does not mandate you to prepare IFR. But if you are preparing IFR and you are an Ind As based company, definitely you have to comply with Ind As 34. It is like that. The standard applies if the entity is required to or elects to publish an interim financial report in accordance with Ind As. The limited review results what you give quarterly for listed companies, that is not in accordance with Ind As 34. That is SEBI requirements, sir. Further presentation disclosure requirements are given by listing clause agreement 41 of SEBI. Next, interim period is a financial reporting period which is shorter than a full year. Then another point what we covered, if an entity is presenting consolidated financial statements for the interim period, Ind As 34 is mandatory for consolidated financial statements. However, it is optional for separate financial statements whether to apply Ind As 34 or not. Ind As 34 is compulsorily applicable on consolidated financial statements, not on SFS. SFS your choice. So, it is broad, sir. Now, how to prepare interim financial reports? See, sir, don't look at the size of it. It's just big, but nothing is there inside. Visualize something like this. Just now we completed financial year 25-26, let's say. So this is 31st March 2026. This is over. Now, the company is in current financial year 2026-27. And let us say we are talking about second quarter, or let's say first quarter. First quarter period is what now? 1/4/2026 and ending on 30th June 2026. Imagine, sir, your company voluntarily decided to prepare interim financial reports for quick updation of information to your shareholders. And obviously, for this Q1, now that you want to prepare IFR, Ind As 34 is applicable. Now the question is, interim financial report, how to prepare? E-Standard gives you two choices. For IFR, E-Standard gives you two choices. First choice is, go and give a complete set of financial statements. Or second option, you can go with condensed set of financial statements also. Sir, what is the meaning of complete set of financial statements? Complete set of financial statements is nothing but, tell me sir, last time your annual year ending was what? 31st March 2026. Annual financial statements, whatever you have given for full year, same statement, same format, same requirements you have to follow for this Q1 also, which means you have to give balance sheet, you have to give P&L account, cash flow statement, statement of changes in equity, notes to accounts. 1 year comparatives you have to give, full disclosures of all the Ind Ases you have to give. If there is a rectification of error, change in accounting policy, major reclassification impacting more than 1 year, then you may also have to give a third balance sheet also. So whatever we studied in AS1 for general purpose financial statements, entirely you have to give for Q1 also. This is called as complete set of financial statements. And in case you are having any subsidiary, associate, joint venture, extra consolidated financial statements also you have to give. So whatever you followed for most recent annual financial statements, so same format, same requirements as applied in most recent annual financial statements. If fully you have to follow. But imagine sir, most of the times we see in our clients' offices, 31st March 2026 is over. Our financial year ka financial statements will get ready somewhere in the month of July or August. Meantime, already first quarter is over. If you ask that fellow to do the same kind of exercise for first quarter also, from where will you do? Asal annually not completed till now. Q1 ki again full requirement means Q1 ka result will come somewhere in Q3 or something like that. It gets delayed. Lot of repetition is there. Lot of accounting resources you have to use to get that kind of reporting. Say standard gives second option. Instead of giving full disclosures, full detailed financial statements, you can present abridged financial statements. Abridged financial statements or brief financial statements. Abridged or brief financial statements only, this fellow calls it as condensed set of financial statements. Sir, what will you give in condensed set of financial statements? Look at the requirements. Condensed balance sheet, condensed P&L account, condensed statement of changes in equity, condensed cash flow statement, notes, material accounting policy information, and other explanatory information. Sir, what nonsense is there? Again, you asked everything, just added one word called as condensed. This is looking extra. It's like this, sir. When you say balance sheet lo PP, a PP ke against ka one number you will write amount, but PP ka schedule ka number also you will write. PP note point 12. At 12 if you open there, 3 pages ka matter will be there. How many assets are there? What are the different class of assets? For each class of assets, opening original cost, opening accumulated depreciation, opening net block, current year acquisitions, current year disposals, current year depreciation, closing original cost, closing accumulated depreciation, closing net block. The entire detail you will present in notes to accounts. The standard says ignore all that. Balance sheet items you write. If something is important, explain. Otherwise, there is no need for you to give detailed explanation, detailed notes to accounts and all. Normally, you visualize once. Financial statements means how many pages? One balance sheet, 1 page. P&L account, 1 or 2 pages. Cash flow statement, 1 page. Notes to accounts, 20 pages. Don't give the 20 pages. So if I remove the 20 pages, now I have balance sheet 1 page, P&L 1 or 2 pages, cash flow statement 1 page, statement of changes in equity 1 page. 4 pages I sorted out now. And notes to accounts, so don't give detailed disaggregations, detailed disclosures. Limited disclosures you will give. And the standard also says in the balance sheet and P&L account, you need not go and give detailed line by line items. Headings and subheadings, if you match, that's enough for me. Sir, what is heading, subheading? Heading means non-current assets is the heading. Subheading PP. Subheading intangible asset. Against that, if you write amount, that's enough. A PP again, who are there, you need not explain. That is relieving lot of accounting work actually. Only the final numbers we will write. Auditor verified. Enough. That's enough. You do not show that everything. So that's how we condense it. And normally we say notes to accounts detailed. Here we don't give notes to accounts detailedly. We will only give selected explanatory information. We'll read all that. It's important. So he's explaining the story here. Considering the timeliness, cost, and repetition of the previously reported information, it is preferable. What is preferable? Condensed set is preferable because this is easy, less work. Objective of condensed set of financial statements is to give an update on the financial position and performance from the last reported financial statements. Hence, it should focus on new activities, events, and circumstances without duplicating the information. What is already recorded, explained in recent 31st March, again you need not start writing in these financial statements. For example, you see 31st March annual financial statements when I printed, in that all my accounting policies and all are recorded in that. Again, you need not give all that in the Q1 financial statements. If somebody wants to know your accounting policies, that fellow will download your annual report from the website and read. You will simply say that my accounting policies, whatever I followed in the last annual financial statements, I followed the same thing here also. And then again, you should not start my policy of valuing inventories, cost or NRV, whichever is lower, like that of 15 pages accounting policy, don't give. Disaggregations, PPLO, what are there? Inventories, what are there? Need not give. So you are duplicating information. Ignore it. These financial statements should include each heading, subheading, and selected explanatory notes. The entity shall present basic and diluted EPS. EPS, no, there is no exemption, sir. Compulsory EPS you have to disclose. Next. Normally, sir, first point there is nothing to read. The AS 1 law, whatever we covered, same thing. Next. We asked this fellow to give selected notes and not full notes. Mara selected notes lo what items should be there? The following is a list of events and transactions for which disclosures would be required if they are significant and required to understand the financial statements. That means in the notes to accounts, specifically talk about them if they are there. Now, who are they? Now, there are many points there. How to remember them is, as you read each point, write which standard it relates to. Okay, so even if you forget those points also, even if you casually run through all the standards, you will understand what are all the important events in each standard. You can fill up this. Check the first one. Write down of inventories to NRV. Which standard is that? Ind As 2. Next. Recognition of impairment loss on financial assets. PPE, intangible assets. He is talking about what now? Impairment loss. So that is Ind As 36 and also Ind As 109. 109 is impairment loss on financial assets. Other assets Ind As 36. The reversals of any provisions for cost of restructuring. Restructuring provision is Ind As 37. Acquisition and disposal of PPEs. Which standard, ma? Ind As 16. Correction of errors. Ind As 8. Related party transactions. 24. And again, contingent liabilities, contingent assets. Again, coming to Ind As 37. So, if they are significant, it's just like, when we discussed Ind As 108, segment report, what information you have to give? A measure of segment profit or loss, that's compulsory. Segment assets, segment liabilities, give if CODM is watching them. Otherwise, you need not give. Like that, the following items, if you feel they are significant and they are required to understand, then you give. Otherwise, you need not give. But continue further. Story not over. The following information should be included mandatorily. Turn back. Don't by heart anything, sir. Understand and leave. These kind of theory questions are not generally expected. If you understand and leave, that's enough. Basic idea, if you have 5 or 6 points, if you read, that's more than sufficient. First one. Accounting policies and method of computation. Listen, ma'am. Since you choose to prepare condensed set of financial statements, detailed explanation of accounting policy not required. It would suffice if you write that whatever accounting policies are followed in the most recent annual financial statements, same policies are followed now also. And a point, if you read, that's enough. However, if during the current year, if accounting policy change is there, then you have to explain. What was your old policy? What is your new policy? What is the impact of change in accounting policy? All that explanation is required. Unless there is a change in accounting policy, you need not give any separate disclosure of accounting policy information. Simple. Sir, why sir I will give, sir? Give, sir, nobody will stop you if you want to give. But we are talking about what? We are talking about condensed set of financial statements. Lo, selected explanatory information. Lo, what you have to give. You want to reduce as much as possible. If you give too much of information, who will read, sir? So make it quick, simple, smart. Seasonality. Sometimes, sir, some businesses are seasonal businesses. For example, you are doing some business which is based on a fruit which is available only in a particular season. You will run the business throughout the year, but your sales will be peaked in a particular season. Remaining quarters you will be suffering a loss. So when you are presenting interim financial report, a reader should understand whether this is a prime season of the entity or not. Otherwise, what will happen? For example, sir, your business is to sell winter jackets and sweaters. When will your sales be peaked, sir? Only during winter. That is usually Q3 generally. Q3 and Q4 ka first period. That's it. But if somebody checks your Q1 or Q2 ka financial statements, will anybody sell sweaters and winter jackets? Will customers buy? No. As a result, Q1, Q2, what will happen? It's likely that the company will suffer a loss. So the reader of financial statement should understand whether the period reported by the interim financial report, is it the prime season or non-prime season? If it is a non-prime season, loss is not a problem. But if it is a prime season, then also you are suffering loss, then that is something to be seriously taken care of. So if your business is seasonal business, then you have to explain whether the current financial period is your main season or not, you have to explain. Next. Unusual items means exceptional items that you have to explain. Change in estimates, you have to update that. Change in capital and borrowing. What is capital and borrowing? During the interim period, company raised money by issue of shares. Company raised money by issue of debentures. You made a bank loan. Obviously, all these are important informations you have to give. Any dividends are declared, you have to explain that. Segment reporting exception is not there, compulsorily you have to give. Events occurring after the interim period. Sir, notes to accounts, so you remember, events occurring after the balance sheet date, events are classified into two, adjusting and non-adjusting. Whatever are adjusting, their impact is considered in the financial statements. Whatever are identified as non-adjusting, what will we do? We will give a disclosure in the notes to accounts. Point. Events occurring after the reporting period, which have not been reflected, non-adjusting events. Indirectly right here, non-adjusting events. All these are mandatory disclosures. Changes in the composition. Composition means you started a new business, you acquired some other company, you merged some other company, you are acquired by somebody else. This kind of information you have to give. Fair value, Ind As 109 ka disclosures, whatever are there, that you have to give. And just like in Ind As 1, explicit and unreserved statement of compliance here also is required. The entity should disclose the fact that it prepared IFR, the prepared IFR are in compliance with Ind As 34. Of course, only when it is complying with in all respects. This is something similar to explicit and unreserved statement of compliance. Ind As 1 we studied this. Ind As 1 is general purpose financial statements. If you are doing quarterly, half yearly, 9 monthly financial statements, Ind As 1 is not applicable. E standard is applicable. But this standard also is asking you the same requirement. Next, sixth point, extremely, very, very important. That if you read nothing, you will get example to will handle this. Come here. Sir, our current period is 1/4/2025. In the current year, sir. Ending on 31st March 2026. Current financial year. That too, we are focused on presenting Q2 ka financial statements. Q2 starts from 1st of July 25, ends on 30th September 25. So this is my current interim period. Whether you prepare complete set of financial statements, you prepare condensed set of financial statements, comparatives are same. So, Q2 ki what financial statements you have to give? One by one, let's start. balance sheet. Tell me, sir, your balance sheet, since you are preparing Q2 financial statements, obviously Q2 ka end balance sheet anyway you have to give. That means a balance sheet as it 30th September 2025. Your interim period end balance sheet anyway you have to give. Not only that, you also have to give one more extra balance sheet for comparative. Guess what is that balance sheet? Guess. Previous year corresponding Q2. Normally we expect that. It is not. You have to give balance sheet as it most recent annual financial statements. When did you close your books of accounts last time? 31st March 2025. Adival, sir. Most recent annual financial statements. Recent annual financial statements. This is balance sheet, sir. One item is over. Number 2. Sir, as it is, this is the question. Last exam looking. November 24, I guess. Not May 25, but November 24 or no, May 24. Question as it is came, sir. What comparatives will you give? Statement of profit and loss. Tell, sir. P&L account guess. 2 అయితే easily you can guess. Current period ka P&L account anyway you have to give, no? That means you have to give statement of profit and loss for the period 1725 to 3925. This is your current interim period. This anyway you have to give. Current quarterly your performance. Now you have to give comparative. Comparative is for what? Ide 3 months in the last year, how did you perform? The corresponding period in the previous year. So, which means SPL for the period 1724 to 3924. Current interim period in previous year. 2. Not enough. SPL for the period. Tell me, sir, your accounting period started on which date? Year. 1425. So from here to here. Year to date. Cumulative P&L account. 1425 till today. 3925. This we call it as current year YTD. YTD stands for year to date. Year to date means from the beginning of current year till today's date. Cumulative P&L. 6 months P&L. But when you go current year, last year also you have to give. SPL for the period 1424 to 3924. This is previous year, year to date. So how many P&Ls you have to give? Total 4. Current period corresponding last year current period. Current year, year to date corresponding previous year, year to date. Total 4 P&Ls. Now you must also understand why I took only Q2. If I take Q1, 2 only will come, 4 will not come. Why? First 3 months and year to date both will be 3 months only. But if you take Q2, Q3, Q4, you will have 4 P&Ls. That's the reason we took Q2. Okay, this is about your P&L account. Next, coming to cash flow statement. Can you guess? Don't see. Guess. You are in Q2. Which period ka cash flow is required? Current period is Q2. Comparative? Previous year, look Q2. Him, sir. What will you do? You will be surprised. Cash flow statement cumulatively for the current year to date. Meaning not for Q2. Entire year to date you have to give. And comparative also. Only Q2 ka cash flow is waste, sir. Because Q2 is still a part of the year, no? So Q1 lo you might have earned income or cash inflows. Adi you might have spent in Q2. So only Q2 if I see, I will not get any idea. So if I want to get a meaningful idea of what you have done with your cash resources, I have to see in this entire year what did you do. That is the reason standard says, get me cash flow statement for the period 1425 to 3925. That means current year, year to date cash flow you want. Only Q3 ka cash flow statement is wasted. Leave it. That's not required. And of course, for this comparative, cash flow statement for the period 1424 to 3924. Previous year, year to date. That's it. Cash flow. Next hero. Can you guess this one then? Statement of changes in equity. The reserves and surplus ka statement broadly with OC items also. Yeah. Again, same as cash flow statement. Year to date. Only current period is wasted. So again, statement of changes in equity for the period 1425 to 3925. Statement of changes in equity for the period. So unless you specifically remember them correctly, definitely mistake chance is there. Cash flow statement is statement of changes in equity or year to date basis, not for the current period. Whether you are in Q2, Q1, Q3, Q4, it's always year to date. P&L account only is the statement which is prepared exclusively for this particular interim period also. Year to date is there in P&L account only. So in fact, what is easy for you to remember is year to date is common everywhere. P&L year to date you have to give. Cash flow statement year to date you have to give. Statement of changes in equity also year to date you have to give. P&L one exclusively current interim period ka report also you have to give. Remember like that. Don't focus too much on Q2. If you remember this as 3 months, sir, 3 months statement is done only for P&L account. It's 6 months, this is 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 6 months. So how you remember is entirely you have to give year to date basis. P&L account, apart from year to date basis, current interim period also you have to give like that. That's the easiest way to remember this. Now, again, this is also current year, year to date, the previous year, year to date. Now, as if all these are not sufficient, this fellow puts one star mark also for this one and this one. If entity is a seasonal business, if you are doing a seasonal business, you have to give SPL and cash flow statement for 12-month preceding the interim period also. Is extra. What is the meaning of this? Come here. Your interim period is closing here, you are standing here. You tell me that you are a seasonal business, I'll ask you to walk back 12 months from here. So 39/20/25 ending, starting is 1/10/2024. The entire 12 months period ka P&L account, this 12 months period ka cash flow statement extra. So in that case, apart from having 1, 2, 3, 4 P&Ls, you will have a 5th P&L also. Sir, why like that? Why seasonal business? You are penalizing extra. No, sir. Seasonal business, what will happen is your current period will not repeat again and again. Because seasonal business, only 1 or 2 seasons business will be there. Remaining seasons, it will be flop. So if I want to get a full idea of your business, I want entire 12-month data. That's the reason they are asking you from wherever you are standing, walk back 12 months. 12 months ka P&L you bring, 12 months ka cash flow you bring. This is seasonal business. E question, sir, as it is they asked, sir. They told Q3, give all the reporting requirements. If it is complete set, condensed set, nothing is going to change. Complete condensed, what is changing is contents of the financial statements are changing. Instead of giving too detailed, you are giving abridged versions. That's okay. But comparative, so no change. It's a very, very important concept. The entire point is 6th point. On this example also I printed here. Okay. Next. Balance sheet on a particular date, no ma. Balance sheet is given on a particular date. Not like that, ma. Balance sheet is not a period statement, no. It's a date statement. Balance sheet is for a particular period on a particular data. Today's net assets, year beginning lo net assets. It is not net assets for 3 months. This is not net assets for 12 months. Are you understanding, sir? So what we are trying to portray is last balance sheet date ki we are having these assets. After 6 months today, our assets are this. That's what you are showing. That is not for performance. See, there are your financial statements. P&L reflects performance. Balance sheet shows you position on a particular date. Performance statement is P&L account. No, so further detailed comparatives are there. So you compare current 3 months with last year 3 months. First 6 months with last year 6 months. That and all is meaningful. Balance sheet comparison is not for performance. No. Balance sheet comparison is for understanding whether the same assets are there or not, whether any new acquisitions happened, some assets you sold off, for this kind of information. So it's not for performance comparison. Okay, come here. Coming to materiality. On this, only one small question is there, that too not in this chapter, some other chapter, but to cover that matter is coming from Ind As 34 only. What is this is? Sir, whatever Ind As you study, not only this, any Ind As, that is supposed to be applicable only for material items. A small immaterial item ki, you need not go and apply any Ind As. Similarly, generally, sir, Ind As 1 also we studied. We have to give disclosure of all the material items, you have to give disclosure. And what is material is a matter of judgment depending on facts and circumstances of each case. Now, imagine, sir, is it possible that a particular amount is immaterial amount from an annual financial statements point of view, but it could be a material amount from an interim financial statements point of view? Possible or not possible? Suppose, sir, 1 lakh rupees amount is there. From an annual basis, if you see, 1 lakh rupees is a very small amount. But from a 2-month financial statement or a 3-month financial statements report when I'm preparing, E 1 lakh may not be immaterial, correct? Now, E 1 lakh rupees, I will definitely not give any disclosures nor explain about this 1 lakh when I'm preparing annual financial statements. So it's immaterial. So what is considered immaterial in annual financial statements may still become material for interim financial statements. So whether an item is material or immaterial, that is to be judged in the context of interim financial statements, not in the case of, not in the context of annual financial statements. The question how they will ask you is, sir, they will show you a small item of expenditure. They will say the immaterial from an annual point of view. No separate disclosures we are giving. But this fellow is now preparing interim financial statements. So in the interim financial statements, should I treat it as material or immaterial? For that the answer is, now that you are preparing interim financial statements, forget about annual now. In the context of this 3 months data, is the amount of transaction what you have, is it material or not? You judge it in the context of interim financial statements, not in the context of annual financial statements. That's that point. Materiality is to be seen in the context of interim financial statements, not on the basis of annual financial statements. Based on this, in Ind As 8 or Ind As 10, one question is there. That fellow will refer you to Ind As 34 in that answer. So when you come to Ind As 34, you should have a supporting point here. That's the reason it is kept here. If you do not know this authoritatively, a question you cannot handle there. Come here. Again, sir, for practically companies may prepare quarterly financial statements. Q1 they gave, Q2 they gave, Q3 they gave. Q4 usually people will not prepare. Why people will not prepare? Instead of wasting time in preparing Q2, Q4, you will prepare a full annual financial statements. No? But somebody would be watching your quarterly performance also. Sir, what should I do? You need not give any additional disclosure, sir. Whatever annual financial statements you make, in that annual financial statements, just one small point you have to disclose. What is that is, whatever accounting policies, estimates and all you made in Q3, if there is any significant change happening to them in Q4, give a disclosure about that in your annual financial statements. This is the only case where something related to interim financial reports is quoted in your annual financial statements. Annual financial statements are governed by which standard? Ind As 1. Our standard law, you have to, means our financial statements law, you have to go and write if there is any estimate changes. Generally, an entity may not prepare IFR for the last interim period as it is going to prepare and present audited annual financial statements. In such case, if an estimate of an amount reported in the interim period is changed significantly during the final interim period, the entity should disclose the nature and amount of that change in the estimate in a note to the annual financial statements. This is not a very great point, sir, but this is a very, very rare point. How is it rare? Sir, annual financial statements law, why will I write anything about interim financial report which is not prepared first of all? Q1, Q2, Q3 we prepared. Q4 lo, sir, Q3 lo whatever estimate you made, that significantly changed in Q4. That means you estimated some heavy provision for damages, but actual damages was not that much. Restructuring provision reversed. Inventories measured at NRV cost. Something happened. So because of that, Q4 anyway I'm not preparing, no. So give a disclosure and a note in your annual financial statements itself. It's a rare point. That's the reason it is there. Study matter also it's covered. Now coming to the main part of our questions. Sir, 99% of the questions are only based on this. All questions you'll be able to solve only on the basis of this. Apart from this, 1% are a few tax based questions are there. Once you finish that, the standard is over. Okay. Let's see what is it trying to say. First casually read, sir, then I'll give you examples. In preparation of interim financial statements, an entity should use the same accounting policies which were applied in its annual financial statements, of course. In case of any change in accounting policy, it should use a new policy. The principles for recognizing assets, liabilities, income, expenses for interim periods are same as in the case of annual financial statements, meaning you should not ask stupid questions that, sir, annual financial statements, a lot of time was there, full standards we followed, here any exemption is there? No exemption. Every standard is applicable even for interim financial reports also. You can't seek exemptions and all. Now, ABCD points you will read later on. Meanwhile, I will give you some examples, carefully focus. The examples only will become your ultimate question, sir, which you have to solve in detail also. Important chapter only. So, focus on the example. Let us say company is preparing quarterly financial statements Q1, Q2, Q3, Q4. And your current quarter is Q2. This is your current quarter. You are bothered only about Q2. What this standard guides you is, when you are preparing Q2 financial statements, imagine that Q2 itself is a full period. Don't be under a cheap impression that a full year low, a part period accounting I am doing. Don't feel like that. Imagine Q2 itself is a full year. Normally, annual financial statements, how will you prepare for any year? Like that, prepare financial statements of Q2 by treating Q2 as a full period. Sir, what is the implication of this line? Implication of this line is no sharing business. No sharing of incomes and expenses with other interim periods. Suppose, sir, our company has investment in equity shares. Since last 10 years, we are having that investment. Every year, that investment is giving us a dividend in Q4. So, Q4 lo we are receiving a constant dividend. Every year we are getting around 100 lakh rupees. If you look into my annual financial statements, other income low, dividend income on 100 lakhs is visible. But actually, a dividend is received in the month of Q4, April month or March month or something we are receiving. This accountant fellow got an idea like this. 100 lakhs is annual income. We are receiving in Q4. But presently I am preparing Q2 financial statements. Let us do one thing. We will recognize 25, 25, 25 and 25. His standard says not allowed, not allowed, not allowed, not allowed. Meaning, imagine, sir, this is not Q, but it is Y. Year 1, year 2, year 3, year 4. Tell me, ma, Year 4 का dividend income, can you recognize in year 2? Likewise, Q4 का income cannot be recognized in Q2. As simple as that. No sharing business. Don't treat yourself as a part of a full year. Treat yourself as a separate accounting period. Then automatically ideas will be correct ideas. Next. This fellow incurred here in Q2 training costs are incurred. Rupees 40 lakhs is paid. You trained your employees. Next time training will happen again only in the next 1 year. After 1 year only training will happen. Now, 40 lakhs is a kind of training which will keep the employees updated for a period of 1 year. Agreed. But the expenditure, when did you incur? Q2. Accountant fellow will propose that, Arey sir, if 40 lakhs belongs to all the 4 quarters, no. So in Q2 I will book 10 lakhs. Each quarter ke 10 lakhs he will book. That's your general idea. Now how you should think is, year 1, year 2, year 3, year 4. Training cost incurred in year 2. Can I book it as expenditure in year 3 and year 4? Can I do like that? No. Something that cannot be split between 2 full financial years cannot be also split between 2 interim periods also. Again, same reason. No splitting. No deferring. No anticipating. Sharing is caring, and a word is not applicable in interim financial reports. Sir, that quarter is also our full year part only. No, sir, he is also my friend, and feelings if you keep, you lose marks. Each Q, each quarter or each period is treated independently. Now I'll show you some exceptions. Exception. In Q2, we paid insurance premium for next 12 months. Sir, if you paid insurance premium, tell me, insurance premium is time related expenditure only, no? If you pay premium, you get coverage for a particular period. Tell me, from when to when you are covered? You are covered from here. In 9 months you are covered. Next year Q1 also you are covered, correct? Now this fellow proposes that since the insurance premium belongs to 4 quarters, I'll split it across 4 quarters. And the current year 9 months, next year 3 months. Especially in the current quarter, 3 months expenditure he wants to book. Can he do it? For that again answer is same. Your thought process should not change. Your thought process should not change. Imagine this is year 2, year 3, year 4. In year 2, I paid insurance premium for year 2, year 3, year 4, year 5 also. Can I split it? Between years, can I split it or not? Yes, prepaid insurance expenditure. Something which can be split between 2 years can also be split between 2 interim periods. Our logic though, I can split the insurance premium. Next, another example you see. Our company took a loan. On that loan, our company paid interest expense in Q4. Expense, when is it paid? Q4. But expense belongs to Q4. Huh? Interest. Interest belongs to entire year. Interest is also something which accrues on time. So, imagine again, year 1, year 2, year 3, year 4. 4th year you paid interest for all the 4 years put together. Tell me, sir, expenditure is recorded in 4th year every year? Likewise, even though you pay interest in Q4, interest expense is accounted in each quarter. So one example is insurance. Another example is interest expense. Of course, interest income. Annual financial statements low. Depreciation entry, when will you write? Every day. Daily one entry you will write. Depreciation. When will you write? Year end you will write. Just because depreciation entry is recorded at the end of the year, will that become expenditure of 4th quarter? No, that is full year expenditure only. No, sir. Depreciation is for full year. Again, time related depreciation. How to remember? All these are time-based items. These can be split between interim periods. So just now you told sharing is not caring and all, you cannot use that. Arey sir, don't share anything else other than time related items, because time related items are split between 2 years only. What about 2 interim periods? Happily you can split. Dividend income is not time based income, but interest income is a time based income. Interest can be split, dividend cannot be split between interim periods. So that is all that is there, sir. Now read ma. Point number A, B, C. Please read. Consider each interim period as the accounting period. All the incomes and all the expenses relating to interim period shall be recognized during the interim period only. Incomes or expenses of current interim period shall not be deferred to other periods. Similarly, incomes or expenses of other periods shall not be anticipated in the current period. Meaning, come here. Training cost, when did you pay in our example? Q2 lo you paid. He says, you paid in Q2, no, shut up and book it in Q2. Don't share it with Q2, Q3, Q4. Don't share. Don't defer it. Similarly, dividend is going to come in which quarter? Fourth quarter. Don't anticipate that in Q1, Q2, Q3, Q4. That's wrong. Whenever it comes, it relates to that quarter. Only exception is time related expenses. Adi standard directly they did not say. Their language you see. C point. Any income or expense that can be split between 2 interim periods, if such an item can be split between 2 full financial years. Sir, I am paying interest on calendar year basis. December lo I pay. From January to December, I am paying in the month of December. But January to March falls in previous financial year. April to December falls in the current financial year. Am I not splitting the interest expense? I am splitting between 2 financial years. Something which can be split between 2 financial years can also be split between 2 interim periods also. That's what logic. And therefore, interest, income, expense, depreciation, insurance, property taxes, rental income, all these are examples of this. So you can write there basically time-based items. Time-based only this kind of incomes and expenses can be split across the interim periods. Rest all, no splitting. Next, D point. That is a joke. All the Ind As will be applicable in the interim period, no exemption is given. Of course. Why will exemption be given, sir? You are not small companies. Ind As is applicable to whom, sir? Big companies only, no. Net worth should be 250 crores or more, or you are a listed company. You cannot seek exemptions and all now. Properly, every standard is applicable. Spend money, buy a CA, hire him, make him do. The preparation of interim financial reports require a greater use of estimation methods than in annual reports. Why these estimations? Where these estimations? I will show you later on. First, till here, clarity is there, sir. Your expense, your share means there is no sharing business, sir, unless it is a time-related income or time-related expenditure. That's it. One more point will take you to questions. Don't worry about all this. All these are cheap only. Come here. Come to page number 16.10. No, 10th point, please. Guys, what we are discussing is change in accounting policy. How will you reflect? So very easy stuff, sir. Carefully listen. It's a simple point. I have an example, but still, before giving to example, theoretically you try to listen. Q1, Q2, Q3, and Q4. Sir, we are preparing Q3 ka financial statements. Q3 is our current financial statements. You tell me one small thing. How many P&Ls you have to prepare? How many P&Ls? 4 P&Ls, correct? Tell me the periods now. First is SPL of Q3 in the current year. How many months is that? 3 months. Then SPL of Q3 in the previous year. That is also for 3 months. Then what else I have to give? I have to give SPL of year to date in the current year. How many months? 9 months. Similarly, SPL of year to date previous year 9 months. Do you understand this? No. Imagine, sir, I was following one accounting policy here. I was following one accounting policy here. Same accounting policy. Here, what happened in the current year? There is a change in accounting policy. In place of old policy, I am following new policy. There is a standard called as Ind As 8. We are next going to cover that. Ind As 8 standard says that whenever there is a change in accounting policy, by default, you have to do a retrospective restatement effect. What is the meaning of retrospective restatement effect is, had you followed that new policy from the very beginning, how your financial statements would have looked, that you have to identify. Now, randomly think, sir. Some expense as per my old policy, 100, 150, let's say 120. This is old policy, but I changed my new policy now. So according to my new policy, the expenditure should be 120, 170, 135. Now, my question is only one single thing, sir. Had you followed old policy, black numbers would have come. Because you shifted your policy, a pink number should be coming, a black number should not come. Now, already by the end of Q2, how much expenditure did you book? 100 plus 150, 250 already booked. Current year Q3 lo, sir, anyway policy changed. I'm not stupid to book 120 now. I will directly book which expenditure? 135. But by booking 135 in the current year, you are taking the impact of change in accounting policy only for Q3. But Q1 and Q2 already you followed which policy? Old policy. That also you have to update or not? If you update, what will happen? Here extra 20 expenditure you have to book. Here also extra 20 expenditure you have to book. That means you have to extra book what? 40 expenditure relating to previous quarters. Relating to current quarter, you have to book extra 15. What this standard clearly says is, listen carefully now. When a change in accounting policy happens, current interim period should be impacted only with the change in accounting policy that relates to current interim period only, not relating to previous interim periods. Because of your change in accounting policy, the expenditure what you recognized in Q1 and Q2 has to be increased by total 40. A 40 cannot come into your current year P&L account, current period P&L account. In 3 months P&L account, 40 should not come. What should come? 15 can come. 15 anyway will come because you will directly recognize which expenditure? 135. 15 will anyway come. But a 40 cannot enter into your current 3 months P&L account. Sir, then where will I show? Sir, do you also prepare a 9-month P&L account now? Going through there. In 9-month P&L account lo recognize extra expenditure of 40. So what this standard is trying to tell you is, when you update your accounting policy, what is already accounted in the previous quarters, they also have to be updated. Current year lo also updation ka impact will be there. Current period ka P&L account should bear the impact of accounting policy which relates to current period only. Last 2 quarters ka accounting impacts should not fall into Q3, 3 months P&L account. But Q3 lo not only 3 months P&L account, you will also prepare a 9-month P&L account. There you adjust it. That's all, sir. In all the questions, almost all the big questions, adjustment will be there. What that fellow will do is, sir, we changed our accounting policy. Because of change in accounting policy, our total increased expenditure is 55 rupees. The entire 55 rupees is impacted to third year, and he will tell. That is wrong. A 55 cannot be thrown into P&L account of 3 months P&L account. You can't post. Why? That 3 months means only this 3 months, sir. This 3 months impact is how much? 15. Only 15 can enter there. Previous 2 quarters ka 2020 cannot enter here. Sir, then where will I show? In this 15 will fall. In this entire 55 will fall. The 15 anyway will be there in the 9 months. A 40 also will fall. So 20 plus 20 plus 50. This is 20, this is 20, this is 50. So current interim period P&L account, a 3 months P&L account lo previous quarters impact should not be there. That's the only point you have to take care of. Now based on this, one small dummy question I created, please go through it. Read correctly, sir, otherwise confusions will come while doing the main question. A Limited is preparing its financial statements in Q3. Q3. Till the end of Q2, it has followed the policy of valuing the stock as per FIFO basis. Q1, Q2, FIFO yes, sir. Q3, you switched over to which policy now? Weighted average cost. The following details are available. FIFO, WAC. Carefully work out, sir. Q1 lo which one did you follow? FIFO. Q2, FIFO. Q3, you followed weighted average cost. That means this is your expenditure, correct? And whenever you switch over your accounting policies, that's not prospective. You have to give a retrospective effect. Now, tell me, sir, because you switched over to WAC, your first year expenditure is increasing by how much? First quarter expenditure is increasing by 600. Second quarter expenditure is increasing by 500. Third quarter expenditure is also increasing by 500. Overall, your expenditure is increasing by 1600. A policy change happened in which quarter? Third quarter. Just because third quarter low you changed your policy, entire 1600 cannot come to P&L account of 3 months P&L account of Q3. That's the only point standard is trying to tell you. You tell me, sir, out of that 1600, how much relates to Q3? 500 you throw in Q3 ka P&L account. Mara first 600 plus 500, adi Q3 ka 9 month P&L will be there. In that you post. That's what he's asking you to do. That's all over. Come here. Current interim period, sir. First P&L account. Year to date P&L account. When you are in Q1, this is for 3 months. This is also for 3 months. When you are in Q2, this is for 3 months. This is for 6 months. So here, second column, please make it 6000. Wrongly printed 6000. Please make it 6000. Printed as 6600. Please make it 6000, sir. How can you post year to date in Q1 as 6600? You don't even change it to WAC at that time. No, wrong printing. Come to Q3, please. When you come to Q3 ka expenditure alone, you will book 7500. This is 3 months, but this will be for 9 months. Count last column now. Last column should be cumulative column, sir. Careful. Counting means not this total. Stupid people. E3 total. 6000 plus 5800 plus 7800. 7500. Overall plus 1100. What is that 1100? Q1 ka extra expenditure 600. Q2 ka extra expenditure 500. So total 1100 extra expenditure should be reflected in year to date column. Don't post it here. What is this? Is Q3 ka extra expenditure that can come. So Q3 ka 3 month means only current 3 months. Previous quarter ka expenditure, how can I book in current 3 months, sir? That is as good as you booking last 2 years ka expenditure in the third year. That's wrong. Retrospective restatement means comparative column change, sir, not main column. Sir, you prepared P&L account of last year. In that mistake is there. You identified that in the current year. Mistake, where will you rectify? Current year main P&L. No, you will rectify. Comparative column, you have to rectify. Exactly the same thing in the comparative column. Comparative column, restatement just call. Sir, main column, you should not update it just because accounting policies changed in the current year. That's all I have to say, sir. Nothing else. Over. Now you see how many questions you will beat out at once. Come here, sir. Come here. Not so fast. Okay, sir, we'll come. You want to go to Uti, yeah? Okay, come. 7th question, I'll take it. Read. Please read now. K Limited has resorts in Uti. The season in Uti is April to June, the first quarter. During this period, business will be peak, and in the remaining period, business will be low comparatively. Fine. During the first quarter of 2014-15 financial year, it earned 4 crores. And the Q1 4 crores money they made a resort. And it is expected to earn 2 crores in the next 3 quarters. Okay, first quarter of 4 crores, remaining 3 quarters put together, they are going to earn only 2 crores. In preparation of interim financial statements, as per Ind As 34, the accountant of the company wants to defer 4 crores income and wants to recognize 1.5 crore in each quarter. We nine yesterday, sir. Sir, 4 crores Q1. Next 3 quarters, 2. Total put together is how much? 6. 6 divided by 4 quarters, 1.5 crore per quarter. He will want to recognize. Can you do like that, sir? If you are doing like that, what are you doing? You are deferring current period ka income to other periods, and you are also anticipating other period ka 2 crores to current year. Both are not allowed. So what you should do? Just shut up everything and recognize 4 crores as income in Q1. That's all. You are not supposed to postpone this to next quarter. How easy you see. Okay, so very interesting case. Read. Excel Limited is an engineering company and it is developing a new networking product which is an intangible asset. It is a developing and a development stage it is there. The company spent 10 crore rupees during the first quarter. As per Ind As 38, development expenses can be capitalized only when it satisfies all the 6 conditions given. Otherwise, total expenses should be charged to P&L account. You remember this, no? 6 conditions of Ind As 38. He says the company is not able to satisfy the conditions at the end of interim period, but the company hopes that it will meet the recognition criteria during the next quarter. Hence, the accountant of the company wants to defer the expenses instead of charging to P&L account. Sir, this is a side effect of preparing interim financial report. You see, if you are not preparing interim financial report, last time balance sheet date, you would have capitalized something already. Current year, while spending, all the 6 conditions are satisfied, you capitalized. Subsequently, when will you check? Again, on the balance sheet data, you will check. Every day, you need not sit and check. On the balance sheet date, you have to check. But unfortunately, our fellow prepared interim financial report. On the interim date, if you check, 6 conditions, 1 condition failed. 1 condition is failed, what will you do? Entire amount you have to write off. This fellow is arguing, no sir, I failed now, but I will pass in next quarter. Each quarter is to be seen independently. First quarter you failed now, come off to PRL. And Ind As 38 says, once you die in PRL, there is no coming back to balance sheet again. Are you understanding the side effect of IFR, sir? If you don't prepare IFR, asala testing you might not have done. Directly balance sheet date you will do, on the day you might have passed also. You would have never come to P&L account. But now you are coming to P&L. Gone, you have to write off. The entity does not satisfy the same as at the interim date. Hence, the entity should recognize total amount of 10 crores as expense during the interim period only. Please underline that, sir. That's the only line you will see. 9th question and all, still concepts are yet to be covered. Come here, this one is waiting for you. Past exam question, I say a favorite, cheap question. Sincere Corporation is dealing in seasonal product. Sales pattern of the product, quarter wise, is as follows. Q1, Q2, Q3, Q4, 10, 10, 60, 20. Tell me, sir, what is your main quarter? Q3. 60% of my sales is going to happen in Q3 and to partly to some extent in Q4. Information regarding first quarter is given. April, May, June. Sales, salary, advertisement expenditure, admin and selling expenditure. 60 plus 4, 64 plus 8, total 72. Net profit is 8. While preparing interim financial report of the first quarter, Sincere Corp wants to defer 10 crores of expenditure to third quarter. Why it seems? Because on the argument that third quarter is having more sales and therefore third quarter should be debited with more expenditure. Considering the seasonal nature of business, the expenditures are uniform throughout all the quarters. Calculate the result of first quarter as per Ind As 34. Also give a comment on the company's view. Sir, first quarter ka salary expenditure and all, can I postpone and book it in Q3 because sales there are high and So what should you do? Nothing. Don't postpone anything. You enter 64 and 8, book it as expenditure of current quarter only. That's your profit is. K Limited shows the net profit of 5,40,000 for Q3 after incorporating the following. Wait there. Q3 you are standing ma. Profit already identified. Profit is identified after incorporating the following. First one. Bad debt of 30,000 rupees incurred during the current quarter. But 50% of the bad debts have been deferred to next quarter. So sad. Sir, current year bad debts you will recognize in the current year and next year. Like that only. Current interim period ka bad debt should be booked in current period. What our stupid boy has done, 15,000 has postponed to next quarter. What should you do now? 5,40,000 minus 15,000. Actual bad debt 30 ma, 50% you booked, 50% you postponed it. Book that also now. So answer is how much now? 5,25,000 revised profit. First adjustment over. Second adjustment. Extraordinary loss of 28,000 incurred during the quarter, during the third quarter only, has been fully recognized in this quarter. Q3 ka loss you booked in Q3 only, it seems. Right or wrong? Right. Trap adi. Don't do anything. Correct treatment. Next. Additional depreciation of 36,000 of third quarter, resulting from a change in the method of depreciation. Okay. This fellow changed the depreciation, sir. From WDU to SLM or something, he changed. Because of that, depreciation amount will change. Extra depreciation that came to 36,000. But that 36,000 belongs to which quarter? Of third quarter only. Third quarter expenditure you booked in third quarter only. Is there any problem with that? No. So what is the final answer? 5,20,000. That's it. E type of cheap questions will come or will not come? Will come. Came already. Mark this one important. 14th one. It came in the exam twice. Of course. AS exam. On 30th June 2007, A Limited incurred 2 lakh rupees net loss from disposal of a business segment. Fine. Out of so many CGUs, one CGU you sold off, or one business vertical you sold off, you suffered a loss. Also on 30th July, the company paid 60,000 rupees for property taxes assessed for the calendar year 2007. Underline the word property taxes, drag a arrow mark and say time related expense. A point if you can't catch over that sum there only. Property taxes is a time related expense. How the above transaction should be included in determination of net income of A Limited for the 6 months interim period ended 30th September 2007. Okay, now he comes and tells you that your interim period is 6 months. Ended 30th September. Easy sum, carefully you have to handle. What is the question number? Sir, you are presently closing on 30th September 2007, half yearly. So it started on when? 1/4/2007. This is your current 6 months period. You are preparing your interim financial statements for this period. Now, read the question once again, top line, and tell me, when did that sale of business segment happen? 30th June, sale happened. In that you suffered a loss. So, somewhere during this only, sale of your business segment, loss suffered is how much? 2 lakhs. Tell me, sir, loss, which period will you book? Obviously, what a current quarter you have to book, whatever quarter it is, because that is not quarterly, no, half yearly period. So, 6 months only you will book, obviously, because the sale happened during this period only. Then, you paid property taxes also. How much property tax did you pay, ma? 60,000. You paid on 30th July. That is also in the same quarter, same half yearly period. So, here only property taxes paid rupees 60,000 for calendar year 2007. You tell me, calendar year 2007 starts from where to where? 1107 to 31st December 07. That means is 60,000 last year lo 3 months ki, current period lo 6 months ki, next period lo another 3 months. Your 60,000 belongs to total 12 months in this ratio. Divide and tell me each period how much expenditure is there. 60,000 by 12, 5,000. 3 months ki 15,000. 15,000. 6 months ki this is 30,000. Here again 15,000. Now, since you are accountant pro max, tell me what entry will you write when you pay 60,000? Tell correctly, feel good about yourself. I will tell half entry, sir. Okay, fine. Looking at your face, I am helping you 50%. Other 50% you do. Expense, correct. Property tax expense. Okay, sir. Advance, prepaid expense. See, prepaid tax. Which 15,000 is it? Next quarter, obviously from October, November and December. This is from April to September. What about other 15,000? The other 15,000, since it's a time related expenditure, when you were on 31st March, you would have recorded property tax expense account debit to outstanding expenses or expenses payable. And accrual concept, you would have recorded one entry. Our liability you are paying now. Are you understanding, sir? So here, property tax payable account debit. This is for Jan to March. That's all. So what goes to your PRL is only this one. The other one is prepaid expenditure. The other one is outstanding expense ka settlement. Such a simple question, sir. If you are not careful, exam pressure low, ideas will not come. You get stuck. Gone. Such a simple question. Nothing is there. Basic accounting. But once you do, it will be easy for you. Yeah, our segment sale ki nothing is there. Our entire 2 lakhs will be booked in current year P&L account only. That fellow wrote the same entry, but in a paragraph. Same story he wrote in the type of paragraph. That's question number 14 for you. This and all you insult yourself. Come to 16th one, sir. Before 16th one more similar stupid fellow is there. Here. Why are you hiding from me? Oh. Disappeared, huh? I was searching for someone. Last time I saw it was there. Okay. First handle this, 18th one. Almost everything you have done except one, but still do it. ABC Limited manufactures automobile parts. ABC Limited has shown a net profit of 20 lakhs for third quarter of 2011. The following adjustments are already made while computing the net profit. Pakka wrong profits are the 20 lakhs to start. Let's see. Bad debts of 1 lakh are incurred during the quarter. 50% of the bad debts have been deferred to next quarter. So you have to book 50,000 now. Additional depreciation of 4,50,000 resulting from change in method of depreciation. No adjustment. Exceptional loss of 28,000 incurred during third quarter. 50% has been deferred to next quarter. Oh, so sad. You have to recognize. The 14 anyway you booked. Another 14,000 you postponed. Now I am booking off. 5 lakh expenditure on account of administrative expenses pertaining to third quarter is deferred on the argument that fourth quarter will have more sales. Therefore, fourth quarter should be debited with higher expenditure. What a joke. Remove this also. So 15 lakhs minus 64,000, that is 14 lakh. That is expensive. Okay, come here. I was searching for this only. Read. Rishabha Limited reported a PBT of 4 lakhs for the quarter ending 30th September. On inquiry, you observe the following. Give the treatment required under Ind As 34. You are in 30th September Q4. Oh, sorry, Q3 that is. Okay, depends on whether you are following Jan to December or April to March. But that's anyway. 3 months ending 30th September. Your PBT is 4 lakhs. So 4 lakhs wrong profit to start of sir. What happened now? Dividend of 4 lakhs received during this quarter only. But you recognized only to the extent of 1 lakh. In my room, sir, a 3 lakhs he postponed it to other quarter. Wrong. What should I do? Add. Next. 80% of sales promotion expenses, 15 lakh rupees incurred in this quarter has been deferred to next quarter. 15 lakhs, so 80% he deferred. The 12 lakhs he deferred. Expenditure also should have booked in this quarter only. Minus 12. Good. Next. In this quarter, the company changed depreciation method from WDV to SLM, which resulted in excess depreciation of 12 lakhs. The entire depreciation amount has been debited in the current quarter only, even though the share of the quarter is only 3 lakhs. Now you see, sir, the entire thing he is making you sound like change in accounting policy. But you must understand that change in depreciation method is a change in accounting estimate, but not a change in accounting policy. So whatever they have done, that is correct only. There is no need for you to identify how much belongs to current period, how much belongs to previous periods and all. Do not do that. They trap it. Rupees 2 lakhs. You know why this adjustment is there? Not that they want to trap you. Once upon a time in accounting standards, sir, change in method of depreciation was identified as change in accounting policy. At that time, it was an adjustment. Now it is not. So now we have to simply ignore it. Don't do anything. Rupees 2 lakhs unusual gain received in this quarter was allocated equally to this and next quarter. Equal share cheskunnar, sir. Wrong, no, sir. Add 1 lakh. Cumulative loss resulting from change in method of inventory valuation. That's all. That's enough. That's final. The accounting policy. Here you apply all your talent. Cumulative loss resulting from change in method of inventory valuation was recognized in the current quarter of 3 lakhs. You know what's the meaning of this? Wait there. Come here. Because of change in accounting policy, increased expenditure is how much? 1600 cumulative. Entire 1600 current quarterly he booked. Correct, sir? No, like that. In this case also, where is it stupid number? Okay. Total 3 lakhs he booked off. Out of this, 1 lakh loss relates to previous quarter. At the year to date column, you have to show your talent, not in the main column. So what should I do? 3 lakhs you booked, but you should have booked only 2 lakhs. So I should increase your profit by another 1 lakh. Loss and he told no. Next. Sale of investment in first quarter resulted in a gain of 20 lakhs. The company apportioned this equally to all the 4 quarters. 20 by 4, 5. In the 5 is there, remove it. Tell the final answer. 7 plus 9. 7 plus 9. 9 minus. That's all. That's final answer. Fantastic. Mind blowing answer. Difficult, is it? This question or a similar question came, sir. Where is that stupid question? Where are you, Ray? Hero Limited reported PBT of 8 lakhs for the third quarter. On inquiry, you observe the following. Dividend income of 8 lakhs received during the current quarter has been recognized only to the extent of 2 lakhs only. So, 8 lakhs ki, you have to add another 6 lakhs. 60% of sales promotion expenses incurred in third quarter has been deferred to fourth quarter. 4 lakhs extraordinary gain received in third quarter was equally allocated to third and fourth quarter. Cumulative loss of 30 lakhs. Oh, my question only, yeah, copied. Cumulative loss of 30 lakhs resulting from change in method of inventory valuation was recognized in third quarter. Out of this, loss of 10 lakhs relates to previous quarter. 3 ni 30 చేశాడు sir, 1 ni 10 చేశాడు. Sale of investment in first quarter resulted in a gain of 40 lakhs. In our book, it was 4 lakhs. Or 20 lakhs, that he made it 40 lakhs, double yes. 4 marks, sir. Same, ditto question. There will be some advantages of doing more questions. Disadvantages, obviously, time, but sometimes questions you'll see like that. Exam of peace of mind will come. Okay, come here, sir. Sir, this is the major adjustment what they are trying to test. Apart from this, few special cases are there. Let's come here. Few specific cases of guidance given in Ind As 34. We'll start with the order of importance, sir. Everything is not important, but the most important one being taxes. Come to point number J. Taxes in interim period. Sir, taxes normally we have to ultimately how much tax you have to pay, that depends on your annual income, not based on your quarter income. But you may be preparing quarterly based financial statements, but your tax liability is determined based on your annual income, not based on your quarter income. So, how to determine tax expense of each quarter or each half year in your interim financial reports is standard gives a specific guidance. It is little different from what we learn, but it's not difficult also, it's easy. Let's say X Limited operates April to March accounting year, and presently it is in Q1. Now Q1 ka data, actual accounting income of Q1. Now that Q1 is over, you will definitely know what is your actual accounting income. Q1 accounting income PBT. But Q2, Q3, Q4 accounting income, you will not know now. You will know only when you go into Q2, Q3, Q4. But the standard says, step number 1, estimate annual income, which means estimate annual accounting income. So Q1 actual I'm taking, which is 3 lakhs. You don't have a choice also. But for Q2, Q3 and Q4, I am taking expected values. Let's say Q2 I'm expecting 4, Q3 I'm expecting 6, Q4 I'm expecting, let's say, 2. So 15 lakh rupees is your accounting income. Step number 1 sorted. Sir, why they are asking you to work out accounting income is, Sir, in an Indian tax scenario, if you check, for corporates, there is no slab rate system. Slab rate system is there only for individuals. But outside India, there are many countries where even corporates also slab rate taxation is there. Imagine, sir, in India also, if I tell you slab rate system is there, how much tax you have to pay depends on clearly on your annual income. No? So even though you earned 3 lakhs today, if you are not going to earn overall crossing 10 lakhs, your slab rate will be 20% only. But when I see your annual income, I understand that, okay, it is 15 lakhs, you are crossing 10 lakhs also. So you're in 30% bracket right now. So that's the reason the standard is asking you to work out total annual income, even though I have to measure only Q1 ka tax expense right now. Come on, step number 1. Step number 2. Compute taxable income and current tax. Identify any special incomes. What is the meaning of special incomes? According to Income Tax Act, certain incomes are taxed at a different rate. For example, long-term capital gain is there. That is taxed at a different rate from the usual incomes. So, a kind of income separate. Also identify deferred tax, if any. So, let's say total annual accounting income is 15 lakhs. Sir, for basic understanding, I'm not bringing any deferred taxes now. Slowly we'll introduce if required. But time being, understand the process. To this, make some adjustments and identify your taxable income. So let us say, out of this 15 lakhs, remove capital gains in Q3, 1 lakh. So remainder income is 14 lakhs. This I will call it as taxable income. It's not that a 1 lakh is not taxable, it's taxable at a separate rate. Now, current tax rates. Imagine it is like this. First 5 lakhs, 20%. Greater than 5 lakhs, you have to pay 30%. Therefore, and on capital gain, you have to pay 10%. Imagine this is your current tax rate, just to make the case more interesting. And then your current tax will be equal to, you are having 14 lakhs income, sir. On first 5 lakhs, you have to pay 20%, which is equal to 1 lakh. 14 lakhs, total of 5 lakhs I already considered, no, remaining 9 lakhs. On remaining 9 lakhs, we have to pay 30%, which is how much, sir, is 1 lakh. 9 into 3, 2,70,000, which is equal to 3,70,000. Then special tax. Special tax on that 1 lakh, you have to pay 10%, which is equal to 10,000. Step number 1, step number 2. So step number 1, normal accounting income, sir. In this, is the real. These 3 are estimate. And based on my estimate, I worked out taxable income. Based on taxable income, worked out current tax. If deferred tax is there, that also you have to work out. Special income is there, special income tax also work out. Step 2. Step 3, final step. Sorry, last but one step. You have to compute water. Water stands for weighted average tax rate. Compute weighted average tax rate. How to compute weighted average tax rate is water percentage per normal taxes on accounting income. You have to explain, you have to express. I mean to say, for example, 3,70,000 is there, divided by, what is your accounting income normally? 15 lakhs, step 1. A 15 lakhs of special income is there, remove that. So it will be 14 lakhs into 100. How much is that? Percentage. 26.42. Okay, na? Next. You have special income also. So what are percentage for special income? Special income tax is 10,000 rupees. Special income is there 1 lakh rupees. Here there is no slab, no, so same answer came off here. Finally, step number 4. Your tax expense in each interim period would be Q1. What is your Q1 income, sir? 3 lakhs. On 3 lakhs, directly go and apply 26.42%. Check the number, sir. 79,260. This is Q1, ma. Like that, Q2. Q2, how much income did we anticipate? 4 lakhs. A 4 lakhs में go and apply 26.42%. 1 lakh? Okay, 680. Now Q3, careful. Q3 how much income did you expect? 6 lakhs now. So in this 6 lakhs, sir, there is a special income also, no? So there is a special income of 1 lakh. On that 1 lakh, apply special rate. So that is equal to 10,000. Remainder is 5 lakhs. On that 5 lakhs, apply your usual average rate. 1 lakh, 32,100. So both put together it is 142,100. Q4, I think I gave you only 2 lakhs into 26.42%. Much 52 for it here. 50? I'm sorry, 840. That is that, sir. This is how you handle it. In this, you observe what actually you have done once again. Step number 1, current period ka income you know. Since you are standing in Q1, Q1 ka income you know. Q2, Q3, Q4 you estimate. Suppose you are standing in Q2, then you will know current of Q1 and Q2 and you have to estimate only Q3, Q4. Step number 1, annual accounting income, PBT. Step 2, taxable income, current tax, deferred tax, special tax. Step number 3, a tax expense what you computed in step 2, a tax expense express it as a percentage of your step number 1 and work out a weighted average tax rate on accounting income. So accounting income denominator, tax expense numerator. So you are getting a rate percentage on accounting income. Go to each quarter ka accounting income, release that rate. If any special rate is there, that also you have to apply. That's it. Now, in this, what doubt we will get is, tell me, sir, in computing this 26.42% kind of rate, are these estimates are also involved or not? Yes. Is it possible that the estimates and actuals may differ in future? Possible, no? Very much possible. Then what will happen? Simple. You have to remeasure again the entire tax expense. Imagine. Sir, I'm showing you the maximum case so that all the questions will become easy for you. So bear with me with this example. Once this example is over, it will be very simple for you. In Q2, company actually earned PBT of, how much did you estimate originally? 4 lakhs. So there is no change in the estimate, everything will work as planned. In Q3, company earned PBT of, how much is planned? 6. but this fellow earned 9 lakhs. Out of this 9 lakhs, 1 lakh is capital gain and remaining 8 lakhs is normal income. So there is a change in the estimate and you identified that in Q3. Now that there is a change in the estimate, you have to do the entire steps once again and see what is right and what you have to do now. So for Q4, okay, so this is a change in estimate. Sir, what should I do? Redo all steps again, which means step number 1, determine your annual accounting income. You tell me now which one is actual, which one is fake now. Which one is expected, not fake. Q1 actually you earned 3 lakhs plus Q2 actually you earned how much? 4 lakhs plus Q3 you now actually earned 9 lakhs. There is a special income though. Q4 expected. Let's continue with the original expectation only, which is how much? 2 lakhs. Sir, this is actual. This is also actual. This is also actual. This is expected. So you identified that there is a change in estimate in Q3. Sure, tell me the total number. 3 plus 4, 7 plus 9, 16 plus 2, 18 lakhs. My step 1 is ready, sir. Step 2. Let's work out taxable income. So your accounting income is 18 lakhs. In 18 lakhs, there is a special income, capital gain of 1 lakh. That if I exclude, remainder is 17 lakhs. So my current tax rate will be like this. For the first 5 lakhs, I will apply 20%. For the remainder 12 lakhs, I will apply 30%. How much is that? 1 lakh plus 3 lakhs 60,000, which is equal to 4 lakhs 60,000. Special tax 1 lakh into 10%, 10,000. This of course relates to Q3 only. Step number 3 is determining your water. What is your actual tax, current tax now? 4 lakhs 60,000 divided by, what is your income? 17 lakhs into 100. Tell me the number. 27.05%. Earlier your rate was not 27.05%. Your rate was something else. 26.42. Now it is coming to 27.05%. You know what is the moral of the story? First quarter, second quarter also, you should have applied only 27.05. But I already applied what? 26.42. That means you recognize lower tax expense. A correction and all has to happen now in the third quarter. Now, how will I do that correction? Remember, sir, interim financial statements itself means year to date model. So, measure tax expense on year to date basis, which means what is Q1? That means up to 9. That means year to date means which quarter, sir? Q1 plus Q2 plus Q3. Tell me, sir, Q1 ka income is how much? 3. Q2 ka actual income no change is not there. Estimated and actual both are same. Q3 9, but a 9 lo 1 lakh special income is there. So actual income, if I take normal income, it is only 8 lakhs. On this, I have to apply 27.05%. Do the math. year to date basis lo measure cheyandi sir. Till date how much tax expense you should have booked? Tell me the number. 405,750. From this what you do, minus tax expense of Q1 and Q2. Q1 Q2 already మనం కంప్యూట్ చేసాం. is 79,260 plus 105,680. Correct only, I saw. Correct only. Photographic memory. Total it up. Net it off. Two lakh 8. That's all. This will become your tax expense of Q3. Now in Q3 what is there? Q3 ka tax expense is there, plus Q1 Q2 ka underbooking whatever is there, that also happened off in Q3 itself. Year to date basis lo you have to measure it. Plus special tax is also there, which is equal to 1 lakh income is the special income on the 10%, 10,000. This is what the standard is asking you to do. Take average rate, and that average definitely has to be updated if your actuals and estimates are not matching. E background lo read the steps. It will make some sense at least. Come to the first one. Step number 1. Estimate annual accounting income by considering future income with certainty. Identify any special incomes which are taxable at special rates. Step number 2. Calculate taxable income and liability using enacted or substantively enacted tax rates. Identify special incomes and special taxes. Calculate DTA, DTL as per Ind As 12. And next 2 bullet points, time being you ignore it. I will tell you later on, one at a time. Step 3. Weighted average annual effective tax rate. This is nothing but average tax rate, sir. Step 2 lo tax expense is there. Step 1 lo accounting income is there. Express it as a percentage. Step 4. Apply the weighted average tax rate on accounting income of each period. That's it. Come to note point 1. That also you will understand now. When there is any change in the estimate of accounting income, then repeat the above steps in such interim period. Such interim period means in that period where change is there. And the tax expense of that interim period is measured on year to date basis, retroactive effect. That's exactly what we have done in Q3 now. See, originally we anticipated something. 3 is actual, 4, 6, 2 are anticipated. But in Q2, exactly we earned 4 only. There is no change in the estimate. But Q3, instead of 6, we earned 9. There is a change in accounting estimate. Now that estimate changed, a water percentage is not right. You have to update again. So redo. Step 1, step 2, you redo. Step 3 also work out. Step 4, tax expense you have to measure on year to date basis. Q1 plus Q2 plus Q3 till now 3 quarters are over. So up to now, how much expenditure of tax I should have recognized versus how much I have already recognized. So you further have to recognize 228 ton. Sir, do you agree that in the 228 ton tax expense of Q3, some tax expense of Q1 and Q2 is also there? Definitely it is there, it will be there, it should be there. Sir, you told it should not be there. No, adi change in accounting policy, sir. Is accounting policy change, estimate change, estimate change, there is no problem. Accounting policy change, when it happens, previous quarters ka impact should not come in current quarter ka P&L account. This is not accounting policy, the accounting estimate change. Are you understanding, sir? There is a difference, sir. Guys, take up question number 24. We are discussing this taxes concept now. On that 24th question, we'll start with. An enterprise reports quarterly, estimates an annual income of 10 lakh rupees. So annual income directly given. Assume the tax rates on first 5 lakhs at 30% and the balance income at 40%. The estimated quarterly incomes are 75,000, 2,50,000, 3,75,000, 3 lakhs. Calculate the tax expense to be recognized in each quarter. Guys, your thought process should be in the same steps what we have discussed. Step number 1, estimate your annual accounting income, which is directly given in the question only, 10 lakhs. Step 2, work out taxable income and tax payable. Taxable income, there is no disallowances, that kind of information is not there. So accounting income, taxable income, both are same only. Now, as regarding tax amount, on first 5 lakhs, you have to pay 30%, that's 1,50,000. On the remaining 5 lakhs, you have to pay 40%, which is 2 lakhs. 1,50,000 plus 2 lakhs, total tax will be 3,50,000. Step number 3 is working out weighted average tax rate, and your 3,50,000 upon 10 lakhs, 3,50,000 upon 10 lakhs is coming to 35%. So all you have to do is each quarter period ka income में apply 35%. So 75,000 into 35%, 250,000 into 35%, 375 into 35%, and 3 lakhs into 35%. There are no special incomes, so answer is pretty straightforward case. Right. Question number 25. This question came in the exam. See how simple it is. Estimated annual income is 1 lakh. Brackets is telling inclusive of capital gains earned in Q2, 20,000. The 1 lakh 20,000 is already included. Assumed tax rates on capital gains it is 10%. On other income, first 40,000 30%, remaining income other than 40,000 40%. Assume there is no difference between estimated taxable income and estimated accounting income. Calculate tax expense, weighted average annual effective tax rate, shortly called as weighted average tax rate, water. Also calculate tax expense of each quarter when the estimated income of each quarter is 25,000. And first quarter 25, second quarter 25, third quarter 25, fourth quarter 25. But second quarter ka 25 also includes special income of 20,000. Fine. Chalo sir, let's start then. Sir, step number 1, annual income. Annual income is 1 lakh. In that 1 lakh, there is a special income of 20,000. Set it aside. Come to step 2. On the 20,000, you have to pay 10% tax, 2,000 tax. Leave it. On the remaining 80,000, first 40,000 you have to pay 30%, 12,000. Second 40,000 you have to pay 40%, 40,000 into 40%, 16,000. 12 plus 16, 28,000 divided by 80,000 into 100. 28,000 divided by 80,000 into 100. How much is that? 35%. And special income anyway is taxed at the rate of 10%. So what you have to do, each quarter you go. Whatever income is there on that, apply 35%. If special income is there, go and apply 10%. Come to first quarter. First quarter income is how much? 25. Is there any special income in that? No. So on the 25,000 directly apply 35%. How much is that? 8750. But when you come to Q2 ka 25,000, special income is there to the extent of 20,000. On the 20,000 you have to apply only 10%. So that is 2,000. Remaining 5,000 into 35%. 2750. Total put together it is 3750. Not 37. Sir, 5,000 35% is how much? 1750. 1750 and that 2,000. Correct. And Q3, Q4 it's straightforward. That's all what is there in this. All simple stuff. Also, what came in the exam, once upon a time, old CA final question. Question number 30, sir. Good question. The AS ka question also came in Ind As. Before you read this question, though it's not completely relevant, just like that answer. Sir, what is the entry for creation of DTA? Normal entry. DTA creation. DTA to PRL. Correct? DTAs are created when future law tax savings are anticipated. Correct? Future law tax savings are anticipated when future law some deductions are going to come. Future law deduction is going to come means already there is a disallowance. Correct? So because of current disallowances, we paid higher tax. In future, when they are allowed, we will pay lower tax. Therefore, today we create a DTA. What will happen to this DTA in future? In future, when we actually pay less tax, at that time, DTA has to be reversed. Continue reading. To comply with the listing requirements and other statutory obligations, Quaker Limited prepares interim financial reports at the end of each quarter. Whatever. The company has brought forward losses of 700 lakhs under Income Tax Act, okay, of which 90% is eligible for set off as per the recent verdict of the court that has attained finality. So there is some dispute going on, sir. We are saying that 700 lakhs bought forward loss is there. That income tax fellow did not agree. Ultimately, court gave a judgment that 90% you can set off. 90% means 630 lakhs. Continue. No deferred tax asset has been recognized on such losses in the view of uncertainty over its eligibility for set off. Loss, when did you suffer? Not now, in the past. In the past, when I suffered loss, at that time only I know that in future I will pay less taxes. So previously only you should have created a DTA. But this fellow says, I did not create a DTA because there is a dispute going on. So whether this loss is really allowed or not, it's a matter pending in court. So on a prudence basis, we did not create a DTA. That's fair enough. Since he did not create DTA originally, now you need not reverse DTA also, even if you set off the losses. The company has reported quarterly earnings of 700 lakhs and 300 lakhs respectively for the first 2 quarters of financial year 13-14 and anticipates a net earnings of 800 lakhs in the coming half year ended March 2014. Oh, wait there. First quarter you earned 700, second quarter you earned 300, and you believe that remaining 6 months you will earn combinedly 800. And he says, out of which 100 lakhs is loss in the third quarter. What does it indicate? Fourth quarter you are going to make 900. Otherwise, combinedly Q3, Q4, how will it be 800, sir? So obviously, a 900 is missing here. You have to catch on your own. Continue. The tax rate for the company is 30% with a 10% surcharge. You are required to calculate the tax expense for each quarter of the financial year 13-14. Chalo, sir. Step 1, step 2, step 3, step 4, as usual. Take your calcium. Step number 1 is what? Identify your total accounting income. Club everything. 700 plus 300, 1000 minus 100, 900, 900 plus 900, 1800. So, step number 1, my answer is 1800. What is step 2? Tax. Taxable income you have to work out. So, 1800 accounting income. But luckily, you have a carry forward loss now. 700 lo 90% you can use. So, unto 630. 1800 minus 630 you do. That into what tax rate is applicable for you? There is no slab system and all. Flat 30% is applicable. Into 30% go 10. Add 10% also. Surcharge is also there. So directly 33 also you could have applied. 386.1. This is step 2 ka answer. What is step 3? Water rate. What you should do? 386.1 divided by 1800 into 100. Do 386.1 divided by 1800 into 100. 21.45%. Are you all getting it, sir? Now what you will do? Each quarter ka income is there. Go there, multiply with 21.45%. That's all. So first quarter ka expense will be how much? 700 into 21.45. Second quarter 300 into 21.45. Third quarter minus 100 into 21.45 as the reversal. Fourth quarter 900 into 21.45. That's it. Based on this question only, E question came in November 24. Do you know, sir, question number 30 is how long question? This is AS ka question. AS 25, Interim Financial Reports of Normal Accounting Standards. CA finally this question came. It is not there any RTP, MTP and all. Directly exam this one came. November 24 exam. Past questions, sometimes some good questions will be there, sir. That's the reason we include that. The same drama you see here. Again, a surcharge and all. Total copy pasted. First quarter ka income, second quarter ka income, third and fourth quarter ka combined income, third quarter lo loss. Same pattern. You understand, sir? AS questions they are still asking, sir. Some questions, why they are there means there is a reason. As it is will come. Chalo, question number 31 also is deemed to be completed. 30, 31 both are same. Okay, now coming to extra points, sir. Watch this, sir. Some smart fellow comes, does one fantastic calculation like this. He says, I am presently standing in Q1, Q2, Q3, Q4 year ending. What this fellow says is, sir, my income today is 150. Current income is 150, first quarter ka income. You have to estimate Q2, Q3, Q4. No, this fellow estimated as like this. Why did he estimate like that? If I work out accounting income annual, what will happen? 0 will come. Now accounting income is 0, taxable income is 0. I need not pay any tax, no. Therefore, I will not book any tax expense. Now you cannot go and verify whether in future he will actually make a loss or not. You can't verify. But if you trust this fellow like this, he will never book tax expense. Everybody will start playing this game. So what this standard says is, when you are anticipated to suffer losses in such a way that overall also loss only is going to come, then what you do is ignore the losses and recognize tax expense on this. And if you book tax expense positive here you book tax expense negative and reverse it. For that, read this concept. If you understand, it's fine. Otherwise, I'll take you an example again. Please come here. Note point 3, sir. Note point 1 already over. Note point 3. In estimation of accounting income on annual basis, entity has to estimate income for remaining interim periods. That point we know. If in the remaining interim periods, losses are expected in such a level that overall annual accounting income is 0 or negative, then ignore such losses of future periods and determine weighted average tax rate. So what did we say? Ignore that 50, 50, 50. 150 means whatever tax, imagine that your entire year income is only 150. On this 150, how much tax you have to pay, you calculate. Book it here. Really you suffer a loss, then we'll reverse the tax expense here. So you predicting your annual income in such a way that overall the loss is coming, therefore altogether I will avoid tax expense is not right. If profit is there now, book tax expense. Future loss will come, we will do reverse. It is very, very popular question again. Conceptually important also. Simple question. Come here. Many stupid questions are there in the same model. Try one. Come to question number 27. You can do 26. All are same models. The RTP, MTP are coming, sir. Exam did not come. Ind As. AS exam came. 26, 27 both came. Any one question you can solve. Do 26, sir. An enterprise reports quarterly, earns 150 lakhs pre-tax profit in the first quarter, but expects to incur losses of 50 lakhs in each of the 3 remaining quarters. The Q1 150 profit, Q2, Q3, Q4 losses, and thus having a 0 income for the year, and is governed by taxation laws, according to which its estimated average annual income tax rate is expected to be 35%. That means water rate is given 35%. Calculate the amount of tax expense for each quarter. If you apply step 1, step 2, step 3, step 4 model, you will get 0. Don't apply. You understand, sir? This is an exceptional case. Don't apply. Then what you should do? Directly on 150 lakhs, apply 35%. How much are you getting, ma'am? 52.5. But really, in Q2, Q3, Q4, if you really suffer losses, then the tax expense and liability what you created that is not going to be there for you, every year go and reverse it. So 50 lakhs loss, 50 into 35%. How much is that? 17.5. Tax expense reversal. Presently you are in Q1, no? Q1 ki book jail. Q2 you will come to know the fact. If you really suffer a loss of 50, then this is correct. Reverse of the tax expenditure. So in the quarters where you have positive income, book positive expense. In the quarters where you have negative income, book negative expense. So reverse. If you apply step 1, step 2 model here, you will get 0. The wrong, sir. Is exceptional case, important case. In note point 3 is that only. Recognize tax expense in the interim periods on the profit and a negative tax expense in the interim period when losses occur. Straightforward. A point you read, a question you solve. It is that related. Next, one more last note point is there relating to taxes, and then we are done with taxes. Please come to note point 2. When the accounting year is not financial year, and therefore multiple tax rates are applicable, measure tax expense of interim period by applying actual tax relevant for such interim period. Sir, we did not understand anything. Nothing, sir. Very straightforward. Watch this. Follow carefully. Easy only. Sir, you are following Q1, Q2, Q3, Q4. 4 quarters you will prepare financial statements. But unfortunately or fortunately, your accounting period is January to December. In January to December, the problem ఏంటంటే sir, income tax fellow will give you rates on financial year basis. So it is quite possible that the rate of tax what you pay for Q1 and the rate of tax what you pay for Q2, Q3, Q4 rate will be different. Possible? Sir, last year government tax rate was 25%. In Q1, that is your March month somewhere or February month, budget got presented for the next year tax rate increasing to 35%. Now, as a result, what happened? Your accounting period falls under 2 financial years, and consequently, for different interim periods, different tax rates got applied. If you apply my concept of step 1, step 2, step 3, what is happening? You will average 25 and 35 also, no? Because step 1, total accounting income. Step 2, total tax. Step 3 is what? Total tax divided by total income. As a process, what is happening? Knowingly, unknowingly, 25 and 35 average is happening. The standard says don't do that. Then what I should do is, you will apply your step 1, step 2, step 3 model for here. Q2, Q3 and Q4. Q1 don't touch. Q1 tax rate you apply. That means when your accounting period covers 2 financial years and consequently you have different tax rates, don't take average of different financial year ka tax rates. Sir, earlier we took 30 and 40 ka average rate. That we took because of the slab relating to the same year. So 30% is also for current year, 40% is also for current year, depending on your slab of income. Akkada average you take, no problem. But 2 financial year ka tax rates, don't disturb it. So point. Based on that also, one question if you see, all models will be over. 27 is normal one, sir. Not this one. Yeah, this one, sir. Please read this one. An entity's accounting year ends on 31st of December, but its tax year end is 31st March. Exactly the same case what we are talking. The entity publishes interim financial report for each quarter of the year ended 31st December 2019. The entity's profit before tax is steady at 10,000 rupees each quarter. Fantastic. And the estimated effective tax rate is 25% for the year ended 31st March 19 and 30% for the year ended 31st March 2020. What is your accounting year here? January 2019 to December 2019. Tell me, sir, first 3 months ki which rate is applicable? Last year ka rate. 25% is applicable for 3 months. New tax rate 30% is applicable for 9 months. Don't do average of tax rates falling in different financial year. That's the rule. So what you are supposed to do? Q1 lo book tax expense at the rate of 25%. Q2, Q3, Q4 ki go and give tax rate of 30%. So never do averages of tax rates falling in different financial years. That's all. That is one extra note point you have to keep in mind. That's it over. This is all the concepts relating to tax impacts. Now coming back to other concepts. In this next important concept is above one item only. Fixed production overheads. Fixed overheads are absorbed. Wait a moment, don't read that. Ind As 2 is over for us. Tell me, sir, how will you allocate fixed overheads? Normal capacity or actual production, whichever is higher. Based on that, you have to allocate. Correct? Read. Fixed overheads are absorbed on the basis of normal production or actual production, whichever is higher, as per Ind As 2. In interim financial statements, fixed overheads absorption must be done on year-to-date basis. See, normal production, actual production, that you don't check quarter wise, year-to-date basis, you have to keep on checking. That's the only point you have to remember. It is important, sir. On this, questions have come in Ind As also, AS also. It's very, very important. Fixed overhead absorption is equal to actual production units till date into fixed overhead absorption per unit. P&L impact is whatever you computed above minus what is already absorbed till date. So anyway, let's work out and see with the numbers, then you'll have more clarity. Come here, sir. 23, 22. Both are same type of questions. 21 also same type of question only. One question if you solve, all the remaining are done. This is same as 21 and 22. We are solving this one. Please go through this one. Fixed production overheads for the financial year is 10,000. Okay, annual cost. Normal expected production for the year, after considering planned maintenance and normal breakdown, also considering the future demand of the product, is 2000 metric ton. So what is 2000 metric ton? This is your normal production. Normal production level is 2000 metric tons. Adi per annum, sir. It is considered that there are no quarterly or seasonal variations. That means throughout the year, your production will be uniform. This is not a seasonal business. Therefore, the normal expected production for each quarter is 500 metric ton. 2000 metric ton per annum means per quarter it is 500 metric ton only, because you are not a seasonal business. If you are a seasonal business, what will happen? First quarter 100, second quarter 100, third quarter suddenly 1800, quarter 4 0. It is possible like that. But you are not a seasonal business. Very clearly the question is telling there are no quarterly or seasonal variations. So uniformly. And fixed production overheads for the quarter is also 2500. Already he told 10,000. Per quarter it is 1/4, 2400, 2500, sorry. Now he is telling you actual production achieved in Q1, Q2, Q3, Q4. Presuming that there are no quarterly or seasonal variations, calculate the allocation of fixed production overheads for all the 4 quarters as per Ind As 34, ready with Ind As 2. Now, all of you, sir, take your calculator. What is your fixed overheads for each quarter? 2500 divided by what is your normal production? 500 metric ton. So that is how much rupees? 5 per unit. 5 per unit is your normal absorption rate based on normal production. Let's see. Q1 is over, sir. By the end of Q1, what is your actual production overheads? 2500. This is actual. But how many metric tons did you produce? 400. For each unit you will absorb at the rate of 5, which is equal to rupees 2000. What does it mean? We incurred 2500, but what I can allot to the units is only 2000. That means how much I incurred, but I cannot allot to the units? 500. Under absorption is there. That is a loss that will go to PRL. Wait there. Come to the answer, sir. Actual fixed production overheads is 2500. Fixed production overheads based on allocation rate of 5 rupees per unit is 2000. So under recovery, unallocated fixed overhead. Sir, I spent, but I could not produce. See, sir, you are incurring expenditure of 2500 to produce at least 500 units. But if you produce only 400 units, there is an underutilization. So whatever extra cost you incurred, that somehow you should not load it off to the units produced. So extra you incurred, but units you did not manufacture. So that's a loss. How much amount will go to loss, sir? 500 rupees. Okay. Now, first quarter, nobody will make mistakes. It's very easy. Come to second quarter. The moment you see 600, what is your mind saying? Actual production or normal production, whichever is higher. Correct? Wait there. When you are doing interim financial report, you have to absorb fixed overheads based on year to date, not on Q2 alone. Year to date. Year to date ka meaning is what? Q1 plus Q2 combined you have to analyze. Tell me, sir. Q1 how much is your actual? 2500. Expense I'm talking. Second quarter also 2500. So total expenditure fixed overheads incurred is 5000. Okay. Now first quarter how many units did you produce? 400. Second quarter 600. Total 1000. 1000 into 5 rupees. So what you incurred is 5000. What you can allot to units is also 5000. Is there any under absorption or over absorption? Nothing is there. But in Q1, what did you do? You assumed that there is a loss of 500 and you charge it off to P&L account. No, a loss you reverse it. Because loss was there in Q1. But when you club Q1 plus Q2 together, then there is no loss. A loss, whatever you booked in Q1, that you have to reverse it, sir. So check the answer. Actual fixed production overheads on year to date basis is important here. $5,000. Actual fixed overheads to be absorbed on year to date basis. E 1000, how did you get? 400 plus 600. 5,000. Earlier, 500 rupees was not allocated to production in the first quarter. To give effect to the entire 5,000 to be allocated in the second quarter, 500 rupees are reversed by way of credit to the statement of P&L account. First quarter, there was an under absorption and a feeling the book loss. But when it's compared with the second quarter, I realized that overall there is no loss. Again, credited back to P&L account. Now come to third quarter. Third quarter, how many units did you produce? 500 units. But don't look like that. Again, cumulative, year to date. Tell me. Third quarter expenditure is how much? 2,500. So total expenditure incurred till date is 7,500. What is the total number of units manufactured till date? 1,500. 1,500 into 5, 7,500. Both are matching only, no? There is no under absorption, no over absorption. No impact also has to be given. That's it. Q3 you see, there is no under or over recovery of allocated overheads. Hence there is no further action required. Finally, Q4 how many units did you manufacture? 400 units. Again, cumulatively come. Total overheads incurred till date is 10,000 rupees. But total units manufactured till date is 1,900 rupees. 1,900 into 5 rupees is 19,500. 9,500. So you spent 10,000, but fixed overheads which you can allocate to the units is only 9,500. The 500 rupees extra you spent, but production did not happen. So 500 rupees is a loss that has to be booked in your PR. Sir, what is the logic of doing this year to date method? Logic very simple, sir. Imagine, forget about stupid interim financial statements. Let's think of annual financial statements. What is your normal capacity? 2,000. What is your actual production? 1,900. So your total fixed overheads incurred is how much? 10,000. What you can allot to your actual production is 1,900 into 5 rupees, which is 9,500. On an annual basis, you are getting a loss of how much? 500. Interim basis also same loss should come. No, overall. How can I have more loss or less loss? Annual basis, if there is a loss of 500, Q1 plus Q2 plus Q3 plus Q4, when I check also, overall loss should be equal to 500 only. That check is important. To get that check, what I have to do? Every year I have to compare. Every quarter I have to do year to date basis. Adival logic. That's why, look at the last conclusion, what they wrote. The cumulative result of all the quarters would also result in unallocated overheads of 500, thus meeting the requirements of Ind As 34 that quarterly results should not affect the measurement of annual results. That means under absorption in all interim periods should be equal to under absorption in annual financial statements. So that's the whole point. Adi, you need not do anything, sir. You just do year to date basis and naturally it will ensure that. So go back and read the concept booklet what you have written. What's the principle written for this? Concept booklet, what did we write for this? So what we wrote is fixed overhead absorption year to date basis lo actual production units into fixed overheads per unit. This is the absorption. Impact to P&L account. Actual fixed overheads incurred till date year to date minus fixed overheads absorption year to date. A difference will go to PR. The most easiest way, sir. Year to date basis on a point you have to remember. That's all, sir. I and J special cases are important. Remaining special cases never came, sir. On that, questions are also not there. But few you can read and go. Theoretically, if questions comes, you will be safe. That's why we will discuss another 5-10 minutes, some small points. Come here, sir. Come to B bit, please. Don't read anything. I'll put it as a question. You tell me what is your first thought. If it is matching, you need not study that also. It's that simple. Sir, Q1, Q2, Q3, Q4. Okay, I'm standing in Q1. The company planned a major overhaul expenditure in Q4. Can I book any expenditure and liability relating to that Q4 ka overhaul expenditure in Q1 itself? Can I book or I should not book? No. It is pakka expected to be incurred. But if I book now only, you know what am I saying? There is an obligation to incur and I am saying. Is there any obligation to incur? Intention to spend money is different from obligation to pay money. So you should not anticipate any future expenses right now. That's all. Please read. The cost of planned major periodic maintenance or overhaul or other seasonal expenditure that is expected to occur later in the year, that not late sir, later in the year, is not anticipated for interim reporting purposes unless an event has caused the entity to have a legal or constructive obligation. See, why it should not be anticipated on a point, if you know, an exception point automatically you will know. Why you should not anticipate December ka expenditure? Why should I not record in first quarter? Simple reason. If I record that expenditure in the first quarter, since I did not pay, I have to create a liability. If I am creating a liability, you should prove that there is an obligation. Expected to incur is different from obligated to pay. There is no obligation, that's why you should not record. But if you have an obligation, then definitely you have to record. Other exception, unless the entity has a legal or a constructive obligation. This is theory question. RTP MTP lo they are asking you. Next, same story will be this. Sir, how will you recognize provisions? Sir, provisions answer is like this. You tell me, sir, what are the three criteria for recognition of provision? There should be a present obligation arising as a result of past event. Then probability of outflow of resources and reliable estimate should be made towards the amount of obligation. If all the three conditions are satisfied, then I'll recognize a provision on the balance sheet date, correct? Year ending. Whatever three criteria you apply for recognition of provision on the balance sheet date, the same three criteria you have to apply even on the interim date also. Whether you are doing a quarter financial statements or a half yearly financial statements, rules will not change. Provision is provision. A definition you have to satisfy, recognition criteria you have to meet. No exceptions are given. That's why see what is written there. The entity will apply the same criteria for recognizing and measuring a provision at an interim date as it would do at the end of its financial year. In this, is there anything extra to remember, sir? All natural, normal points. So don't get panicked looking at the number of special items there. Inside that, there is nothing. Next. Again, sir. Understand my question correctly. Sir, year ending, sir, normally company creates a bonus provision, of course, if it has an obligation. Year ended, after the balance sheet date, we will give some bonus. It has been my practice. Therefore, there is a constructive obligation or a legal obligation. So even though exactly amount you do not know, you will estimate some amount and create a bonus expenditure and a liability on the balance sheet date because you are having a obligation. Now, should I create a bonus expenditure and a provision at the end of Q1, Q2, Q3 also? That's the question. Do you understand my question? For the entire current year, let's say I have to pay 100 lakhs bonus, sir. What is the entry I will write? Bonus expenditure account debit to bonus payable. 100. When will I write this entry? 31st March I will write. This fellow's doubt is, this bonus is for the entire year, no? Correct. But Q1 also we earned some profit. Should I create a bonus expenditure and a liability at the end of Q1 also? That's the question. Now, bonus creation key, what is the condition, sir? Condition is, first of all, obligation should be there. That should be either legal or constructive obligation. If obligation is there, then only bonus is payable. Now, generally bonus is payable. If it is legal obligation, definitely you have to create, sir. There is no doubt on that. But if it is a constructive obligation, I can pay bonus only if I have profit. No, if I do not have profit, how can I pay? If it is not compulsory, then I need not pay also. In that case, you will know whether you will have profit or not only when you come to the end of the year, not at the end of each quarter. You have seen some questions. Q1 lo profit is there. What happened in Q2, Q3, Q4? Losses came. Overall year point of view, 0 you have. You have intention to pay bonus, but you have money to pay bonus. Huh? You may not pay bonus in that particular year, and therefore you need not owe. So first quarter unnecessarily if you create a bonus, ultimately you don't have an obligation to pay or you don't have an intention to pay, then unnecessarily you would have created. No. So standard says, go and apply Ind As 19 ka criteria. Ind As 19 lo what they said is, on every balance sheet date, see if you have an obligation. You have an obligation to pay bonus, please recognize expenditure and a liability. Don't have, don't recognize. So no detailed guidance is given. A bonus is anticipated for interim reporting purposes if and only if the bonus is a legal obligation or a constructive obligation and the entity has no realistic alternative but to make payments and a reliable estimate of the amount of obligation can be made. Ind As 19 employee benefits provide guidance. Now you tell me, is it extra point? Whatever we do normally at the end of the year, same thing is there at the quarter also. So no new point for you. Come here. Variable lease payments. This is interesting case, new case. Carefully understand. Sir, I leased a machinery from a lessor. Lessor told me that I have to pay some lease rent and all, which is part of my ROS accountability to lease liability. Accounting it will go off. A lessor fellow tells me, if you use this machine and manufacture more than 1 lakh units, on that every extra unit you manufacture, you have to pay me 5 rupees. Now, whether I will pay that extra 5 rupees per unit or not, that depends on what? Whether we are going to produce more than 1 lakh or not, that depends on my output. Now, I am in Q1, sir. I already manufactured 30,000 units, Q1 lane. And now I definitely feel that by the end of the year, we'll hit off the mark of 1 lakh. And definitely contingent rent is payable. Now, should I recognize some expenditure relating to that contingent rent in the Q1 also? Even though rent is payable based on units, but rent relates to the entire year. So it's a time related expenditure which is based on production units. So what the standard gives you a guidance here is, carefully read. Contingent lease payments can be example of legal or constructive obligation that is recognized as a liability. If a lease provides for contingent payments based on lessee achieving a certain level of annual sales, an obligation can arise in the interim periods of the financial year before the required annual level of sales have been achieved. So my production level or my sales level might not have hit the mark yet, but it is likely to hit. The standard says book the expenditure. If that required level of sales is expected to be achieved, you need not actually achieve it, expected to be achieved is enough. And the entity therefore has no realistic alternative but to make the future lease payment. That means first quarter only 30,000 units you have manufactured and sold, and you very well are sure that pakka 1 lakh mark we are going to hit. Then for that extra rent, you definitely have to create a provision right now. On this question is not there, sir, only theoretical question. Nothing is there, sir. You can go through this on this very simple point. This is also simple point, sir. There is no new points in this. This H point and E point number B are similar. What is that? Other planned but irregularly occurring cost. Suppose I have a plan to incur some training cost after 6 months. Very certain, 100% I am going to pay that. Just because I am very sure that I will incur expenditure at a later date, that does not mean that out of that some expenditure will book it in the current quarter, because you don't have any obligation to pay. A training event did not happen. So that's what he's saying. Recognizing an obligation at the end of an interim financial period for such cost that have not yet been incurred generally is not consistent with the definition of liability. Indirectly, what is he saying? Do not recognize. Future cost ki never you should create a provision today. Ind As 37 ka fundamental point. Provisions are future outflows, but every future outflow ki today provision you should not create. No, our point. This point is based. HIJ we have already covered. The depreciation and all are simple points, sir. Come to this one. This is also something which you can read. Sir, how will you measure closing stock? You know valuation principle. I'm not asking valuation principle. That I also know. Cost or NAR, whichever is lower. Multiplied with what? Cost or NAR, whichever is lower. Multiplied with what? Total number of units. How do you know how many number of units are there? You will believe that accountant ka Excel sheet. No, you will have to go and do a physical stock verification. If you are doing physical stock verification, on one side, more purchases are coming, more sales are also happening. Can you do physical counting? Whatever you counted is not there, no. It will be sold. So what will you ask the client? Client, stop. Stop selling, stop taking input, let me count first. So you all know, sir, at the end of the year, we go for a physical stock take. A physical stock take, technically speaking, will disturb their business for 1 or 2 days. If their internal control procedures are good, one day it will be over, sir. Bad company, the 2-3 days work halted. He can't make purchases, he can't deliver goods. Are you understanding, sir? Imagine I ask that fellow to do that in every quarter. What will he say? Are for your sake of stupid financial statements, should I lose my business? So his standard says full stock taking procedure is not required on interim periods. So what you do is on a sample basis you can check, or take the total goods ka value on based on your accounting records minus the sales margin. If you remove, average cost will come. That is acceptable. What is he trying to say indirectly is physical stock take if you do on every interim period, that may not be convenient to many companies, that will disrupt your activities. So you need not do. Then how will they work out? How you will work out is average estimate basis will work out the cost. Full stock taking and valuation procedures may not be required for inventory at interim date, although it may be done at financial year end. It is sufficient to make estimates at the interim dates based on sales margins. To save cost and time, entities often use estimates to measure inventory at interim date to a greater extent. So exact physical valuation is not required. Small estimate should be fine. Foreign currency translation gains and losses. How cheap question it is. Don't read. I'll ask a question, try to answer. Sir, I have a foreign currency borrowing, sir. Foreign currency borrowing is a monetary item. Q1 ending low, sir. Balance sheet I'm preparing now. On every reporting date, what am I supposed to do? All monetary items must be remeasured using closing exchange rate. I remeasured. Loss came. This fellow's argument is, sir, why should I book loss? This is full year is not over. No. Subsequent quarterly exchange rates may move favorable to me. So I will not book loss. I will hold it. Next quarter gain will come, or next quarter loss will be set off. Why should I book loss in the first quarter? Argument a client brings. Maybe true, because Q1 you get a loss does not necessarily mean that annual point of view also loss may come. Loss may not come eventually. In fact, you may have a gain also. We never know. But Ind As 21 says, apply me as it is. Each quarter, treat it as a full year. First year loss came, sir. Will I book the loss or not? Or will I say, second year gain will come. Why should I book loss in the first year? And the argument is acceptable or not acceptable? No. Like that here also. Entities should not defer some foreign currency translation adjustments at an interim date if adjustment is expected to reverse before the end of the financial year. E point actually gets covered to you in the concept of no sharing caring. Sir, if I am not booking loss in Q1, ka meaning is what, sir? I am deferring the loss to next period. No. A deferring are not permitted is what he is telling. Sir, a question, sir, there are questions they are asking. How will you treat bonus in an interim period? How will you treat foreign exchange loss in an interim period? Like this theoretical questions they are asking. Unless you study this, you can't answer that. But there is nothing to study, sir. You ask yourself simple questions, answers will come out. E-provision, same things are already discussed. Come here, pensions will do. Tell me, sir, do you all agree that according to Ind As 19, there are 4 types of employee benefits? Short-term, long-term, post-employment benefits, termination benefits, 4. Out of that, for long-term employee benefits and post-employment benefits, our accounting is based on whether it is a defined contribution plan or a defined benefit plan, correct? If it is a defined benefit plan, you have to apply a method called as projected unit credit method, PUCM. A PUC method, some steps are there. If you visualize, what are the steps? Estimate the benefit payable in future, cost. Step number 2, allocated cost per annum. Step 3, current service cost. Step number 4, a liability sheet. Step number 5, current service cost, interest cost to PVDPO and accounting entries you have to write. Plan assets accounting and all we have seen. Now, the entire drama, current service cost, interest cost, when will I recognize, sir? Every day I'll recognize. Year end actuary will give one report, no? Our report CSIC will be there. Looking at that, my accountant fellow will pass off the entry, current service cost, interest cost to PVDPO. The entry is passed on the basis of actuarial report. Year end it will come. This is PUCM method, defined benefit plan. Now you can guess my question very easily. Year end you will do this. For Q1, what will you do? Will you again fetch a new actuary report for only Q1? Na? It will be costly, no? Every 3 months, if you are bringing actuarial report, that fellow will loot you. For the sake of following Ind As 34, will you go to that extent? Huh? The standard says, don't take trouble for me so much. Last year annual actuary report is there. Take that, proportionately measure it off. Last year actuary report lo current service cost some number will be there. That is for full year. Today you are preparing for Q1. Multiply with 3 by 12. Of course, you have to make adjustments if some employees have left and all. Some employees already taken full pensions. Some adjustments you make, but basically you draw the numbers from past actuary reports. Recent actuary report you take, from that do proportionate calculations. The guidance given. See, Ind As 19 requires that entity determines the present value of defined benefit obligation PVDBO and the market value of plan assets at the end of each reporting period, and encourages an entity to involve a professionally qualified actuary in measurement of obligations. Fine. This is Ind As 19 ka provision. But interim lo what I should do? For interim reporting purposes, reliable measurement is often obtainable by extrapolation of latest actuarial valuation. Most recent actuary report, whatever you have, take that. Based on that, proportionately calculate. Extrapolation is that only. Right there, proportionately compute expense for interim period. That's all, sir. These are the special cases. These special cases, sir, as you have evidently seen, no questions numerically can be tested because they are all simple guidances. You can do, you cannot do, that kind of thing. Questions can be tested only on two aspects this year. Both we covered already. One is fixed overheads. The other one is income tax expense. That's why if you go through, run through the questions quickly, they are asking you theoretical questions only. For example, you see here, this MTP lo question came, sir. How should the following be recognized and measured in interim financial statements? Straight away, that fellow gave you 4 items and is asking, tell me the treatment of that 4 items in interim financial reports. Provisions. Provisions, what is the rule, sir? Whatever you do at the end of the year, provisions ka criteria, same thing will apply even in interim financial reports also. Foreign currency translation gain or loss, same. You cannot postpone exchange gain or exchange loss to other quarters. Major planned periodic maintenance or overhaul. Q3 lo overhaul is there. Q1 lo can I book expense, sir? No. Impairment of assets. If impairment indicator is there, definitely you have to go and do impairment testing. What is there to postpone and all? Simple. E points, if you once read e question, you can answer. The easy look 4 marks, sir. Question. MTP it is, sir. Examiner did not come yet, will come. It is same type. Employer contributions, major repair and renovation expenses, bonus. Same, whatever special cases we have studied based on that questions. Whatever you studied there, as it is, you have to write, print that here. This question only we already covered. Please read this quickly. RTP November 2022. I thought I kept this in Ind As 8. I removed it and I put it here only. Okay. While preparing interim financial statements for the half year ended 30th September 20X1, an entity notes that there has been an under accrual of certain expenses in the interim financial statements of first quarter ended 30th June 20X1. Under accrual means you forgot to book some expenditure. The amount of under accrual is assessed to be material in the context of interim financial statements. However, it is expected that the amount would be immaterial in the context of annual financial statements. The management is of the view that there is no need to correct the error in the interim financial statements, considering that the amount is expected to be immaterial from the point of view of annual financial statements. Whether the management's view is acceptable. Sir, presently if you are preparing interim financial statements, materiality has to be judged in the context of interim financial statements, not in the context of annual financial statements. So obviously management's contention is not right. That is a material error only. Compulsorily you have to rectify. That's all. Haha, over.